Higher by just 0.1%, Anna.
Yeah, let's have a look at some of the individual stocks in focus then, Tom. We'll focus in on the banking sector. We've had numbers from ING, but also Deutsche Bank, so that's going to be certainly one of the ones we're watching. Fixed income sales and trading revenue beating estimates, a buyback there. There is that raid that they've confirmed. How much does that cloud things? Perhaps not when it comes to the actual numbers reported. SAP in focus. Where will this one trade at the open? The current cloud backlog grew by 16% in the fourth quarter. Is that going to be enough? They've announced a share buyback as well. Tom was mentioning the copper price, which is up by 6%, so we'll certainly be watching what's going on with the mining stocks. We'll also watch what's going on with oil majors as well. We've paired those gains a little bit, but on the Iran tensions, oil prices heading back up towards $70 a barrel on Brent. We're at 69.26 right now, guys, so up just over 1%.
There is a lot to price in to these European markets this morning. Is it going to be balanced? Is it not going to be balanced? Are we going to see big moves one way or the other? Let's see. FTSE 100, no big moves so far. Oil stocks are going to be in focus. Miners are going to be in focus. We've got the Lloyds Banking Group out with numbers as well this morning. That's going to be in focus. We'll wait and see how other markets go, but initially, the Stoxx 600 is really just a reflection at this point, maybe of more UK stocks. I think the CAC's going to be interesting today, but it's going to be the DAX. I think will be fascinating to see exactly how Deutsche trades this morning, how SAP trades this morning. The SMI's got a whole raft of pharma stocks that it needs to deal with as well, as has the CAC actually, and Sanofi's going to be interesting to see what we get out of Sanofi this morning. Could be really quite interesting too. The IBEX is up by 0.2%. How's the AEX going to trade today? Sort of day 2 ASML, I think, will be an interesting story to watch out for. Going to price in all the tech. There is a lot going on. On balance, it looks like actually we are starting to see a little bit of outperformance coming through from the CAC and a little bit of underperformance. We'll see how the DAX goes in just a moment from some of the other key markets. Tom, sectors.
Basic resources at the top of the list. Not unsurprisingly, of course, given the pickup in copper prices and across the commodity space, just much higher pricing that's come through in the session today. So basic resources as a sector up 2.5%. Tech is there, represented by the likes of ST Micro, up 1.2%. So tech is getting a lift as well. It's the second best performer across your sectors so far. Personal care, that is the sector with the biggest drop so far, down 0.5. Health is also down a little.
Today, but we'll see how that one develops.
Biggest points gainer in Europe this morning, ASML.
Right.
So ASML and Schneider, the two biggest holdings. Shell, Rio, Anglo-American, Glencore, Total. So the commodity story well represented in terms of the points gains that we're seeing at the top of the list this morning. What is interesting at the bottom, Roche is the biggest points drag this morning. Is Thomas Schinecker being too conservative with his guidance? He said, I can guarantee the guidance. There may be some upside, but is he being too conservative with that? Is that why the stock is tracking lower? Or is it the kind of themes that we've been watching over the last couple of days on pricing out of America and all those other kind of IRA stories?
CapEx concerns, political uncertainty out of the US. But in terms of the pipeline, that was in focus. And in terms of their obesity drug, he's saying they're making really significant progress on that.
The pharma space is largely dead. Three biggest points drags: Roche, Novartis, Novo Nordisk.
Yeah.
AstraZeneca's not far behind. It's interesting, Deutsche Bank is lower by 1.78%. And I wonder, to your point, Anna, whether that's what is happening in terms of the raid that has been conducted on the headquarters, or is it something to do with the numbers? Actually, there's some interesting comments coming through about research as well that is worth watching. SAP, here we go. That is a big drop.
We all share the same sentiments around that one. Yeah, down by 10%.
That is brutal, given the 30% drop that they've seen from previous highs.
Yeah.
Wow, look at that.
There was a time
10%
we
drop
were
for
talking, this
SAP.
was the biggest company in Europe.
The most valuable. The valuation's been cut to about 250 billion. That compares to about 500 billion for ASML. But the point that Christian Klein was making to us earlier was, yes, it makes sense that the investor focus is on the hardware right now, but ultimately the value accrues to the application there. I guess the question is, when does that become the story? Is that a 2026
But are they going to
story?
be... Will somebody else be there? The competition at that point is going to be enormous. And this is why software companies are being marked down as aggressively as they are. Like, their share price has been kind of one way for the last year, but that is brutal.
He's also saying, I mean, this isn't the area of real concern around CapEx, but if you're spending on AI, markets want to see where it's showing through. And this is a story where it's sort of just showing through everywhere, was, I paraphrase, but one of the lines that he was giving us, it's in everything now. Whereas maybe something like Meta that's able to strip it out and say, we've spent a lot of money, but this is what you're getting for it. Maybe that's it. That's certainly what the Markets Live blog was saying.
They're really buying the dip in ASML, though. That's interesting. It's not fully been bought yesterday. So in terms of the share price over 2 days, we're up by 1.3% at the moment. But we have gapped higher off the lows that we hit towards the back end of the session, but we haven't fully filled that gap yesterday that was created at the back end of the session.
It tells you something about investor sentiment around these big AI plays, doesn't it?
It certainly does. Let's get an investor view. Frédéric Carrier, who's head of investment strategy for the UK and Asia at RBC Wealth Management, joins us on set this morning. Frédéric, very nice to have you with us. Our eyes this morning are very focused on the earnings stories coming out of Europe, and tech is very much a part of that. So maybe let's start there with your views on the technology sector. What we're learning through this earnings season about technology, what's caught your eye?
It is still early to really know what the trends are. Investors are focused on the CapEx story. That seems to be intact. Still a lot of money going into building the infrastructure. The big question, as it was last year, is what sort of returns are companies going to get? And that's where there's still some uncertainty. So there's still a lot of noise, and we're still trying to get a picture. I think it will take some time before the full picture emerges.
Yeah, so in terms of, are you thinking about tech as a sector and investing strategically around different parts of the AI story, or you think it doesn't sound as if it's a big priority for you?
It's not a big priority. For Europe, there's a lot of noise. Well, globally, there's a lot of noise at the moment, and we think it's particularly useful to have a framework and things we can really rely on. And one piece of that framework is Germany, the infrastructure project. That is something news from last year. Implementation is this year. And we spent a lot of time looking at what sort of disbursement we're seeing in Germany. And if we look at the monthly deficit, if we look at the sentiment in the subsectors which are going to be affected by infrastructure, such as transportation, civil engineering, or construction, the sentiment in these subsectors is improving, as is the orders. So we are seeing some disbursement of these funds, often in transportation, building of roads, alterations, all of that can have quite a quick impact on GDP growth.
How does the run-up in metals prices and materials prices factor into that view around infrastructure and the infrastructure play? How do you factor that into your investment view if there's going to be higher pricing, maybe a squeeze on margins, maybe inflation?
So inflation, we have to see. We don't think that inflation is going to be a problem this year. Clearly, it could mean that if this increase in materials prices is factored in for people who use materials as an input, it could mean a squeeze in margin. But in terms of the sectors we are looking at in Europe, those which benefit from the fiscal stimulus, so industrials, materials, defense stocks, even banks, we think are good opportunities.
I'm just trying to understand how we're getting into an environment where we have stimulus and spending and higher metals prices and a massive build-out of AI on infrastructure and defense, and we don't get inflation.
Well, the massive build-out of AI is mostly in the US. That is where utilities prices are really being impacted. There is less evidence of that in Europe.
Okay. But
less evidence compared to the US.
But I invest in Europe, I don't invest in America. If the American economy runs hot, do I want to be part of that, or do I not want to be part of that?
You want to have exposure to the US, that's for sure, yes.
How much? Like, am I downgrading? Am I having less this year than I had last year?
You probably have as much this year as last year, and compared to benchmarks, and you and I have had many conversations about what benchmarks are appropriate, but for each wealth client, with the appropriate benchmark up to his benchmark in the US, up to his benchmark in Europe. We think, or her, of course. We want to be involved, but not beyond benchmark, not take large overweight positions overall in our regions.
Would euro dollar at 120, 122, 125 be a good thing for European equities or a bad thing for European equities? Or does it depend on what investor we're talking about, if I'm an American investor or a European investor?
Well, that is part of the question, but in terms of the euro, you also have to look at not only the euro-dollar exchange rate, but
yuan.
Well, what the other currencies of the other trading partners are doing. And so far this year, where there's been quite an increase in the euro has strengthened against the US dollar, it has weakened against the Norwegian, the Swedish, and even the pound. And therefore, overall, based on this trading basket, the strengthening of the euro has really been marginal. And that extent of a strengthening compared to other trading partners, we don't think is an issue for inflation.
Okay, so we watch the wider basket, not just the US dollar against the euro. Frederic, let's talk about precious metals, because it's been such a theme of 2026 so far. January, incredible gains, certainly in silver, definitely in gold as well. And you have a very eye-catching gold. It's not a target, I don't think, but you have a number for gold that you think we could get to that's way higher than where we are now. Talk us through your rationale.
Way higher, and we have to say that the current price is already higher than what we thought our optimistic scenario for the end of the year was. But we've looked at the length of the last three rallies since the 1970s, and on average, the length was 1,062 days. The longest rally was just under 1,200 days. We are just under 850 days into this rally. So this rally could run for quite a bit more time.
And what does that mean for the price?
Well, we also looked at the number of all-time highs that were achieved last year on a monthly basis. So they were 5 on average every month. This year, in only January, they were 8 or 9. So all of this, if you put all of this together, it suggests to us that the price could reach more than 7,000 by the end of the year if these trends are maintained. And certainly the underlying demand for gold, that remains from central banks.
Do I wait until the party ends and the lights come on? Because gold and silver tend to go down fairly fast when they go down. Or do I get out before the party ends and the party's still going?
The party is still going, so you might want to be involved.
But when do I leave?
Well,
that's the question, because the drawdowns, historical drawdowns in gold and silver are epic.
Yes,
So do I want to keep riding it until?
Well, you want to ride it and try and spot when when the party ends.
But do you want to ride the pure metal, or do you want to ride the basic result, the miners?
Gold and silver, the prices, as opposed to miners.
Okay,
in our view.
But with your lens on the UK, FTSE 100 was well positioned in this environment. I mean, how does the FTSE 100? What is your outlook for the FTSE 100 given what the miners have done?
Again, it's a neutral position. We see the economy as continuing to muddle through, and no big vision in terms of improving things. So, it's a less interesting market in our view. Fewer rich pickings than in other markets.
Okay, Frederic, thank you very much indeed. Nice to see you. Interesting gold targets, Frederic Harrier, Head of Investment Strategy, not targets, sorry, for the UK and Asia at RBC Wealth Management. Okay, there's some really big moves out there. This board will not capture all of them, but it's going to capture some of them. We've got a big kind of drawdown in pharma. ASML is bouncing back, not completely bouncing back. Defence stocks are off today. Luxury is fairly flat. The actions in SAP, the eye-watering moves that we've seen to the downside, catching everybody's attention this morning, Chloe Mellez included. What do we got?
Good morning, Guy. Indeed, it's not a good day for SAP. It's growth in the cloud backlog disappointed investors quite a bit. And so we are down more than 11% as a result. This is obviously a big problem, given that the cloud is so essential to SAP's strategy going forward. And there has been also quite a lot of concerns around the potentially negative impact of AI on those enterprise software companies. And so we are down massively this morning for SAP. We are also seeing downward moves for Deutsche Bank, because it seems that the earnings, strong earnings and also the buyback were not enough to reassure investors over the offices being raided as part of a money laundering investigation just yesterday. And so we are down about 1.5% for Deutsche Bank. Moving on to chips, and there we are in the green. STMicro provided a sales outlook that was ahead of expectations. This is a chip supplier to Tesla, to Apple, and so this is a sign that maybe there's a recovery, a pickup in demand from those consumer electronics customers. And then across the board, we are also seeing positive movements for the rest of that chip sector because that sentiment is still quite positive after ASML's numbers yesterday. Moving on to miners, and there we're also in a positive territory. Gold, silver, copper, all of those are hitting all-time highs because of geopolitical tensions. And then we also have a Glencore and Antofagasta that updated the market with the production reports today. And so these were seen as quite positive. And so we are up quite strongly across the board there for miners. And finally, ABB, which provides equipment for data centers, also is up very strongly after some positive earnings and also a 2 billion euro buyback. And so it is being rewarded quite strongly, up almost 8% for ABB.
Okay, it's really the hardware and software story once again in the spotlight, given SAP and then ABB on the hardware side around the data centers. Chloe Mele, thank you very much indeed. We'll get to banks performing well in the session. Lloyds Banking Group announcing a buyback as prelim. Fourth quarter pre-tax profits beat. We're going to be joined by the CEO of Lloyds Banking Group, Charlie Nunn. That's coming up. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day.
Impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Welcome back. This is the opening trade. Now, Lloyds shares are pretty flat this morning, just a touch to the upside after the company announced plans to buy back a further £1.75 billion of its shares after both its core banking business and newer insurance and wealth products boosted earnings in the fourth quarter. We're joined now by Charlie Nunn, the CEO of Lloyds Banking Group. Charlie, really nice to have you on the programme. Thanks for your time. Let's start with what's going well, because the numbers seem to be ahead of estimates quite substantially for the fourth quarter in terms of pre-tax profits. 4 years into your strategy, I guess you're going to tell me it's delivering. What's the top line? It looks as if we have lost our connection. There you go. Yeah. We have lost our connection to Charlie. We will try and re-establish that. Yeah. But it does look as if and they are 4 years into this. Yeah. They are 4 years into this strategy, and so interested to see how they think it's going right now.
So it's interesting. So end of the strategy. So what's the outlook here? Return on tangible equity, let's call it circa 15 now. Does it get boosted to 16? How much further could they push that? Yeah. You've got the motor financing thing. I think you could put that in the rearview mirror. What happens with the housing story? Yeah. More stable housing market? Does that boost lending? There's a lot to sort of think about what happens next.
Let's try again. Charlie, that didn't go well, so we're going to get another go. Charlie Nunn, the CEO of Lloyds Banking Group. I hope you can hear me this time. So I'm saying it looks as if the numbers have come in better than expectations, and you're 4 years into this strategy. How has it delivered, and what's next?
Thank you, and sorry about that falling off just now. Look, it's been a strong year in 2025, and that's what we're going to talk with our investors later today. We've continued to grow the business, and we saw 5% growth in lending, up 22 billion in the year, 3% growth in deposits. We saw growth in market share in a whole set of our businesses, and that's really core for us as we look to the future, building that momentum. And we saw our other operating income continue to diversify and grow at nearly 10%, 9% up year on year. And that's our 4th year of that kind of growth rate. So good in that context. We're continuing to innovate and really bring new services to our customers across the businesses. And we are very confident in the outlook beyond this year, for this year and beyond. And of course, that's enabled us to increase our dividend 15% and another big buyback.
So, Charlie, your net interest income looks to be in line with estimates. Tell me about the hedge maturity profile and where we are in that, because I know that the full benefits of higher rates, which we have lost recently, but they don't flow through at the time, they flow through over time. And I wonder if you can tell us, therefore, what we should expect, how that profile looks.
Yeah, so one of the key things we've been doing at Lloyds Banking Group is making sure we continue to win trust from customers around current accounts, personal and business, and we've grown market share in those. And what that means is we can have a longer dated structural hedge. And so we've said again, last year we delivered a significant uptick in our structural hedge income, about £1.2 billion. This year we're projecting £1.5 billion. And we're saying again through 27 and into the back end of this decade, we think the structural hedge will continue to be a tailwind for Lloyds Banking Group. So that then alongside growth in the balance sheet and growth in the activity with our customers gives us confidence around the top line growth of the group to be significantly above the rate of growth of the economy.
Return on tangible equity, Charlie, that's going to get better this year than it did last year. Talk to me, which other metrics are going to get better in 2026?
Yeah, so we've had now, since our strategy was announced in 2022, some key guidance. The first one was return on tangible equity, and we're now predicting that will be greater than 16% in 2026. Of course, also our capital generation, we're predicting greater than 200 basis points of capital generation for our shareholders. And then finally, cost-income ratio, so our efficiency, our operating leverage for the group, for our investors, we're saying will be less than 50% by the end of this year. For us, that's really important. It's a staging post, and we can see momentum for all of those metrics beyond this year.
Charlie, just a sort of wider question. What does credit quality look like right now in the UK? It seems to me we've got a reasonably stressed consumer. Is that the reality that you see in terms of your credit books?
So actually, no, we don't see that. We actually see credit quality and the resilience of the consumers at very low levels relative to history. Our outlook for the economy this year is what we'd call a resilient but slow growth economy, going about 1.2% GDP growth. And when you look at our credit quality, last year we only had about 17 basis points. That had some adjustments in the models. But we predict actually that about 25 basis points is our guidance for this year, which is below the long-term run rate. And underpinning that is we're actually seeing that households and businesses in the UK have got the strongest financial position we've seen for a very long time, since before the financial crisis. Higher savings, higher cash flows, less indebtedness, partly based on lower spending and investment, and that's the opportunity to help get confidence back into the economy so we can move to a higher growth trajectory.
Charlie, what's the mortgage market looking right now? Because parts of the real estate market, parts of the property market in the UK are looking soft. I'm thinking of London in particular, but of course rates have come down. What is your outlook in terms of the mortgage part of the business going forward?
Well, first of all, in 2025, we actually saw overall house prices only increase about 0.3%, so quite sluggish in terms of house price growth, but quite a strong mortgage market. We actually did, for example, £17 billion worth of first-time buyer mortgages, and we increased our total mortgage lending by £11 billion in 2025. Look, we think that confidence for consumers to continue to grow the mortgage market this year is still there. We think it'll be about the same kind of scale of market. We think house prices will grow about 2% this year. And obviously what's supporting that is this strong savings and cash position of some households in the UK and a reducing rates environment. We're still thinking rates will come down 2 times this year.
Okay, 2 times, 2 additional cuts in the BOE. Charlie, what are you doing on AI? If I was an investor, I might be asking a question around whether or not companies like Revolut, which has a bigger market valuation than you do right now, about 75 billion in terms of the last numbers, whether or not they're starting to take market share from you and whether or not you're acting quickly enough, you and the team, to embed AI into the product.
Yeah, actually, our market share in dollars is 80 billion. But in terms of AI, look, we've been a leader on AI for a long time. We already have 800 AI live models. We've delivered a lot of the revenue growth, the strategic revenue growth, and the efficiency savings over the last few years using that. And we're very excited about the agentic AI and then digital asset growth we see in front of us and the opportunity to improve how we serve customers. We're going live this year. It's already in customer testing and pilot testing with some agentic AI advice services for customers to help them with investment advice to get more out of their everyday spending. And we think it has the potential to really transform how customers experience our services. And of course, we do see lots of opportunities to improve efficiency and the effectiveness of the group.
Charlie, how much are you spending on AI and how much are you getting back from that spend? What's the return on that spend?
Yeah, so we haven't given the specific investment in AI, but actually most of the areas we're innovating, given that we have the biggest digital bank by far in the UK, growing at by far the highest rate, faster than all of the fintechs, it's a material part of our investment. What we have said again today is in the last few years, we've delivered £1.9 billion worth of cost savings and £1.4 billion worth of revenue growth linked to strategic initiatives. And about 60 to 70% of both of those numbers is driven by our AI and digital investments. So it's really material today, and it's going to continue to be a source of innovation and improvement of our customer services going forward. So we're very excited by it. We are the leader in the UK banks, as proved by surveys like Evident AI, and we intend to keep that leadership position as we go forward.
Okay. Charlie, just briefly, if it's possible, do you think the UK should be concerned about reliance on US payments companies, geopolitics being what it is? I think of Visa, MasterCard, Apple Pay, Google Pay, you know, the list goes on. Is that a structural concern for the UK banking sector, do you think?
I think it's a really good question and one that we obviously think about a lot. Obviously, our domestic UK payments and the majority of payments in the UK don't run on those rails. They run on domestic retail payments rails or intra-bank rails. So we do have some more resilience than is sometimes talked about. But I do think the developments, especially around stablecoins last year, are important. And I think you've heard me talk about before, we're working with the other major banks in the UK to lead on something we call GB tokenized deposits, which is to bring the value of modern technology to our payments infrastructure system-wide. We're looking to try and launch that in the first half of 2027, if we can get the support of the regulators. And we'll bring massive benefits to our customers and will future-proof payments so that the UK can continue to be a leader in payments into the future.
Okay. Really interesting. Really appreciate your time this morning on the back of the earnings. Charlie Nunn, CEO of Lloyds Banking Group. Coming up, Nokia's fourth quarter adjusted profit falling 3%. We'll get to a conversation with the CEO of that company. That's Bloomberg coming up.
And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
This is the opening trade. Happy Thursday. We're 30 minutes into today's session. It is a busy day. You've got the Fed, of course, coming through with the expected pause, but two dissenters, and then the earnings front. And this divergence still in terms of the tech story, hardware versus software. Across the headline basis, you're seeing gains in Europe, 0.5%, a pretty decent response so far this Thursday to the earnings story. Some decent numbers coming through from the banks. Again, a mixed picture on the tech front. The DAX down 0.4%. SAP is a big drag there. Over in France, CAC 40 gaining 0.9%. ST Micro on the other side of the tech story performing well. FTSE 100, basic resources, copper prices, iron ore prices, oil all up. That is lifting that sector. So across the FTSE 100, gains of 0.6%. We're breaking the central bank decision as well from Riksbank, holding at 1.75%. That is the third straight hold for the Riksbank. As expected, keeping rates on hold at 1.75 over in Sweden. Guy.
Let's get back to the equity market and talk about the internals we're seeing within the stock 600. 393 up, 189 down. The balance definitely that we are seeing a more positive picture emerging, but there's some key standouts on the downside that we're watching out for. We'll get to those in just a second. Volume's actually pretty good, unsurprisingly, on such a busy day. There's so much to factor and price in to these markets. Upside, ASML bounces back, but not completely. Yesterday was an amazing round trip for ASML. Stock this morning up by 3.63%. The data center story is working for Asia Brown Boveri, the Swiss-Swedish engineering company, up by 7.71%. The metal story is working for Rio. It is up by 2.53%. Capturing some of the stories we're watching this morning. Downside, SAP off its lows but being battered on the back of the numbers. Nokia is also sharply lower as well. Inferior telecoms equipment company trying to be maybe a data center telecoms company. Nokia down by nearly 6%. And Deutsche Bank on the back of its numbers. And there's a lot of other stories floating around about Deutsche, the raid on its headquarters, the raid on its business, and also what's being said about independent research this morning. Both fascinating stories, but the core number, the stories that we're watching out for, maybe the focus of investors. The stock down 1%, Anna.
Let's get an update on some of the political themes we're covering this morning then, Guy. The UK Prime Minister Keir Starmer is promising to seek a, quote, more sophisticated relationship with China. He met with President Xi earlier today during what is the first trip to China by a British leader in some 8 years. President Trump has warned Iran to make a nuclear deal with the United States or face military strikes even worse than last year's. In a social media post, Trump says the fleet he's ordered to the region, led by an aircraft carrier, is ready to fulfill its mission with, quote, speed and violence if necessary. Iran's UN mission responded on X, warning if pushed, the country will defend itself and respond like never before. NVIDIA CEO Jensen Huang says his company has not yet received any orders from Chinese customers for its H200 AI chips. This as Beijing is still deciding whether to allow imports of the US firm's components. Elsewhere, The Information reports that NVIDIA, alongside Microsoft and Amazon, is in discussions to invest as much as $60 billion in OpenAI as part of a major new funding round. Tom.
Let's get to the telecom story then, with a focus on Nokia. Guy was talking about the pressure on the stock right now. Nokia shares slumping this morning after its fourth quarter earnings. The numbers come as the Finnish mobile equipment maker streamlines its business to focus on AI. We're joined now by Justin Hotard, CEO of Nokia, for an exclusive conversation. Justin, thanks for joining us. What do you think the response is? Why do you think there's a negativity in the market? Is it that this pivot to AI and supplying data centers, well, their connectivity is just taking longer, that the execution is going to be more challenging than maybe you and the team expected?
Well, I think, Tom, first of all, if you look at our results, we're in line, actually slightly above what we said we would do for the fourth quarter of the year. So I'm very pleased with how the team has executed and very pleased with the progress we're making on our transformation. Look, as you know, in the AI world, there's always a lot of different expectations. The reality is we're doing exactly what we said. We're seeing very solid growth in optical networking in particular, 17% on a constant currency basis year over year. And then on the other side, if you look at book-to-bill in both optical networking and IP networking, which are really where we're playing in AI data center today, strong book-to-bill, which shows further demand growth and obviously good growth potential for us.
Is the constraint then less about the demand and more about supply when it comes to your AI pivot? Are you able to meet the demands of your customers?
Yeah, no, I think absolutely. We're first of all, the entire AI data center business right now has constraints, as you know. I mean, there's different dynamics happening. Memory constraints have been talked about a lot over the last few weeks, but there's also there's been other constraints, not just energy, connectivity, silicon. Right, there's a set of things that the industry has been in constraint, which is why I think this is also going to be a much longer and more stable growth trajectory for the industry. But for us, good growth, ongoing demand, it supports what we believe is a solid growth opportunity for us in the market, and I'm pleased with again how we've executed, and pleased with the opportunity ahead for us. Key thing for us is to make sure we're focused on executing for our customers and continue to innovate.
Justin, can I just ask Tom's question in a slightly different way? Are you being conservative around your guidance on the data center front because of execution risk? Are you just having to be conservative at the moment? Investors are looking at this and trying to fathom whether that's the case.
Yeah, Guy, I think first of all, as I've said, I want to make sure we're a company that sets commitments, executes on those commitments, and we're predictable. And what I'm really pleased about over the last couple of quarters is we've set a foundation for doing that. But it's 2 quarters, and as you know, that's not something that implies a trend. So my focus right now is making sure we're continuing to build on the momentum we see in the market. We're guiding 10 to 12% growth in optical and IP switching. As we said, optical is one where we have traction that is further ahead and more mature in the AI and data center market. IP switching is earlier for us. But I want to see us, continue to execute against our commitments and deliver for shareholders. And the story of the last 2 quarters is we've done that, but we've got a lot of work to do to be consistent about doing that. Again, because that's something that takes multiple quarters of consistent execution.
Okay, where is the bulk of the business? Where is the bulk of the business opportunity geographically going forward in the AI data center story?
Yeah, I think the reality today is the bulk of the business is where the data centers are being built, largely in the U.S. and North America. I'm optimistic we'll see continued demand. I mean, you obviously see the news of investments being made in Europe, but largely from some of the major AI and cloud players today, and emerging in Asia as well. So I think today it's still very much in the core AI and cloud players. Sovereign AI, there's a lot of discussion. But it's much earlier, in terms of government-driven sovereign cloud investments. But again, I think that's a play that will come out over time. For us right now, it's making sure we're delivering for the big customers, and then of course supporting all of the geographic opportunity we have, particularly here in Europe.
Justin, good morning to you. I know that you have a partnership with NVIDIA, and we know that NVIDIA has invested in Nokia. I wonder if that partnership, that technology partnership, is delivering what both sides want. What's the experience there?
Yeah, hi, Anna. I'm very pleased with the progress we're making. This is a relationship that has been been in place for a few years, going back to the announcement of the AI RAN Alliance on the radio side, and the work has been ongoing. We shared when we made the announcement in October that we expected to have proof of concepts and trials later this year in 26. We're well on track to do that. Really pleased with the partnership, and very excited about the opportunity. I think there's a lot of recognition from certainly from our two teams that there's more work to do, but tremendous potential, and that as AI moves into physical AI, which is things like autonomous vehicles, augmented reality, robotics, that networks fundamentally need to change, and that includes telecommunication networks if they're going to serve and deliver these types of workloads. So the innovation, the partnership is very strong, and really pleased with how things are progressing.
This is a business that has pivoted many times, Justin, in many decades of history, from paper mills to now data centers via mobile phones, as we remember. Justin, how does the investor pitch go? How receptive are investors to you being part of the data center build out, or is there any expectation that you stick to other areas?
Yeah, look, I think it's very clear that we are a company today that is focused on, our largest customer base is telecommunications operators. Our biggest growth opportunities in AI and cloud. I think investors obviously want to see us move into the growth that's happening in AI and cloud as quickly as possible. There's a lot of support for that thesis, but of course we also have to recognize, and you touched on this, given the pivots, the change, and candidly, the fact that we haven't demonstrated consistent execution in our financial results, that we're a bit of a show me story. And again, that's why we're being disciplined around execution. And I'm really pleased that this quarter, the team did a great job in showing that we were executing as we said we would.
Justin, does that pivot mean that you might be putting assets up for sale in terms of the legacy part of the business?
Well, one thing we did announce, Tom, in November is that we have a set of assets in portfolio businesses. These are assets that are good businesses, but they don't fit with our capital allocation priorities. In some cases, they're not at a scale that will meaningfully impact our portfolio. And so those are things where we're looking for the right outcome for those businesses. And in some cases, it might be a different owner of those businesses. But they're also very good businesses. They have important customer bases. And so we're not, in many cases, not exiting those businesses or winding them down. But we are looking at whether there's a different owner. And so as you look at the business now and effective January 1, what you will see, as you look at Q1, is us reporting in network infrastructure and mobile infrastructure, and then an incubation business in defense. And those are really the three platforms we see for long-term growth and where we're deploying capital against those opportunities.
Justin, great to catch up. Thank you very much indeed for the time this morning. Really appreciate it. It's Justin Hotard, the CEO of Nokia. Stocks down circa 6% as we speak. Let's turn our attention back to one of the other narratives that we are watching so carefully this morning. Commodities absolutely on a tear this morning. The record-breaking rally getting fresh momentum. Gold is up, silver's up, copper's up. Fresh record highs for many of these metals. Let's go to Martin Ritchie in Shanghai to talk about this. Let's start with copper, Martin. Who is buying all of this copper at this price?
A very good question, and it comes after a really extraordinary month for trading in metals. I feel as if I've been on TV every day talking about the markets, which shows you how special January's been. What we've seen over the past month is a sort of wave of trading activity in China, and we've seen record volumes passing through the Shanghai Futures Exchange. A lot of big funds getting very bullish on copper in particular, on aluminum as well, pushing those prices to a record high. And today it seems to have culminated in this extraordinary spike that's kind of fed across to the London Metal Exchange. 8% up for copper. It's the biggest rise since 2009 in one day, so it's a pretty extraordinary day. And this rise in sharp rise in prices is bad news for anyone, as you hinted at, buying copper, especially since downstream demand in China is not particularly strong at the moment. So there's this very strange discrepancy between very bullish momentum, kind of driven by macro factors, the debasement trade, weaker dollar, everything else, and the kind of conditions on the ground in China. How that resolves itself remains to be seen.
Martin, yes, absolutely. So a lot of focus on whether the Chinese demand will still be there at these prices. Let's move to another metal where we're also seeing incredible moves in the month of January, and that is gold. I'm seeing more and more references, though, to a gamma squeeze, to a short squeeze on gold. So how do you get under the hood of what it is exactly that's driving gold and silver higher?
So gold's gains have been so big that I think it's starting to change the kind of market dynamics and participation a little bit. You know, at these kind of levels, it's a bit more risky for banks or the traditional big players in the gold market to really trade, and that creates thinner trade, thinner liquidity, which tends to mean more volatility. And as you said, you were referring there to the gamma squeeze, where some dealers are selling, have to sell options, so they're buying into the futures market, which is in a illiquid market that's sending up the prices of gold even higher. Again, it's been extraordinary gains for gold. It's way past even levels that I think most bullish analysts saw at the beginning of this year. So it depends on how those the kind of sort of stranger outlying dynamics kind of calm down in the next few days.
Martin, thank you very much. I think it's going to become a market indicator for higher energy prices or other metals prices and inflation. How many times in a month Martin Ritchie is on TV? And in January, that's been many times. So we thank you very much, Martin. Maybe we'll see you tomorrow. Who knows? We'll see what happens in these markets. But it is increasingly a focus, incredible volatility. And it's really interesting, the line he said there about how banks, their balance sheets are constrained to the extent they're able to get involved in these markets right now, such as the volatility that we're seeing in some of these metals.
Are we getting to the squeezy phase, though? Is this kind of... Is this gold? Maybe is a different story, but the copper story I think is fascinating. If the underlying story is not there, is this how much more sustainable could this story be, and what happens when it comes to an end? The gamma works also in the gold. The gamma works both ways, and can work on the downside very, very sharply as well.
What I'm really enjoying about the news flow today is that you can join the dots between what's happening in metals, what's happening in tech, and what happens with the Fed decision as well. You do not get someone like Elon Musk committing to spend $20 billion on CapEx, double the estimates, and particularly on a foundry to make chips, if you don't think that there is, number one, the demand, but also question marks about how you feel the reason he's building a foundry is because he can't get the chips.
But that industry is so cyclical.
All of these metals.
That's so cyclical, that industry. Are we going to get an overbuild? Do we end up with a situation in a year? Precisely.
Yeah.
Again, so how do you hedge for that?
Precisely. Timing around this is insane.
And at the moment, it's amazing that a lot of the constraints on this incredible technology, AI, are very much real-world ones. Can you get the builders to build the data centers? Can you get all the metals at the prices you can afford to build the chips? So, yeah.
And the Nokia CEO telling us that on optical, on energy, on chips, on the labour force, all of those things are constraints right now.
It's amazing. He's basically saying the guidance is constrained because I don't know around all those issues how it's going to work.
So how can you price and how can you build cars cheaply? Here's the pivot. Coming up, Stellantis slashing prices for Fiat, Opel and Peugeot models in France, despite all these higher input costs. What is the car maker's new offer then on the Fiat Pandina model? Take a guess. We're going to give you the answer when we come back. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to the minute global news whenever and wherever it happens. I'm Anne-Marie Hordern in Davos, Switzerland, and this is Bloomberg.
Before the break, we asked you at what price is Stellantis offering some Fiat Pandina models in France? Well, the answer is, drumroll, €9,990. Just a snip under 10,000, of course, for the 1-litre engine hybrid city car. Our floor manager, Sean, expect, what did you say, Sean, 15 to 20,000? 15 to 20,000? So it's below 10,000. Sean got it wrong. Deflation in car prices is real. The automaker is slashing prices for its Fiat, Opel, I think that meant to be Opel, not Open, and Peugeot models in France in a bid to increase production volumes and stabilise the performance of key brands after dramatic market share declines in recent years. I can see, can I see Guy in a Fiat Pandina?
So I have to say, the old Fiat Panda, the really boxy the 4x4 version, was the most amazing car. You could go anywhere in that thing. It was a big pejorative here, a tin can on wheels, but it would go anywhere.
It was from what decade? They were all tin cans on wheels, weren't they? So I don't think it's pejorative.
No, but it would go. That thing would go absolutely anywhere. So this thing's got big shoes to fill, is what I will say.
Apparently it's supposed to be pocket-sized. The price, yes, you're right, the prices are coming down. I mean, this is Chinese competition, isn't it? This is where a lot of the research said that people wanted cheaper cars at the lower end. And
why does it look like? Why is it? It looks like it's meant to go off-road, but you said it was a city car.
I'm not sure I'd take that off-road.
Yeah, I don't know. It is very small. It's supposed to be a city car.
Yeah.
Let's tell you what else is coming up on your day ahead. The UK Prime Minister is in China. That's in the rearview mirror and looking ahead because he's still there and he stays there for a little while. EU Foreign Affairs Council, that's meeting in Brussels. US earnings. We have MasterCard and Apple and Visa still to come. So a sort of payments and tech theme coming. 1:30 p.m. UK time, we get US data, including initial jobless claims and trade balance. The focus has not really been on the data of late, has it? It's been in other areas of the market.
Yeah, the Fed was a non-event. I can't quite. If Valerie Titel is watching, I apologise. Okay, so I'm really sorry. But the Fed was a bit of a non-event last night. I think Powell actually wanted it to be. So that's not the story. Was Skylar Montgomery Koenig excited by the Fed last night?
I mean, not particularly.
Okay,
it was
fine.
largely
So
as expected.
Let's just move on from that. What's happening in gold and the ratios? Everything's just bonkers.
Yeah, well, I had someone send me the gold-silver ratio the other day, and it's at a multi-year low. It's so low. And it's interesting because this is something that we used to look like as a signal for the economy, as in silver has more industrial uses, and so as that ratio declines, it's because the economy is doing better, whereas gold is the more safe safe haven. And I'd say, yes, that could be what's happening now, is in the economy is quite strong. You're having stuff like copper bid up. It could also be speculation in that you have very different market sizes. So gold is bigger than silver by a significant amount. So if you have that speculation flow into silver in the same amount, it's much more impactful on the silver market. And so, I definitely don't think it's one where you're looking for a reversal. And especially with gold, you're starting to look at levels on an RSI basis, for example, that look very stretched. But I'm also not sure that there aren't dip buyers still.
I remember a world where this used to tell you something about the real economy. I'm not sure whether silver up 65% year to date tells us anything sensible about anywhere.
Maybe, or it tells you that people are really worried. Are people fleeing for the sort of safe haven? Are they worried about the dollar? Is this a kind of structural shift that we're seeing in the global economy?
So Scott Bessent came out and tried to play the grown-up in the room again, tried to play the comforter for the markets and said, we do back a
Are you saying his boss isn't the grown-up?
I'll leave that with you. We do support a strong dollar. Was that the most interesting comment from the Treasury Secretary, or was it his comment about not intervening to support the yen?
I mean, it's not intervening, right? As in, that's what changes the story around the dollar significantly, and particularly with respect to the yen, is markets got all excited last Friday because you had that rate check out of the U.S., and so the question became, will the U.S. be selling dollars? And there's no limit to the amount of depreciation you could get there, right? It's not like Japanese authorities. There's no limit on how many dollars you have to sell. So you could get significant downside. The question is just why now? It could be because you have GGB yields that are rising and that's pushed up U.S. yields, but you'd probably just want stability in that case rather than a huge amount of dollar downside. So I don't think it's particularly concerning going forward. I think it's something that will probably move on from now. But, if it was a real possibility, it would be impactful.
It seems that the US is doing a lot to weaken the dollar anyway.
Yeah.
So would this be a time, you could lean into it, I suppose, with intervention, but from that perspective, you wonder whether intervention would need to be the thing to do. What's the focus from here then, Skylar? The day ahead, just went through some of the things on the agenda. There's some data, but it's not, what do we look ahead to? What gets us excited? We're getting into earnings season, which might deliver some clarity.
Yeah, I think the earnings season so far is still pointing to relatively strong earnings, relatively strong growth. For me, the question I'm really trying to grapple is, will we return to fundamentals as a driver of markets? So like the dollar, for example, the move we saw on Tuesday, yes, you eventually got a catalyst later in the day in Donald Trump's comments, but there wasn't a catalyst, as in it's detached from fundamentals. If you look at euro-dollar versus rate differentials, you're now seeing a move apart, and you've had the economy hold up, rate expectations pushed out, so there's not a cut expected until July, and at the same time, you haven't seen this mass selling or underperformance of U.S. assets, particularly since the dollar's decline. And so the question is, if you don't really know what the fundamental reason for the dollar decline is, how do you know what's going to stop it?
But haven't we been through large periods where you look at interest rates and they haven't told you much? I remember large periods of time when that wasn't the case. So what is the market trading on?
Well, this is what the worry is. You don't know really what it is. It could be hedge ratios adjusting. So that's what we saw last year, and that implies a level adjustment lower in the dollar. It could be speculation, and that makes me a little bit more worried because it'll be stickier. And even if you have positive dollar drivers, they probably have to be quite big to see a move. But it makes it harder for investors, right? Because if you're so detached from fundamentals, what do you use as your guidepost?
Okay, Bloomberg, Skylar Montgomery-Koenig, thank you very much indeed. The gains in Europe have actually come off slightly, still up 0.3%, but it had been a stronger start to the session.
Yeah, absolutely. We're still seeing, in terms of the sector breakdown, basic resources still flying. That's still really the story. Energy stocks also firmer.
SAP is amazing.
SAP to the downside. The fog has cleared in London. That's it for the opening trade. The Pulse is next.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The world's biggest tech firms showed no signs of easing up on AI spending, with Meta revealing ambitions to spend as much as $135 billion this year. Well, cautious optimism from the Fed as Jay Powell talks of clear improvement in the U.S. outlook after keeping rates on hold. Chris Waller, who hopes to replace Powell, calls for a cut. Plus, the Chinese President Xi Jinping praises the British Prime Minister on his landmark visit to Beijing and vows to consider granting UK citizens visa-free entry. So there is quite a lot going on in the markets. Let's look exactly at what's moving the markets. I would point to gold. That was my first go-to thing that we talked about this morning. Well, gold at $5,500. We've seen this rally in miners powered by the surging metal prices is really pretty striking. I was looking at this year. If you look at the sub-index, for example, up by 19%. Silver was up by 2/3 in the last year. And then we have, of course, some good optimistic news out of AI. S&P futures getting some 0.2%. The U.S. 10-year 4.2617, actually 1.2. And this is a picture for European markets. Now, overall, let's see if what we started in the U.S. in terms of that exuberance can also come through to European markets. We're seeing a lift for the UK, the FTSE and the CAC 40, but you can see, for example, SAP, we talked to the chief executive, down some 11.3%. Let's also have a look at pre-market, some of the U.S. tech. We had a lot of news out of Tesla, spending about $20 billion to try and really up their robotics and AI game. Meta Platforms, big spenders in AI, 7.5% higher, but Microsoft down 5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Another busy agenda, a weaker dollar, mixed signals from big tech, but let's begin with the Fed. The window is closing for Jay Powell to deliver another rate cut before his term ends after the committee voted to hold despite pressure from the U.S. president. Now, Powell emphasized the decision was supported by most of the FOMC, but without the backing of Governor Stephen Miller and Chris Waller, who are two contenders, actually, to succeed Powell.
There was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but the committee pretty broadly for holding today.
Well, with us now, Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management, and Giulia Pellegrini, Emerging Markets Portfolio Manager at Allianz Global Investors. I mean, it's a big day for the market. So we have the Fed that we need to talk about, and then gold just on a tear. What was your main key takeaway from the Fed, Kim?
I think it's just that the risks are much more balanced now. So growth is perfectly fine in the US. The consumer, it is a K-shaped economy, but overall the consumer is stable. They are going to get higher than usual tax refunds coming into their pockets. So that's going to keep the consumer going strong. And then on the corporate front, what we're seeing in earnings, guidance, balance sheets, they're still fine now after having digested that tariff and policy uncertainty from last year. And then the labor market, we're now seeing signs of stabilization. So I would say it's still squishy in parts, but overall, you're seeing some stabilization. Those significant downside risks that we were talking about last year, they've dissipated, and that just makes further cuts from the Fed less pressing.
I mean, I guess a couple of questions maybe on inflation further down the line, but that's maybe a story for the beginning of the second quarter. How do you see this impacting emerging markets? It's really a dollar story.
It is, and it's a very positive backdrop for emerging markets. We just heard solid U.S. economy from both Kim and Powell, and overall a weaker dollar, which is a real tailwind for emerging markets. We've got some of our main currencies from the Brazil real all the way to the South African rand, up to 4 to 5% year to date. So it's a very, very positive backdrop for us.
Yeah, I mean, how much further can the dollar actually weaken? And again, it kind of changes everything. Many investors are surprised that the president says it's fine with that.
Yeah, we think the dollar can still tactically weaken a little more from here, just given what market positioning is like and a bit of that tailwinds behind the hedge America narrative going on. But ultimately, we just don't see it running away because the fundamentals in the U.S. are still strong, and we could also see a bit of an upswing going into the midterm elections.
Are there any particular emerging markets, Juliana, that you like more than others?
Sure, I mentioned some of them just now. We're still very positive from Brazil all the way to South Africa. We're also looking into Colombia more interestingly. There's a number of them that basically will use dollar strength to really use that policy room to maneuver at home. So central banks in emerging markets will have the space to cut rates some more. This is good news for local bonds. But it's also good news for FX because with a weaker dollar, you are less concerned about financial stability considerations. So all in all, the EM local complex is still the one we look at most favorably this year.
I mean, do you have to pull away the tariff threats for some of these emerging markets, or is it just because they've gone through some of the structural reforms?
Well, it's a bit of both. We'll obviously be watching for new tariff threats. Those are always something to keep a close eye on. But what we're seeing last year is that most of these markets have weathered that kind of storm, and they're ready to negotiate. And Trump has shown some willingness to also negotiate. At the same time, these are markets that, as you said, have been doing their homework. They've been improving their fundamentals. Their policy making is a lot more credible. They've got space to use those policy tools as well, and that's very important in a more uncertain macro environment.
I'll ask you about China in a second, but overall, I mean, gold. What's gold at the moment? It's like 5,500. I mean, I guess it's difficult to stay away from it.
Yeah, I think, and this goes to the is it a sell America or hedge America conversation, I think. So I think there is some discontent, some dissatisfaction on U.S. policy. Some diversification is being embraced. But I think ultimately clients still look at the breadth, the depth, the size of the U.S. Treasury market, and they still want to be there.
Kim, what do you think the biggest story is over the next couple of quarters? And I know it's a very volatile environment. Things can change very quickly. But is it really some of that inflationary pressure maybe coming back? Is it the labor market that could weaken because of AI? Or is it steady as they go until the end of the year?
Yeah, I think, it's a question of whether we still have that path to 1 or 2 more Fed cuts this year, which the market is pricing. And I think that path to that, like you said, is disinflation later on this year with maybe a new Fed chair as well. So if I look at inflation, growth is fine, but I think disinflation can continue at the same time. They don't have to be mutually exclusive. There are disinflation in the pipeline, say from rental, from tariff goods inflation peaking. You're in a K-shaped economy as well, which
which then limits how much corporate pricing power there actually is. And then layer on that AI story. And our view is that if growth is driven by an AI boost, you're coming with productivity gains, you're doing more with less. So the labor market can still rebalance, and you still see that downward pressure on wage growth while growth remains elevated.
Is there a danger that actually the labor market is disrupted quite significantly in the U.S. because of AI, and the Fed would have to do something about it?
Yeah, so the dual mandate is inflation, it is the labor market. I would say for now we are seeing stabilization rather than something more significant. But the Fed is going to be aware of that, and I think that's why bonds are still a good thing to have in your portfolio as a diversifier, just in case.
Julia, talk to me a little bit about China. I mean, China has been, diversifying a lot of their overseas investments. Where's that money flowing into?
Sure, that's a very interesting trend. We've seen it last year. We're seeing it picking up steam now. So what China is doing is looking at more interesting yields abroad, a more interesting pipeline of issuance abroad, and looking at jurisdictions that offer good quality credit and interesting yield pickup. And that's your Middle East credits, but that's also some of Eastern Europe and Central Asia. So they've been sending more flows abroad to these jurisdictions, which is something that is very interesting to see. The broad story of flows to the EM continues to be very positive. We saw last year an interesting turnaround after 150-odd billion of cumulative outflows from 2022 to 2024. Last year, we picked up about 31 billion of inflows. And the prospects are very good for this year, not just from China, but also because, as you know, flows typically follow returns. And last year, returns in EM were incredibly enticing.
Could it be wobblier this year?
Well, what we're expecting this year is essentially a repeat of 2025, but with more modest return numbers. Last year, if you think about it, local currency return 19%. It's going to be a bit hard to beat, but we're still looking at high single-digit returns for the hard currency component and low double-digit returns for the local currency component, which we prefer, as I said. So it's still going to likely be a very positive year for emerging markets. Most of the concerns we have are really exogenous in nature. They go back to the EM markets, actually.
And to that, do you see the rest of the world or parts of the world importing deflation from China? Because it's not really coming to Europe to the extent that maybe we thought it could have been.
It is indeed the case. We haven't seen it in European numbers. It is a possibility that we'll see it coming through more across the rest of the world. Again, there's still something to be confirmed in the numbers ahead. It is true that China has been actively rerouting its trade away through Asian countries, but also to jurisdictions that it has been trading on for a while, Latin, Africa, etc., and it's boosting those ties. So I think it's a trend to be confirmed, but it's one that we need to watch.
And Kim, how does that, then factor into your thinking of U.S., for example, versus European assets?
Yeah, so you mentioned that we aren't seeing as much of that disinflationary pressure into Europe via China. Agree, it's been a case of that diversion in volume from Trump 1.0. It's continuing, but we're watching, of course, the currency as well. We can't escape that now with the dollar weakening and the euro strengthening against it. We've heard a bit from the ECB officials yesterday. For us, I think two caveats to that. Yes, when the euro is strengthening versus the dollar, imported prices do fall, right? Your raw materials, your energy, your consumer goods does put downward pressure on European inflation. But at the same time, you are in a period where there is a cyclical uplift in Europe, right? Financial conditions are easing as well. So I think that downward impact is going to be dampened to some extent. And also, if you look at the trade weighted index, it's actually completely flat on the year and pretty much flat to where the ECB last put out their inflation forecasts. So it's a bit of a push and pull. I don't think it's a big enough change at the moment to really matter.
I know the ECB is always at pains to say that, look, they're data dependent, depends on a case by case. But is it impossible to say whether the next move that could be really further along 2026 is a cut or a hike?
Yeah, so I think actually 2026 pricing looks really attractive from an asymmetric point of view. So the market's pricing nothing. And if the ECB were to do something, it would be to cut and not hike. And that comes from someone who's quite optimistic on fiscal delivery in Europe as well. I think that's just enough spare capacity in the economy in Europe to absorb that new spending while the momentum continues to build this year. But, the next inflation print that we're going to get in a week's time is going to see that headline inflation really fall close to that 1.5% that the ECB has told us that they're willing to tolerate and undershoot in. But I do think there is still a question mark, forecasting 1.5% inflation and saying it's fine versus seeing the whites of eyes of it. question mark whether the reaction function does change when we get there.
And Kim, on the UK, are they starting to, I mean, there's quite a lot of nervousness actually amongst investors on if the Prime Minister gets replaced, if these elections don't go well, local elections. But is that being felt in the markets yet?
I think we've seen a bit of that in the last week. So I think the fundamentals haven't changed in the UK, but that who's next risk premium is slowly starting to build. And we've seen gilts underperform the likes of Germany. But for us, we're still confident that the bank is going to cut 1 to 2 times, more than the 1 to 2 times that the market is pricing. So you've seen a bit of stabilization in the labor market, just like in the US. But unlike the US, UK is fiscally constrained this year. So that limits how much the labor market can really improve. And we think that's going to slowly weaken alongside wage growth and bring inflation down. But to your point, markets don't like uncertainty. They certainly don't like political uncertainty. And we think that risk premium is going to build a little bit more.
And Julia, I mean, you were mentioning, you like, for example, Brazil, South Africa, Peru, Romania, and Turkey. I mean, some of them, it's also looking at frontier markets and some of the emerging markets. But are you expecting, I don't know how trade comes into all of this. Like, we've seen 2 big accords, that have been years in the making, one with India, the other one, of course, with Mercosur. Is this really a kind of like, trying to, I guess, hedge against the Trump administration and what they're trying to do? And so do you expect more acceleration?
Sure, there's certainly an element of that, and we're seeing this as a very positive thing, an attempt to diversification. At the moment, we're seeing it as signaling, though, because some of this will take time to pay out. It'll take time for European parliaments, local parliaments to ratify some of these deals and to then really kick in. So we're positive for the long term. Markets react to the short term, obviously, and what we're looking at is still a very positive backdrop for EM, both in terms of local fundamentals, global fundamentals as the growth story goes, and some pockets of interesting political events that you'll see: Colombian elections, Hungary elections, Brazil elections, that we don't see as concerning, rather as an opportunity for active managers like us to eke out local alpha, because these will be local alpha drivers that will give us an opportunity to position.
So interesting. Thank you both for joining us. Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management, and Julia Pellegrini, Emerging Markets Portfolio Manager at Allianz Global Investors. Now, coming up, Tesla shifting gears, unveiling plans for a massive spending spree to build Elon Musk's AI vision. We'll discuss what was announced in that earnings call next, and this is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, Deutsche Bank says a surprise raid on the company's headquarters as part of a money laundering probe will not stop the company from achieving its goals. It comes after a bank, or the bank, reported a record year for profit. Well, James von Moltke, the chief financial officer, spoke to Bloomberg about the broader financial landscape and the impact of geopolitics on AI.
There's remarkable strength across risk assets around the world. As you say, some of the paradigms that we're used to, strong dollar and risk-off situations, allocations of capital around the world, including to the United States, of significant amounts, and then growth paradigms that we got used to. Those things are all changing in a world of uncertainties around the geopolitical alignments, the impact of AI, still a high degree of liquidity. So investors, I think, are reacting to some of those paradigm changes. For us, obviously, we're positioned, I think, to help in reallocations to Europe as they take place. We're very focused on acting as a gateway to opportunities to invest in Europe, and obviously helping Europe to finance all of the investments that are needed here, whether that's, again, AI, defense, infrastructure, digital transition, also the sustainable transition. These are all things that are still going on and where Europe will require immense capital investments.
And I think probably saying sell America slightly overstates what's going on, but there's been, different kind of characterizations of trying to describe what's happening. There's one that's sort of quietly quitting America, i.e., diversifying away. Are you seeing that represented in Europe? Are you seeing clients moving more, or is that not?
I'm not sure I'd use those words, but I mean, more thought given to, for example, if you're a non-dollar investor, do you hedge your dollar positions? You're going to be invested in the United States for sure, but do you need to hedge the currency? That is a question. Seeking growth outside the United States. There has sometimes been valuation differentials for companies in similar circumstances between the United States and outside. So there's, put it this way, looking for value, but it doesn't mean instead of the United States as an investment destination.
James von Moltke there, the Deutsche Bank chief financial officer, speaking to our Oliver Crook. Now, in U.S. tech earnings, social media giant Meta posted record sales and a strong forecast. But it's a different tale for the world's largest software maker, Microsoft, with concern that the company's AI investments could take longer to pay off. Well, Neil Campling, Bloomberg's senior strategist, joins us now. Neil, thank you so much for joining us. So, two different stories from Meta and Microsoft.
Yeah, absolutely. And I think this is the key here for AI spending is very much a case of investors are looking for proof of ROI. Where is the proof of returns on investment from all of that AI CapEx spend? So as far as Meta's concerned, the key thing is that the core business is accelerating and delivering growth above expectations. In the case of Microsoft, the key business being Azure, headline numbers were up 38% in constant currency, which matched buy-side estimates, but did come in above estimates, and that's the key issue. And at the same time, is posting 66% CapEx growth. So all of that AI spending, yet isn't delivering that accelerating growth and better than expected numbers. And that's the key differential here. And then on Meta's conference call, they were very clear that they were talking up that they are delivering better results on the core business thanks to the returns that they're seeing from all of that AI CapEx. So investors want to see in tech earnings the accelerating growth. Yep. They want to see the better top line numbers, and that is the key to delivering that better ROI for the AI CapEx.
Neil, Apple earnings are out a little bit later. If you look at SAP, they were pretty strong actually, but they weren't pretty strong because the share price is being slammed. So what do they tell us?
So for SAP, again, being a bellwether tech company in Europe, the key thing, going back to that same question of growth and delivering on that growth dynamic. Now, they made the mortal sin, if you like, on the release of saying that they see a deceleration of growth from on their cloud backlog. Cloud backlog is really a key KPI, if you like, and they delivered 16% in 4Q, and they are predicting that will decelerate in the next 12 months. And investors don't want to hear that word deceleration. And for SAP, they are obviously in the software vertical, And what we've seen from tech investors, I think, is for many ways, software has been the funding short, if you like, to invest in semiconductors and the hardware of AI. And so to date, AI has been spending on the CapEx and the hardware, and really we're not seeing that translate into software spend yet. And that's the problem that SAP face currently. And you can see that from the share price performance, not just today, but actually for the last 12 months when the stock has been under pressure.
Neil, thanks so much. Neil Campling there, Bloomberg's senior strategist. Now, Tesla chief executive Elon Musk has announced a $20 billion spending spree to build factories for robotics and AI manufacturing. In a bid to support production expansion, the company also says it plans to discontinue the Model S and X vehicles. Well, let's bring in Craig Trudell, Bloomberg's global autos editor. Craig, I mean, this was a huge deal, right? This is kind of, taking away from the Tesla that we know to really try and create the vision of Elon Musk of what he sees the future of AI.
Yeah, and we've been talking about that vision and this sort of reorienting the company from, quote unquote, just a car maker to something much more, right? And yet in actual sort of practice, what the company has done in terms of CapEx has been, to not spend all that aggressively. They've been fairly conservative. So for them to come out and say, we're going to more than double CapEx, from one year to the next, and almost, spend twice as much as what Wall Street was expecting, that was something that really caught everybody's attention last night.
So is it all about robotics? And are they, I don't know, I mean, is it, winner takes all or first mover advantage, or are they still in the game?
I think it's AI compute infrastructure, absolutely, but I think it's also, some of this is going to go to semi-truck production, which they've, talked about for years bringing to market. They're finally, for real, going to do it this time. You've got the cyber cab, you've got those humanoid robots that we've been talking about for years now. Some old going away. You mentioned the S and X falling by the wayside. It's funny, all the way back in 2019, Elon was talking about the only reason they were continuing to make these were for sentimental reasons. Well, I guess, sentiment is, running short there. So we'll see those phase out in the months to come.
Craig, how do you think, I mean, I remember having a conversation, maybe 10 years ago with Carlos Ghosn, of all people, and he was saying you have to be careful because, at the moment, cars are cars, and in the future, you don't know who will build cars because it could be software companies, I guess now it could be AI companies, and at the time, everything seems so far away. But what do you think is the future of Tesla and just cars, manufacturers?
It's a great question because, everybody was sort of braced for Apple being that company that was going to get into the car space. We saw that it turns out it's really hard to make these very complex products at high volumes. But we've seen Xiaomi come in and absolutely do what everybody thought Apple was going to do. And yet, this is a very low margin, highly competitive, very sort of up and down business. And I think Elon Musk wants out of that. He wants into what is going to grow, and that's all these opportunities tied to AI, especially at this moment where everybody, of course, is competing to tell a bigger, brighter story about what AI is going to deliver in the future.
I mean, do these big tech? I mean, I don't know whether now Elon Musk is like a big tech bro, but is his future is his vision different to everyone else's also because of SpaceX?
I think he is in keeping with his sort of long-term pattern, just willing to go much further in terms of just how dramatic a change he's going to deliver. He's increasingly been talking about his humanoid robots, providing the best healthcare and not just universal basic income, but universal high income, really lofty stuff. So for him to be talking about that. Even as his sort of core business of making and selling cars is shrinking, there is a question of how much is that sort of papering over the weakness and what actually is how Tesla makes its money today.
So interesting. Craig, thank you so much. Craig Trudell, they're a Bloomberg Global Autos editor. Coming up, we'll discuss the state of the UK economy and what it means for the banking landscape. But that's with Tina Lee, Citi's UK chief executive. She's coming on next, and this is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The world's biggest tech firms showed no signs of easing up on AI spending, with Meta revealing ambitions to spend as much as $135 billion this year. Cautious optimism from the Fed as Jay Powell talks of clear improvement in the U.S. outlook after keeping rates on hold. Chris Waller, who hopes to replace Powell, calls for a cut. Plus, Chinese President Xi Jinping praises the British Prime Minister on his landmark visit to Beijing and vows to consider granting UK citizens visa-free entry. Now, as we're saying, the Chinese President Xi Jinping says the country's relations with the UK have suffered from what he calls twists and turns that didn't serve either nation. Now, the British Prime Minister, Keir Starmer, is on an important economic and political visit to Beijing, trying to build relations with China, boosting the UK economy without damaging links to the President Trump. Now, let's discuss all of this, what it means for the UK banking sector and deal pipeline with Tina Lee, Citi UK's chief executive. Tina, thank you so much for joining us. Look, we're now post-UK budget. Have you started to see any confidence actually returning amongst clients now that that uncertainty has passed?
Absolutely. When I sort of think about the deal pipeline really for 2026, it's the strongest that we've seen now for quite a number of years. And actually, when you think about some of the tailwinds that we've seen and certainly the conversations that we're having in the boardrooms, there's a real desire to do business. Right. And most importantly, to deliver growth for shareholders. So if companies can't deliver growth for shareholders organically, then they're going to need to do it inorganically. So that obviously means that the pipeline for UK M&A certainly looks much better than it's done versus previous years.
And again, why do you think that? Is it because they've been holding off for too long, because valuations have come down, or they just see a changing world and they want to be part of it?
Number one, it's absolutely a changing world, but also actually, if you think about just some of the tailwinds that we've been experiencing with the UK economy, actually, number one, UK PLC's balance sheets are robust, so primed for growth. Second of all, we've obviously got an easy monetary policy, which is coming down, another couple of interest rate cuts this year. Inflation's moving to that sort of 2% target, probably by the end of this year. And at the same time, what that means is that it does give actually a positive tailwind in order to actually do business. And don't forget, a lot of UK PLC are multinationals. So what that means is, how do you drive those trade corridors, not just in places like North America, which is impossible to ignore, but also in other jurisdictions, whether that be China on the back of the forthcoming UK-India trade deal, or indeed in the Middle East.
I mean, it's quite difficult to get numbers of either people having left the UK after budget or tax reasons, and people coming into the UK from maybe the US because they want to get away from some of the policies. I mean, what's your feeling on how that's going?
Look, the ultra-high net worth sector is always globally mobile. So what that means is for Citi, of course, we have locations all the way around the world. So yes, we have seen some high net worth individuals leave, but to your point, we've also seen some come, particularly from the US.
With the dollar, tanking and possibly dollar assets becoming less attractive, are you seeing more demand for sterling assets?
Well, actually, what I would say is there's still demand for US dollar assets. Okay. So that will continue, and we believe that will continue throughout 2026. Where we've seen companies really begin to think about, their supply chains, for example, how do you de-risk supply chains in what is a bit more of an uncertain world, whether that's through friendshoring or dual shoring, that really is the way in which UK PLC is sort of thinking over the medium term, rather than just responding on a day-to-day basis to the news flow.
When you look at, for example, some of the funding for M&A, does that change? Is it still in dollar assets, or could it be, sterling buyout debt?
It can be both. When we think about the amount of dry powder that private equity has, we estimate it's something like $2.5 to $3 trillion ready to be put to work. So there is actually a lot of liquidity in the market, not only for US dollar assets, but for assets more broadly.
What does the pipeline look like for Citi this year in terms of M&A?
It's looking really good, actually. Again, off the back of what has been a tremendous capital markets issuance calendar. The volumes have been off the charts. But what that does is it just means that markets are open for business. We've got credit spreads at all-time tights, and it means that the appetite for investors in terms of really looking at these types of opportunities is really great. So, it's all about finding the right opportunities for UK PLC, but boardrooms are definitely focused on this topic.
Do you think we just need a big IPO to kind of, help the story along?
Yeah, they're coming. They're coming.
Is there
so when one thinks about what happened last year, we saw in the UK about £2 billion worth of IPOs. That was up about 2.5 times from the prior year. And actually this year we do see, for example, whether it's private equity looking to IPO, some of their companies that they've held for 7 or 10 years. But there's absolutely a pipeline of IPOs coming down the pipe. It's going to be an exciting year.
And any particular sectors that you're most excited about?
Tech, healthcare, consumer, fintech. There's a lot of sectors. So when we think about growth and we think about the pipeline, I think what's quite unique is that actually that growth is coming cross-sector.
Is AI impacting your lending strategy at all?
Lending strategy?
Not, or actually your operations, because we're trying to figure out how banks are looking at this.
That's right. So look, AI is at the heart of Citi's modernisation, but it really cuts across everything. So when we think about how we're embedding AI into how we serve our clients, how we empower our people, and also how we improve processes. So the most important thing is the human in the loop. So it doesn't mean that we do not need humans. And what we strongly believe is that when we think about ideas and we think about creativity for our clients, that value is being brought by our people. AI at the end of the day is a tool. It's an incredible tool, but it is just a tool.
And will that change with years, or is that? I guess there's a lot of people that are worried about their jobs in the future. Is this something that you're conscious and over-communicate about?
We're absolutely talking about it. It's not just AI, however. So, of course there are going to be jobs that go, but we're also going to be creating jobs that do not exist today. So actually equipping our people to use these AI tools. About 70% of our colleagues now, we've got over 200,000 people at Citi, now have access to Citi AI tools. So it really is all about empowering our people to say, number one, how can you use AI to do your job better? But also, if there are other opportunities within the organisation, to be able to be ready to take on those different roles.
Will it be harder for graduates to learn on the job?
We're not seeing that. So don't forget that a lot of graduates were doing, shall we say, a lot of data processing, input models. What we're spending a lot of time on thinking is how do we provide that value-add training to our graduates to enable them to really hit the ground running when they join Citi. So, we're continuing to hire graduates. There hasn't been really a drop-off in terms of numbers, and we're always needing to replenish with new talent.
Tina, when you look at UK politics, do you have many clients asking about the future of this government, also what happens in a couple of years when we have elections, and does that worry them?
Not at the moment. Probably the next sort of data point is around the May by-elections. But at this point, I think the government's given themselves a little bit of breathing room. You know, there's a significant sort of fiscal headroom, which means obviously the gilt market has performed very well versus sort of global bond markets. You know, so I think there's a bit of breathing room here. And at the same time, if we do start to see, you know, just some of the economic indicators improve, what we're looking at, of course, is unemployment. You know, if we start to see unemployment tick up, what does that mean? But ultimately, I think markets are expecting that could mean, you know, an easing of monetary policy further than maybe the 1 or 2 rate cuts that are expected later on in the year. So I think in terms of politics, of course, I think investors have a watching brief in terms of what happens. But at the same time, I think, you know, the macroeconomics also is very important.
Does reform have more of a presence in the City of London?
I would say intermittently. You know, I think certainly from City's point of view, you know, we're politically agnostic, whilst at the same time, you know, of course we engage with political parties to advocate for public policy that drives economic growth and encourages investment. So you know, in that sense, I think reform is going to be, you know, quite an interesting area, and will continue to be a key area of focus for our investors.
So something quite exciting, your Canary Wharf, you know, skyscraper renovation.
Yes.
How's that going?
It's going really well. We're really excited about moving in this year, so you must come visit. And you know, but I think what's really quite important about the $1.5 billion that we've spent on that is we've really been mindful over how can we spend as much of that here in the UK. So whether that's suppliers, whether that's labour, so you know, about 60% of that spend has been spent here in the UK on goods, on services, and providing employment for over 6,000 people. So, you know, we're really pleased with how the project's gone.
Yeah, I remember reading the announcement and thinking, this is quite a vote of confidence in the UK.
It is. In the UK, in London as a financial centre, you know, it's going to give us another 30 years here at Canary Wharf.
Tina, thank you so much for joining us. Tina Lee, their Citi UK Chief Executive. Now, let's return to the Fed, keeping rates on hold and signalling a cautious outlook. The two dissenters were Governors Christopher Waller and Stephen Mirren, who favoured a 1/4 point reduction. Now, with us this morning, Michael McKee, Bloomberg's international economics and policy correspondent. Mike, so good to speak to you. So what were your main key takeaways?
Well, the key takeaway, I think, for the markets is that the Fed is in no hurry to do another rate cut. They think the economy has stabilized, if not improved tremendously. And so the bar is going to be quite high for another cut. The inflation rate is going to have to drop. And as Jay Powell suggested in the news conference yesterday, inflation is expected in the short run to move higher. So for the time being, we'll be on hold. And it may be that we never see another rate cut from Chair Powell. Of course, he leaves office at the end of May.
Yeah, I mean, at the Fed press conference, Mike, the Fed chair was asked repeatedly about the bank's relations with President Trump and whether it would remain independent. Here he is.
And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is you know, stay out of elected politics.
Mike, I mean, this was probably good advice for anyone that has to do anything at the moment, but this really overshadows, I mean, does it overshadow everything, decision-making, everyone's thinking, people trying to please the president in case they get the job next?
Well, that is a factor in what's going on, but the Fed has done its best to keep politics out. We were waiting to see what the Fed's strategy would be with this news conference, whether Powell would talk about politics or stick to policy, and he stuck to policy even when I asked him if he's staying on as a governor after his term as chair is up. Basically, the Fed has decided it's not good for the markets, it's not good for the Fed to keep engaging, so they'll just keep their heads down and keep working. The question of who's going to be his successor is going to loom over everything until Donald Trump gets around to finally making a choice. There are people who think that maybe Christopher Waller, who's on the short list, did a dissent yesterday in order to keep his chances alive. But Waller is also a very competent economist, and we're expecting probably a statement from him tomorrow when the blackout lifts on the economic reasons why he saw a cut as being necessary.
Mike, in general, I mean, why is it taking so long for the president? I feel like it's been, an announcement is coming this week for the last 3 months. Is it because he's worried about confirmations, or why is it dragging on?
I don't think he has to worry about confirmations because the Republican Senate will do basically whatever he asks, and that does give him some time because they can move fairly quickly on a confirmation. But as far as why it's taking so long and why he keeps putting it off, nobody has any real idea. There's some sort of feeling that maybe he's not satisfied with the 4 that he's identified as on the short list, but he hasn't added anybody to that. So we don't know. It's the only answer I can give you, friend, is it's Donald Trump.
Mike, thank you so much. Michael McKeither, Bloomberg's international economics and policy correspondent. Honestly, it's a real treat to have him wake up so early and be with us this morning. Coming up, the British Prime Minister says the UK must build a more sophisticated relationship with China. But what impact will that have on wider relations, including the U.S.? We'll be discussing all of that with the former international trade minister. That's coming up next, and this is Bloomberg.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this the new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Chinese President Xi Jinping has urged the British Prime Minister Keir Starmer to rise above differences that had strained past relations between the UK and China. During his visit to Beijing, Keir Starmer called for a, quote, more sophisticated relationship between the two countries following his meeting with Xi Jinping. Now, it's the first trip to China by a British leader in 8 years. Joining us now is Liam Fox, former UK International Trade Minister and former Defence Minister. Thank you for joining us. I mean, I have 1,000,001 questions about what you think is going on right now, but the Prime Minister, let's start there, has been to China. You know, no Prime Minister has been to China, actually, since Theresa May went. Is Keir Starmer right to do so now?
It's always right to have a conversation. You know, even we talked to the Soviet Union during the Cold War, so it's fine. I was on that last trip with Theresa May to China in 2018. Our relationship with China is always one of balancing, is there economic opportunity against, is there security risk in this? And so I think that what you need to do is look at the ledger between 2018 and now. We've had increased trade with China, but we've had an increased trade deficit. Last year it was twice as big as 2019. We do have a trade surplus in services with China, so there is room for improvement there on the economic side. But looking at the bigger picture, we've seen China continue its pressure, increase its pressure on Taiwan. We've had MI5 telling us they're a daily threat in the United Kingdom. We've had them ignoring the Hong Kong Treaty. We've had the various national security laws passed, which diminish the freedom of people in Hong Kong and China. And so I think on the security side, the ledger is negative.
But you also have the U.S. putting extra pressures and threatening with tariffs. So again, how has the world changed since 2018?
Well, in the United States, we've got the position where the national security strategy says China's no longer the number one problem for the United States. It's the Americas and the homeland. So, and yet at the same time threatening 100% tariffs on Canada. So it's unclear exactly what American policy is overall on that. What we have seen is a deterioration in the global economic and trade picture. We've seen increasing protectionism, and we need now for Britain to be looking to wider markets.
Yeah. Do you think the UK has to choose, given what we're seeing between the US and China?
No, most of our economic growth recently has been very dependent on a strong American economy compared to a very flat European economy. But must also remember that Britain has joined CPTPP, the Pan-Asian trade bloc. And if you look at the size of that in terms of GDP, that's about 16% global GDP compared to China's 19%. Now you add Indonesia, where Britain doesn't have a trade agreement at the moment, with the Philippines and the UAE, which have applied, and you can see that there's a potentially bigger Asian opportunity for the UK.
You, of course, since having left office, worked a lot in the Middle East with the Abraham Accords. What's your take on, first of all, what happens in Iran over the next couple of weeks? We had the U.S. administration threatening, actually, them yesterday of either coming back to a nuclear deal or facing the consequences.
Well, the regime is at the weakest point that it's been since the revolution of 1979. And what it has in common with that period is that the revolt is not just young people, as it was at one point, or largely about women's rights, which it was at one point, but it's got the merchant class, basically a whole wide coalition against the current regime. In effect, there's no Islamic revolution left. There's no religious authority. So change can really only come from the people of Iran themselves. But what we can do is we can give them political and moral support, which I'm afraid didn't happen in the Obama administration. And we can also make very clear to the security forces who keep the regime in place at the moment that we will hold them responsible for crimes against their population should that regime fall, and they're still supporting them.
But could you not see the U.S. actually intervene and pick up the leadership like they did in Venezuela?
It's not the same as Venezuela. Iran is a much more complex position. It's what I would call a thugocracy based on the IRGC with a mad theocracy on top of it. It's not the same. And in any case, regime change in Iran will not be brought about from outside the country. It will only be brought about from inside, but we have levers to help the people of Iran in that. Perhaps most importantly, what we need is the international community to be bringing the disparate elements of the Iranian opposition together so that there's a plan for a post-regime Iran that includes a government of national unity of some sort that would transition to a more democratic society.
What will need to happen in Gaza to bring peace?
Gaza will need to be, as in the whole region, there will need to be greater prosperity, because peace is not just the absence of conflict. It also requires justice and economic opportunity and education and healthcare, all those things that underpin it. That's a massive task. But I think we also have to recognize that Israel and Palestine is not the only dispute in the Middle East, and we've got to stop seeing the whole region through that single prism. And Israel also, I think, needs to recognize that no state can be secure in the long term when there is constant instability and insecurity in its neighbors. So we have to see the whole issue, which is where I think the strength of the Abraham Accords comes, where it's not just about the politics, it's also about better economic opportunity and conditions for all of Israel's neighbors.
A lot of your former colleagues have defected to reform. Why do you think that is?
Well, some of them have. Makes me wonder what those Labour voters who have been saying they're going to vote reform will think now, when the very Conservatives that they most disliked are all part of the reform team. British politics is a bit in flux. I think there's been a gap in the centre-right. I think the Conservative Party needs to return to its basic economic roots. We need to be the party of business. We need to be the party of sound economic management and the party of economic opportunity. And I do think that Kemi Badenoch's actually grasped the thorn in this, because we basically had a choice. Margaret Thatcher believed that Britain needed a new agenda. Other Conservative leaders believed the Conservative Party needed a makeover. I think Kemi Badenoch understands that the strength lies in the former.
Would you ever consider defecting?
No, I would never, and I would certainly never defect to reform. I believe that the Conservative Party has always been the most successful political party in the United Kingdom. It has been the party traditionally of economic opportunity for people, and that's what we need to return to. We need to return for one reason above all else, that last year our government borrowed £140 billion. 105 billion of that was on debt interest. We've got to have a proper, honest conversation with the electorate to say we can't continue as we are, otherwise we'll hand the next generation a scorched earth economic policy.
How's it lost its way so much when you look at the polls, and how can the Tories now blunt the threat posed by Nigel Farage and reform?
Well, if you look at the aggregate polls, I mean, I hate to talk about polls, but all politicians look at polls. If you look at what's happening on the left, the drop in the Labour support's almost entirely mirrored by the rise in the Greens. And on the right, the gradual reduction in reform support is mirrored by a gradual increase in Conservative support. The problem for the Conservatives, I think, is credibility and re-establishing trust on economic issues. And that's best done by a very honest conversation with the population. We can't have 9.2 million people of working age not working in the country. We can't have these high tax rates that we have and be a competitive country.
Does it need to be something more radical than an honest conversation, given reform has more than 30% in the polls?
It will require very clear policy decisions to be made. But I think the first thing is getting the public to understand that we recognize the long-term problems of the economy. We recognize the damage being done to our economy by a high-tax Labour government. The next election will be an economic election. I have no idea.
Haven't these recognitions been done?
No, I don't think so. I think that the next election, unlike the last one, which had a lot of mixed issues in it, post-pandemic and so on, will be an economic election. It will be a choice between higher inflation, higher unemployment, lower investment under Labour, or a Conservative economic alternative. I think reform, well, I have no idea if they have an economic policy, and if they do, what it is.
And yet they do so well on the polls.
Well, that may well be the very reason at the moment that people will vote for something that looks like a good advertising campaign, even if there's nothing behind it.
Okay, it's so good to speak to you. Thank you so much for coming on. Liam Fox, former UK International Trade Minister and former Defence Minister. Now, there is quite a lot going on today. We have AI, we have a lot of earnings, and of course it was only yesterday that we had the Fed, we had our Michael McKee going through all of that. Now, technology stocks are fueling equity gains. Again, the sector's mega caps really plan to build out the infrastructure that powers artificial intelligence. And then the other big story, gold and silver hitting record highs. The dollar resuming its decline. Gold actually climbing above $5,500 an ounce. Silver extending its advance. Up next, it's Bloomberg Brief, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
A cidade estava sitiada.
Isso, ao começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It is 5 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. More spending unleashed. Tech stocks lead futures higher with some of the biggest players announcing further investment in AI. But software stumbles. SAP and Microsoft lag as cloud business disappoints. And the S&P 500 yesterday hit the 7,000 mark for the first time, although it came back down. The dollar rose yesterday and is back on the decline today on debasement risk. Let's take a look at the futures board here. S&P futures right now about 0.2%. It looks like we could open at 7,000 again when that bell rings in 4.5 hours. NASDAQ futures up 0.2% as tech spending really impresses the street. I mean, we're looking at Meta spending $115 billion this year, and Russell 2000 futures getting about 0.1% after no move by the Federal Reserve yesterday. Speaking of that, let's take a look at Treasuries right now and see where yields are. 2-year yield, little changed at 357. The 10-year yield also little changed at 425, and out the long end, 487.35 for the 30-year bond. In terms of the commodities and the dollar, let's take a look at gold because we have another new record, 55.12 here for the yellow metal. Copper also pushing to another new record, 13,864. And the Bloomberg Dollar Index shows the greenback down about 0.1% against its G10 peers. For some of the stocks that we want to watch, let's bring in Chloe Millet from London. Chloe?
Good morning, Matt. Meta is up very strongly in pre-market trading this morning after providing revenue guidance that was much stronger than expected, and that helped to offset the impact of also much higher AI spending. And this is really the latest sign that those big tech companies are not holding back and not planning to hold back anytime soon on this massive AI spending spree. And we are up for Meta a little over 7% this morning. Moving on to another big tech name, and on the software side of things, it's looking a little weaker. We have got Microsoft down this morning after quite
muted growth in its cloud computing business. And this echoes what we saw as well from SAP in Germany, which also mentioned this weakness in the cloud business. So that is something to watch out for going forward, and we're down about 6%. And finally, let's stay over in Germany, and Deutsche Bank reported strong earnings and a 1 billion euro buyback, but that was overshadowed this morning by a money laundering investigation that led the offices to be raided just yesterday. And so it seems that this legal headache is taking priority in investors' minds over those really strong results, and we are down almost 2% for Deutsche Bank.
All right, Chloe, thanks very much. Chloe Millet covering the stories there in stocks today. Coming up this hour, we're going to speak to Maria Waitman of State Street on this equity market, and later in the hour, a closer look at tech earnings with Joel Kalina of Wedbush. Right now, though, stocks are pushing higher as mega-cap tech steps up its AI spending spree.
Our North Star is building the best place for individuals to make a massive impact. So to do this, we're investing in AI native tooling so individuals at Meta can get more done. We're elevating individual contributors and flattening teams. We're starting to see projects that used to require big teams now be accomplished by a single very talented person.
Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. So, Tom, it does look like at least Zuckerberg and Facebook are stepping up spending, and the suppliers, for example, SK Hynix and Samsung, also stepping up spending to produce more chips.
Yeah, look, I think this reinforces two key themes, and we'll see if these themes sustain themselves through 2026, which was one, software versus hardware. Hardware performing very well. The spend on CapEx, SK Hynix, Samsung coming through, of course, with the memory chip squeeze and needing to build out for that, given the huge demand. And on the software front, companies like SAP being questioned in terms of the competitive threat and whether they really are getting the ROI on their AI investments. Microsoft, of course, as well, when it comes to the Azure business, not really getting to the point where investors can say that the CapEx spend on data centers and infrastructure can be justified, at least question marks over that. A 66% increase in CapEx spend for the quarter for Microsoft, 37 billion, above 37 billion US dollars, and yet Azure growth slowed. Yes, revenues increased 38%, but that was slower than the estimates, and that is what is causing question marks for Microsoft. Very different picture for Meta. The core part of that business, advertising revenues, absolutely smashing it, blowing up on all fronts in terms of the ad picture for Meta. So it seems investors saying it's okay, you can continue to spend on CapEx. And they are looking potentially, Meta is looking potentially at around $135 billion of CapEx in 2026. That would be a 90% increase, Matt.
What's wrong with the software companies? Is this an AI problem? Because SAP, the most valuable software company in Europe, has been literally decimated today.
Absolutely brutal session for SAP, and the stock was already down prior to today by about 30%. They've been going through this transition, of course, Matt. You know this company well from your time in Germany. They've been moving from licensing their software to subscriptions in the cloud. And the key question for investors is, how long does that continue? That's been a tailwind for this business in recent years. But there's question marks about whether or not that starts to peter out in 2027. Then there's also the question of the backlog in terms of the demand and the orders, and that came in a little smaller and a little lower than had been expected. And there's a lot of competition in the software space. This is a big enterprise player, of course, but there's a lot of new up-and-coming startups focused on AI, focused on software, focused on the enterprise, and to what extent are they starting to lose market share on that front? The CEO telling us that ultimately the value will accrue at the application layer when it comes to AI, but when that really comes to fore is and remains a question that they certainly have to answer.
I want to get back to the spending spree. Tesla also wants to spend more money, right? $20 billion to build its AI future. What's the story from Elon Musk?
Well, the story from Elon Musk seems to be this is not a car company anymore, Tesla. They're forgetting about the Model S and the Model X. They're going to stop producing those. This is all about AI. They're going to invest about $2 billion. Tesla will invest about $2 billion in XAI. But to your central point, a commitment of CapEx from Tesla of $20 billion US dollars, double the estimates, and Musk talking potentially about building a foundry. And that ties us back to the chips question, the shortage in terms of memory from SK Hynix and Samsung. They are having to think about building their own foundry at Tesla and at XAI to meet that demand for those chips, and that's going to result in more capex. But investors seem to be pretty relaxed, and they are betting that the future that Musk has carved out for themselves in terms of robotics and AI, that will ultimately pay off.
T-Mac, your transformation to tech reporter is complete. I noticed no more tie. Is that a European thing too? If you cover tech, no tie.
It's a bit of a cliche, isn't it, Matt?
It's good. I like it. It's a signal to the viewer. If you're a Bloomberg anchor and you're not wearing a tie, then you're covering tech. Tom McKenzie out of London with the tech results for us, driving those results, driving futures higher, again above 7,000 today. Joining us now is Maria Waitman, head of equity research at State Street. So, Maria, you know, we were up above 7,000 yesterday, came back down. I guess there's some sell orders at that big round number, but do you see us pushing through again today or this week?
Yeah, hello, and I mean it's really good day to be on the program as like kind of for an optimistic equity strategist. So yeah, no, we are very kind of constructive on the market. I think kind of broad-based kind of macroeconomic story is still very supportive for equity gains. We see robust earnings growth, kind of, and monetary policies that is kind of supportive, and we see lower, I mean, inflation being anchored. So like all kind of building blocks of kind of broad-based rallies there.
I wonder if the broadening out makes sense to you, Maria. I mean, okay, these tech results are front and center. That's all anyone cares about. It's not just T-Mac who's dropping the tie. Like everybody is getting rid of the tie. We're all tech now. But what about the rest of the market? I mean, are we going to see those earnings catch up? Are we going to see those valuations catch up?
Yeah, I mean, so there probably will be a little bit more controversial. And I mean, you know myself, we've been very constructive on the tech story for a long time. And I mean, the reason we love tech is not because it has like AI in it, or we love it for strong earnings. And I think this tech results, like this quarter, once again, we're kind of underlying this message that earnings growth in this sector are incredibly strong, and lots of other sectors are really struggling to grow their earnings. So, I mean, for us, it's less about broadening. It's about finding winners, finding strong results. And they still kind of mostly gravitated in tech space. So, yeah, unfortunately, not much broadening on our side.
Does the dollar worry you as a European investor in U.S. assets? I mean, it has come down to a 4-year low, but if you look at a longer-term chart, it seems to be really just normalizing. How do you view it?
Yeah, I mean, we're concerned about dollar, and that's like lots of conversation I have with European investors, of course. I mean, on one hand, like weaker dollar is obviously very good for U.S. companies and their profitability, and kind of a little bit of a headwind for profitability of European companies. So that's kind of this kind of direct angle. But yeah, increasing number of clients are kind of questioning the need for hedging their U.S. equity exposures. That tradition over the last kind of few years has traditionally not been even a conversation. Now that's increasingly people thinking about it and kind of potentially worrying about hedging of the U.S. equity. So far, we haven't seen that being like weaker dollar being a reason not to buy U.S. stocks. I think it's more about how you buy it, what you do with your kind of currency positions.
What about the rest of the world? I mean, we were just talking about SAP. It's been decimated, and okay, it's a software company, no longer Europe's biggest. ASML is the biggest company in Europe now, but it's still only a $500 billion company, right? Nothing compared to the U.S. Is anything outside of America interesting to you in tech?
I mean, the easy trade that outside of America in tech is obviously Asian tech. So, I mean, we see a lot of interest in Korea and Taiwan. I mean, I know lots of people see it as a broadening and diversification, but I mean, really, it's just the same AI trade, but just implemented slightly differently. So we see people doing that. I think our point is that outside technology area, I mean, the only other areas that is quite interesting is probably kind of commodities and mining stocks, but other than that, we don't really see kind of economic momentum broadening enough to support earnings and kind of cyclicals and defensives and all those kind of traditional areas.
You like commodities even now? I mean, would you put new money into gold, copper, silver?
I mean, what is really interesting in terms of if you're thinking about commodities is this, I mean, what drives demand for commodity is this kind of huge geopolitical uncertainty. And I mean, the levels of those are quite unprecedented. And it's really, I mean, at this stage, it's very hard to imagine that's going away. So that's kind of the bid in the market for commodities. But what is really interesting is geopolitical uncertainty is not translating in a huge market volatility, like things like weeks, moves, there's all those kind of volatility trades are quite anchored, I guess, kind of benign inflation, keeping stabilizing it, which gives you a bid for risk assets, right? For your carry trades, for your potentially emerging market trades. So that's a duopoly in the market. Yes, we like commodity trades because of geopolitical uncertainty, but it's not spilling in the market and creating wall events.
All right, Maria, great to catch up with you. Really appreciate you joining us this morning. Maria Waitman there of State Street talking to us about equities and commodities. Speaking of, let's get a look at what's going on in oil right now. You can see gains there as well. NYMEX crude WTI pushing back up towards $65 a barrel with a 2% plus gain today on concerns, geopolitical issues that Maria pointed out, not the same thing that drives gold, but worries about oil production out of Kazakhstan and the situation in Iran. Brent crude pushing back up closer to $70 a barrel right now at $69.73 a barrel. Let's get to the other top stories trending on the Bloomberg terminal this morning. Blackstone is in advanced talks to become the single largest shareholder of New World Development, a move that would see one of Hong Kong's richest families relinquish control of a major asset. Under the proposed deal, Blackstone would be able to restructure the embattled developer, and New World could continue to try to offload assets to shore up liquidity. The Bank of England is looking to restart the sale of a London sports club that helps host the annual Wimbledon tennis tournament. The UK Central Bank has hired property agent Knight Frank to help with the freehold sale. The BOE is looking to restart the sale of the site amid a push to slash costs. And ties between China and the United Kingdom continue to thaw. President Xi Jinping praised British Prime Minister Keir Starmer's visit to China and vowed to consider granting UK citizens visa-free entry. Starmer called for a more sophisticated relationship in the first trip to China by a British leader in 8 years. Coming up, Deutsche Bank shares decline on concerns over outlook and that raid by federal prosecutors. More on that next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
had one of our occasional visits from the prosecutors yesterday, and as you may have seen in some of the reporting yesterday, the investigation relates to transactions from the years 2013 to 2018. Naturally, we're cooperating as we do in each case with the prosecutor in their search. We will continue to do that. We can't really say much in this early stage of the investigation, but it builds on earlier investigations on similar matters.
That was Deutsche Bank CFO James von Moltke speaking with Bloomberg on the raid at the lender's Frankfurt offices, which has overshadowed the bank's fourth quarter results. Bloomberg's Tom Metcalf joins us with the latest. And Tom, before we get to the quarter and the shares, what's with the raid? I mean, I thought this money laundering issue was behind the German bank.
Well, yeah, I very much enjoyed the CFO's very, very droll comment there, as we have on occasion these raids. Yeah, basically, from what we know, it is related to staff at various sort of premises, and really how they kind of dealt with transactions linked to Roman Abramovich in terms of more the reporting on the Deutsche Bank side than anything else. So certainly, it literally happened yesterday, which if I was a Deutsche Bank executive, I'd be very frustrated at, because inevitably it kind of overshadows these results, and it's too early to say, just how, sort of much jeopardy there is here for Deutsche Bank as an institution from an investigation like this. But whether it's sort of a passing problem or not, it certainly optically looks terrible the day before you go out with your Q4 results.
Yeah, it does seem like it could have been timed better by the prosecutors, or maybe that was their intention. How is the business going? How did the earnings present Deutsche Bank's comeback under Christian Sewing and James von Moltke?
Yeah, I mean, look, things are proceeding well. They were able to record profit. I think analysts sort of view, kind of saying these set of results doesn't really move consensus anyway. So you've had Deutsche Bank shares jump by about 2/3 over the last 12 months, and this set of results, decent, no kind of nasty surprises or anything like that, but nothing to really, kind of change the dynamic there. And some analysts pointing out maybe the outlook for 2026 was a little bit soft, a little bit disappointing, but broadly speaking, Deutsche Bank is plowing ahead, continuing to kind of restructure, re-strategize under Sewing, and not too much to report on sort of anything changing there.
And it's been obviously the European bank story has been amazing to watch for long investors. It's been a profitable trade. Deutsche Bank shares total return over 5 years up 330%. I remember when they were trading for like a quarter book value. Is this rise expected to continue? I mean, 2025 was a banner year for European banks. Is 2026 going to look good as well?
Yeah, I think certainly not what we saw in 2025. So the whole host of banks that reported today, again, a bit like Deutsche Bank, doing pretty well, but it's just proven really tough to sort of beat those embedded expectations. So, I think it will be a pretty strong set of results across the board this earnings season, but I don't think you're going to see certainly kind of the share price double again, as some banks did in 2025.
Tom, are European bankers going to get good bonuses this year? Is this going to be a good season for them?
Everyone likes to complain whatever they get. I think certainly at the US banks it's looking pretty rosy, but we are picking up some sense that, perhaps at other banks there is a downward pressure on costs, because, that's the one lever that all bankers can pull, after, sort of all executives can pull, is keep those costs under control, even if it maybe hits morale at some of those hard-working bankers.
All right, Tom Metcalf covers the European banks for us. Really appreciate you joining us this morning out of London. Coming up, new commitments in OpenAI's blockbuster $100 billion funding round. More on that and a look at what else is making headlines in your front page news next. This is Bloomberg.
2026 for us is the year that everything just comes together, right? We're not just moving money. The last decade, literally, we've been the race for Africa's growth, right? And the future of Africa, in our opinion, is not hype, it's infrastructure-led. When Africa wins, the global economy wins. We're building the pipes, and those pipes are now of age. Now, as of right now, we are the biggest fintech in Africa, the most licensed non-bank entity. In the last 10 years, we built that muscle. Now we're putting that to the test, all right? Now we've covered the entire world. We have UK, US, UAE, Canada, Europe covered through our partnership with Global Open, for example, and Nuvian. And the point behind that really is, how do we ensure we use that infrastructure to drive the next phase of growth for Further Wave by empowering our customers across all our segments?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
This is Bloomberg Brief. I'm Matt Miller in New York. Time now for your front page news. First up on the Wall Street Journal, billionaire media and tech investor Barry Diller approached Warner Brothers Discovery last year, expressing interest in buying CNN. Sources say no serious action was taken on Diller's inquiry, nor was it taken to the Warner board of directors. A Warner spokesman said CNN was not and is not for sale and is an important part of Discovery Global. Next up, on the Financial Times, leading with OpenAI in talks to raise $40 billion from NVIDIA, Amazon, and Microsoft as part of its blockbuster $100 billion funding effort. Sources say that NVIDIA could invest as much as $20 billion. Amazon has discussed investing is about $10 billion, and Microsoft, which already owns 27% of a stake in OpenAI, could invest several $billion more. And on the Washington Post, Democrats demand new ICE restrictions as a government shutdown looms. The demand includes requiring warrants in some cases, creating a uniform code of conduct for agents, actual uniforms, body cameras, and no more masks and anonymity. The impasse over the Homeland Security funding bill means a partial government shutdown is likely at midnight of January 31st unless legislation is passed to keep it open, and they are working on that. We're going to be talking about it. Quick look at what's going on in the commodities this morning. Gold at $5,514 a troy ounce. We come back, we'll talk about oil. This is Bloomberg.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have
significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later on over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the trend, the technology trend and the investment is real.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. More spending unleashed. Tech stocks lead futures higher with some of the biggest players announcing further CapEx in artificial intelligence. But software stumbles, SAP and Microsoft lag as cloud businesses disappoint, and the S&P 500 yesterday hit the 7,000 mark for the first time before coming back down. The dollar yesterday rising on remarks from Scott Bessent, but is on the decline again on debasement risks. Here you can see S&P futures up 0.2%, 7,021 the level there. Obviously a bit of a premium to the cash trade, but we could, or likely at this level, will open at 7,000. NASDAQ futures higher by 0.3%, and the small caps up as well. Take a look at treasuries. Not a lot of movement after the Fed did little yesterday. The 2-year yield unchanged at 356.93. The 10-year yield also little changed, 425, relatively high level, and the 30-year yield at 487.55. In terms of commodities, those are the big movers of the day. Gold going through 5,500 to a new record 5,506. The level there. Copper at 13,942, and the Bloomberg U.S. dollar index down about 0.1% against its G10 peers. For some of the stocks to watch, let's get over to Chloe Melee. She's in London. Chloe?
Good morning, Matt. We have got Meta up almost 8% this morning in pre-market trading after providing a revenue outlook that was much stronger than expected. And so that helps offset the impact of much higher AI spending. And this is, of course, part of all of those big tech companies spending billions and billions on AI, which then also drives momentum for those semiconductor stocks, those data center equipment stocks. So this is a much broader story than just Meta. Moving on to another aspect of tech, which is not doing as well, and that is software. Microsoft is down this morning after reporting a quite muted growth in its cloud computing business. This echoes what SAP has also said in Germany this morning, with weakness in that cloud business. And finally, let's go over to rare earth companies that are down this morning after a report from Reuters that the Trump administration was backing away from plans to guarantee minimum prices for critical minerals projects. And so this is driving down those stocks quite significantly this morning.
All right, Chloe, thanks very much. Chloe Melee there in London with a look at your single stock stories this morning. The first Fed decision of the year, we got a hold. Chair Powell has two more meetings in which to adjust rates before his term ends. Let's talk about the likelihood of that with Michael McKee, our international policy and economics correspondent, joins us here on set. So we didn't get any move yesterday. None was expected. How did you view the presser?
I thought Chair Powell was...
By the way, when did you get back? Weren't you in D.C. yesterday?
Yes, the Star Trek people beat me up.
That was fast.
Powell looked pretty relaxed yesterday. Of course, the decision they made was to avoid all politics questions. He shut down all of those fairly rapidly, including mine. And then he seemed relaxed about the outlook questions because basically he was able to say, we don't know whether we're going to cut rates again, but the economy is in reasonably good shape right now. We're kind of at the high end of neutral, and we think we can sit and wait and watch, wait for more data.
I can understand, growth looks fairly strong. Inflation looks at least subdued at 2 3/4. What about the labor market? Is that not a concern, especially after all the firings we got yesterday?
Well, interestingly, in their statement, they said that the labor market unemployment has basically stabilized, is the word they use. So they're thinking that unemployment is not going to go crashing down again. Of course, we got a lot of job layoff announcements this week, but some people think that's just because it's the first of the year and that's what companies do around that time. So we'll have to see how that plays out. And of course, a week from tomorrow, we get the jobs report for the month of January, and we'll see whether unemployment stays low. But for Powell, there's kind of the risks are balanced at this point, much more balanced than they were. Still a risk that inflation goes up, although he thinks it's still tariff-related, and there's a risk that the job market gets worse, but they can react to either one of those if they need to.
So is it likely that he cuts rates in either of his last 2 meetings?
It doesn't appear that way, and that's not the way the market's betting. There's no real idea that the Fed is going to be cutting rates again until July at this point. Now, there's 2 more meetings for Jay Powell on March 18th and April 29th. His term as chair ends May 23rd. The first meeting for the new chair will be June 17th. That's what you're going to want to pay attention to. And it's unlikely that the Fed is somebody's going to walk in and get the Fed to start cutting rates really quickly. So I would think at this point we're likely to see the Fed on hold for at least the first half of the year, unless there's some major surprise in the data.
I look at WIRP, and chances of a cut are only 14% in both of the next 2 meetings, and then they jump to 50% in June.
Well, it's all going to be about the data. The probabilities of a cut go up and down when the data tells it to. And at this point, we have not seen data in the last month that suggested that the Fed needed to cut. So you watched the vanishingly small chances of a rate cut yesterday disappear on that graph.
All right, Mike, thanks very much for making it back so quickly. Michael McKee, back from Washington and the Fed. Let's take a look at oil right now. Brent crude hovering just below $70 a barrel as President Trump warns Iran of military strikes if a nuclear deal is not reached soon. Let's go to Washington. Mika Solner of Bloomberg Government is standing by. And Mika, the one thing that's been terribly confusing to me over the last couple of days when I see this headline, I thought we had completely obliterated Iran's nuclear capabilities. It was almost unpatriotic to question their supply now of enriched uranium. Why would we need a nuclear deal with them?
Yeah, absolutely. I mean, this is a complete escalation of what the president has been suggesting when it comes to, using his full bully pulpit and influence against Iran. And this comes after weeks of these deadly protests where Trump has continuously argued and warned Iran that there will be more military action in the region, potentially. And so this is the latest threat, I think, when it comes to where that is. But it is having a ravaging effect on the oil market.
So how's the setup look? What have we got over there in terms of aircraft carriers? How serious is this threat?
Well, I think it potentially could be very serious. Iran has responded saying that they're ready to retaliate if the U.S. takes any action, and it could be the start of another potential conflict between the U.S. and a very powerful adversary. And so we're really going to keep a close eye on. I think the White House is being, trying to be very aggressive in this, but also very cautious in terms of what the implications can be.
Any chance the U.S. just goes in and takes out the Ayatollah, a la Nicolas Maduro?
Anything is possible these days. Of course, the administration is going to be very tight-lipped on what its actual protocols and plans are. But I think we're also going to have to see with, the more that Iran responds here.
All right, Mika, thanks very much. Mika Solner there out of Washington, D.C. Let's take a look at some of the other top stories trending on the Bloomberg terminal this morning. Blackstone is in advanced talks to become the single largest shareholder of New World Development, a move that would see one of Hong Kong's richest families relinquish control of a major asset. Under the proposed deal, Blackstone would be able to restructure the embattled developer, and New World could continue to try to offload assets to shore up liquidity. Ties between China and the United Kingdom continue to thaw. Chinese President Xi Jinping praised British Prime Minister Keir Starmer's visit to China and confirmed visa-free travel for UK visits under 30 days. The two sides have further agreed to a partnership to expand UK services in China. And copper soars to $14,000 a ton right now, holding just under that, the most in more than 16 years. The rally was fueled by speculative trading in China. Investors are piling into base metals on the Shanghai Futures Exchange on expectations of stronger U.S. growth and more spending on data centers, robotics, and power infrastructure. Coming up, we break down tech earnings and the AI spending spree with Joel Colina of Wedbush Securities. Next, this is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Our North Star is building the best place for individuals to make a massive impact. So to do this, we're investing in AI native tooling so individuals at Meta can get more done. We're elevating individual contributors and flattening teams. We're starting to see projects that used to require big teams now be accomplished by a single very talented person.
Big tech ramping up AI spending, with Meta planning as much as $135 billion in CapEx this year. Let's bring in Bloomberg's Neil Campling for more. So it seems that investors will applaud an increase of CapEx to this size. It's got to be a record.
Yeah, absolutely. I think the if you look at the guidance range that was given by Meta last night, if they reach the top end of that CapEx guidance range, you'll be looking at 86, a record. The fact that they're delivering above estimates on the top line gives them, gives investors the confidence that that spend will translate into growth and better than expected numbers. So it really is that typical expectation that when you come in above expectations on the growth line, you're given the benefit of the doubt in terms of that spend. And of course, as we heard on the call last night, Zuckerberg did a very good job of saying that the AI spend is translating into core business exceeding expectations. And as long as that message comes through, they'll be given the benefit of the doubt for now, for sure, until we know on an industry basis whether we get true good ROI from the AI spend from the industry.
You know, it's interesting, Neil, yesterday ASML came out with great numbers, but most importantly, a massive order book, which was far higher than the street had estimated. And I thought, well, they must be supply constrained to some extent. Those suppliers, those kinds of suppliers, I note today, and Samsung and SK Hynix, are also boosting CapEx so they can make more of what Meta needs to buy.
Yeah, absolutely. And in terms of, there's been a big focus on memory chip pricing and, the huge sort of demand outstripping supply that we're seeing in terms of contract and spot prices for memory. The memory companies have to spend big for HBM. We know that leading edge lithography in terms of the spending from Taiwan Semiconductor and Samsung is again continuing to raise numbers for the next 2-3 years. And of course, ASML, in terms of, it takes a very long time to build a leading edge fab. If you remember, from the time that the shovels go down to producing leading edge chips is really a 3 to 5 year investment cycle. So investors get the confidence with the likes of ASML in terms of that, that long outlook for the chip spend. And we'll hear again from KLA later tonight as to the outlook for the AI sort of CapEx related spend. And on the other side of that, in terms of is there going to be an impact from the likes of memory pricing, if we hear that from Apple in terms of their numbers tonight.
All right, Neil, thanks very much. Bloomberg's Neil Camplin giving us an update on what we've heard and a preview of what we're going to hear. Let's talk about all that right now with Joel Colina, Managing Director of TMT Trading at Wedbush Securities. That's, of course, telecom, media, and technology, and tech being the focus here. Joel, what was your take on the handout?
Yeah, Matt, good morning. And I have to say a quick shout out to Neil Camplin, probably one of the best tech specialists I've ever worked with in my career, an absolute legend. But turning to earnings last night, yeah, mixed bag. And more importantly, Meta, Neil touched on it right before me, impressive revenue momentum. And the key for the stock, positioning was extremely clean and light into this print. With the mega caps have been very soggy for the better part of the past 3 to 6 months. But they just gave incredible first quarter guide, which was obviously offsetting that elevated OPEX and CapEx. But again, the story for Meta, Zuckerberg on the call was very focused on kind of talking about the ROI and increased engagement and relevancy they're seeing across their platforms. And the gains are there. And it's just, again, there's a clearer path now for this story to work and the multiple to kind of creep higher. You have OPEX and CapEx out of the way. And now we can look forward to the avocado model release, which is likely coming at the end of the quarter.
So, Joel, what do you think about the supply constraint issue? Because yesterday we saw, with ASML, they had a revenue of almost 7 billion euros, but the order book was more than 13 billion. And I was just thinking, as I saw the shares, trading up and falling down at the end of the European session, they probably just can't make enough to boost revenue more meaningfully.
Yeah, it was definitely disappointing. T+1 reaction, ASML faded all day. The ADR sort of closed around its lows as well. But more importantly, it's up 5%, kind of as we speak right now. Lam Research sounded fantastic last night on their call. Visibility continues to kind of extend. Yeah, but supply tightness and constraints is the #1 bottleneck right now in AI. And that's a good problem to have. Neil touched on memory. We're seeing it in the optical space as well. And as we talk about, the AI revolution, which continues to evolve and broaden out, Microsoft, Just very disappointing on the Azure guide last night. There's just no sign of acceleration there. CapEx is just insanely elevated as well. And look at SAP was a disaster this morning, down about 13 to 14%. ServiceNow is down 7-8%. So software is just sort of the the redheaded stepchild and just can't get out of its own way. And unfortunately, this AI overhang is going to limit the upside and excitement for the software complex in general.
Well, but meanwhile, everybody's piling into OpenAI. We just had a story that they're going to raise, another $100 billion. And they need that, obviously, for their spending plans. Why so bullish on OpenAI? Microsoft owns 27% of that company.
Yeah, OpenAI, I think, is a little bit of a different story. I've been a lot more kind of concerned about any names with outsized exposure to Sam Altman. Just look at NVIDIA. Stock has been dead money for 6 months. Oracle has obviously been a train wreck, going back to early September when they hit, around 340. So investors are clearly worried about OpenAI moving forward. There was more reports last night. I don't know if it was confirmed, but cash burn, it continues to accelerate. I think I saw $9 billion a month is sort of what OpenAI their cash burn may be creeping up to. So I think two things can be true at the same time. AI trade and momentum can be still firing on all cylinders, but there's pockets you want to avoid and you don't need to be all in on. Kind of stick to the, keep a more simplistic view and keep to the stories that are winning. And semi-caps, as you touched on earlier, you have Samsung and Intel have both risen from the ashes over the past 6 months. Taiwan Semi's CapEx going higher. And again, you have sovereigns are getting involved as well. Domestic chip production is a number 1-2 policy for Trump and his administration. And I don't think you can sleep on that tailwind either.
Yeah, it's, maybe throwing good money after bad with OpenAI. In terms of, the actual productivity of AI or contribution of AI to the bottom line, are you thinking that we're going to start hearing a lot more of that on earnings calls this quarter, Joel?
Yeah, that seems to be a trend. We kind of picked up, that quite a bit in early December during, TMT conference season. We heard it in early January as well. Obviously, Zuckerberg and his team really, plainly and really brilliantly laid out what they're seeing from their, AI spending. And so, and again, look what Anthropic's been doing over the better part of the past 3 weeks as well with Cloud Code. Cloudbot is has gone viral over the past week or so. So again, it's really reinforcing. There are gains here and there's productivity gains. And again, I think you just want to, again, stay in the lane and I don't think you need to lever up on things, tied to Sam Altman. But again, there are real gains being seen and which is going to reinforce, I think, the spending cycle.
Joel, what's the best area in AI? You've got the hyperscalers, you've got the software, you've got the memory chips. What do you think is where there's the most opportunity that maybe we haven't recognized?
Yeah, I think memory, Neil touched on memory. That's very well known. And some of the moves across the memory and storage space are just parabolic. Seagate was up 20% yesterday. It's just sort of phenomenal. I love this. I'm going to stick to the semi-caps. I think there's a lot of tailwinds. I think they're agnostic to who wins the AI arms race. And to me, that's what kind of separates, the semi-caps from sort of like Taiwan Semi. All roads go through Taiwan and all roads go through semi-caps. And I think they're a winner in pretty much all scenarios.
Joel, great to get some time with you. Really appreciate it. Joel Colina there of Wedbush, head of TMT Trading. Coming up, we're going to get you set up for your trading day with more earnings and economic data on deck. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Earnings season is here.
Earnings season is upon us.
Can they surpass expectations? Bloomberg is first to break the numbers.
Taking a look at Starbucks.
Meta with the outlook. eBay also reporting earnings. More earnings to get through.
With the smartest insights.
You start the year at 22 times forward earnings, you're just going to have a more sensitive market.
We're probably going to have another good earnings season.
And our conversation continues here on Bloomberg.
Continuing coverage on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Matt Miller in New York. Let's get a look at what's ahead today. Earnings continue with Lockheed Martin, Caterpillar, Comcast, and Blackstone all before the bell, plus jobless claims and trade balance come out at 8:30 a.m. Eastern. It is Thursday. And then after the bell, you've got the big one, Apple reporting earnings, as well as SanDisk, increasingly bigger, and Visa also after the market close. In terms of the single stock stories that we're watching, IBM is extending gains after earnings alongside Meta, kicking off the big tech debt spree. ServiceNow had results that were overshadowed by AI disruption fear, and you can see that stock almost decimated today. And USA Rare Earth, not nearly as big, but Reuters reports that the U.S. is backing away from plans to guarantee a minimum price for critical minerals project. Remember, this is the company that's going to get $1.6 billion in funding from the Biden CHIPS Act. In terms of the macro movers today, you got to look at gold. Absolutely crushing a new record, up through $5,500. Copper also at 14,000. You can see futures up 0.1%. The dollar and the 10-year, very little change. That's it for Bloomberg Brief. Bloomberg Surveillance is up next. This is Bloomberg.
cidade estava sitiada.
Nisso, ao começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is going to be, as we all know, a really interesting week for tech.
It's more about tech than it ever has been. Investors are starting to demand a little bit more.
Anytime you have a technology shift, you're going to have big winners and big losers.
The big question is, can we still see the degree of margin expansion out of the tech names?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, ramping up spending. Mega cap tech showing no signs of easing up on a major spending spree. Fed Chair Jay Powell heading towards the exit, hitting pause on rate cuts, and gold continuing its explosive move higher on a 9-day record-breaking rally. Gold topping 5,500 for the first time ever.
This rally is 28% so far in 2026. We are not yet done with the first month of this year. Trading is getting thinner. A lot of banks are having difficulty taking more risk. There is a question why. Is this because of the investment in the physical world? Is this because of concerns about Fed independence, despite what Fed Chair Jay Powell is talking about? Is this a Sell America trade, or is this a trade that has taken on a life of its own as people go to Costco and buy gold bars?
It's not just gold. Gold up by close to 30%, silver up by more than 60%, copper up by 12% already year to date.
And a lot of this has to do with not just the precious metals and the idea of a debasement trade and wanting to store value. When you think of metals like copper and silver, you can actually use in the physical world. As you see the CapEx spending coming from places like Meta and Microsoft and what's going on with the AI trade, you can understand why commodities are moving higher.
Big move in the equity market as well. 6 days of gains on the NASDAQ 100. More gains ahead for us. S&P 500 futures up by 0.1%. These two names in focus, Meta and Microsoft, major spending plans. But if you don't put up the growth, you'll be punished. And that's the difference between the performance of those two names in a pre-market.
This is, to me, the key question. What was it about the tenor of the way that they described some of the spending that caused such polar opposite responses in markets? Meta said it was going to spend up to $135 billion this year. That is up more than 85% from the same time last year, with some $71 billion. And people are rewarding them because guess what? They're showing that they are actually reaping benefits in some of their ads, in some of the spending that advertisers are giving them. At the same time, Microsoft, a big question about a lack of capacity to really meet demand. And that, I think, continues to be the ongoing concern.
They're both spending a ton, but it's where they're spending. And for Microsoft, the fact of the matter is that growth is not in Azure the same way investors wanted to see. When it comes to Meta, the spend is outrageous, but where it's going, investors liked.
Should we get to the Fed?
Please.
These were the headlines after the close. It was big tech. The Fed. Here's the recap from RBC. No comment. Literally, that's the headline. HSBC, some dissent, but no change in direction. Citi's Andrew Holdenhorst, Chair Powell did his best to give no new guidance.
So I actually did a bunch of searches about how often he said something like, Jared Powell said something like, I don't have anything for you on that today. I don't really have any response to that. I'll refer you to my statement. I won't give you anything additional to that. Pretty much most of the answers that people want, most of the questions that people want answers to. Are you going to stay on the Federal Reserve? What's your view about the independence of the Fed? How about that subpoena that is a requirement to resolve before we can get any additional members of the Fed confirmed by Congress? All of these questions, I don't have anything for you for that today. So right now we're looking at the economic backdrop, and that right now remains in a pretty even place.
Journalists did their best to make it interesting, and ultimately, Chair Powell was determined to make it boring, and he won. Equity futures right now in the S&P just about unchanged. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research as big tech lifts stocks to record highs. Angelo Zeno of CFRA with Mag 7 earnings in full swing, plus Claudia Sam of New Century Advisors as Fed Chair Jay Powell sticks to script. We begin this hour with stocks building on record highs and the dollar sliding. Ed Yardeni of Yardeni Research writing a weak dollar boosts the gains for US investors in overseas financial markets. It certainly supports our recommendation to overweight emerging market stocks. Ed joins us now for more. Ed, good morning.
Good morning.
Hey, it's good to see you. Is this a repeat of Q1 last year, the performance of the dollar and the performance in international equities?
Well, there's a bit of deja vu all over again, but in the first quarter of last year, we had DeepSeek hit the Magnificent Seven right from the get-go, and so that was actually a sell-off. This time around, the Magnificent Seven seemed to be kind of mixed, but on balance, they seem to be holding their own quite well.
And the Nasdaq has started to outperform more recently.
Yeah.
After the outperformance we saw previously in small caps so far year today, that started to fade.
It's kind of a bull market and everything, and so if something lags, it gets a chance to catch up.
How would you describe this regime that we're in right now? We've heard a lot of different things being thrown around, debasement trade, sell America, but to your point, I'm just seeing record highs all over the place. In metals, in equities,
it's just
worldwide.
a worldwide bull market. And I think that's because central banks across the board have provided an enormous amount of liquidity. We actually have some liquidity probably left over from the pandemic. I mean, there's, over $7 trillion of money market mutual funds. So, you know, if the Fed were to actually lower rates, that would probably continue to fuel this bull market. But it doesn't look like it needs any fuel from the Fed because earnings have been phenomenal.
Just if you develop that a little bit further, and this sort of builds on something that John's been talking about over the past couple of days, how much is the sell-off in the dollar a response to this sort of global bull market, and how much is it a response to debasement based on concerns about Fed credibility and based on policy uncertainty?
I don't really get all that excited about these general terms like debasement, because there's only, like a year and a half ago that The Economist was running cover stories about the exceptionalism of America, and then all of a sudden we're not exceptional anymore. I think there's still a lot of things that are exceptional about the U.S., but including the resilience of the U.S. economy in the face of all the shocks. But you know what? The global economy has held in there remarkably well also. And I think we are seeing people kind of take note that emerging markets continue to emerge. As a matter of fact, a global index shows that more manufacturing production now happens in emerging economies than in developed economies, and more exports. And so we aren't really it's not debasement, it's not deglobalization, it's kind of rebalancing of portfolios. So as the stock market goes up, people actually get more nervous that they've never made so much money and maybe it's going to take a dive. So they buy more gold, because gold and stocks tend to be inversely correlated. But on a trend basis, they tend to go in the same direction.
It's rebalancing on a lot of different levels. It's
Correct.
Rebalancing when it comes to the U.S. versus the rest of the world. It's also rebalancing with the financialization of U.S. markets and global markets going into the physical world. Right? We're seeing the actual capex continue to expand. Does it seem plausible that we can continue to see this expansion in capex without inflation, especially given some of the inputs from precious metals and actual base metals?
I hate to tout my own brand here, but I've been talking about the roaring 2020s since August of 2020, and maybe it feels like it, you know? I mean, come on, let's have fun here. And the reality is it's not all speculation. It's productivity, and productivity is really what's driving all this.
We're halfway through your year, decade, and decade target for gold.
Right.
Do you think we actually get there quicker, the 10K mark? And do you need to start rethinking about where you're pricing precious metal?
I'm running to catch up. I mean, I've never had an opinion on gold. I mean, I'm a strategist. I need something to value. So, however, when it crossed above 2,000 back in 2024, I said, you know what? It's really pretty simple. A lot of foreign central bankers have decided to buy gold after Russia invaded Ukraine, and we froze Russia's assets. So gold has been absolutely on fire since then. So when it got to 3,000 at the beginning of last year, I said, let's look at the charts. Probably 4,000 by the end of the year, got to 4,500, and I raised my target for this year from 5,000 to 6,000, and we're going to be at 6,000 by the end of the year or next week.
It feels speculative, though, at this moment. It feels almost like it's trading like a meme stock. Why is that?
Well, I think on a global basis, you know, Bitcoin and gold have a lot in common. It's hard to value them. It could be zero, it could be a million, whatever you want it to be. But in the case of gold, I think it's in both cases, it's a global market. People are buying it 24/7. And so I think there's a lot of geopolitical uncertainty. I mean, we've got an armada off the coast of Iran. We're still got issues in Venezuela. Meanwhile, there's been a purge of generals in China, and we don't know what that entails. And so if there's and the president has brought back the Monroe Doctrine with a Trump corollary. Well, how about the Putin Doctrine? How about the Z Doctrine? So I think there's a lot of geopolitical risk.
Given everything you describe, it's pretty impressive. Tens are still at 425, isn't it, in the Treasury market?
It's been amazing. You know, I'm kind of wondering where the bond vigilantes are. Oh, I know where they are. They're in Japan.
They showed up last week, didn't they?
Yeah, but you know what? I think they're kind of getting frustrated because they can't bring it down. They can't cause a crisis. Japan may be impervious to a bond vigilante attack, so maybe they'll come back here. But look, I think it goes back to the dollar. This is still a safe haven. So, you know, as soon as people get scared again about geopolitics, I think you'll see the dollar come back. And the administration, first the president says, great, the dollar's going down. And then Scott Bessent, his Treasury Secretary, says, we like a strong dollar.
I just want to get to that point. You still believe the dollar is the haven?
Absolutely. Absolutely. It's look, people have been saying, oh, the dollar's going down, foreigners are bailing out. And then the Treasury has monthly data through November showing that actually over the past 12 months through November, foreigners bought a record $700 billion of U.S. equities and a near record of almost $1 trillion of fixed income securities. So the data just doesn't add up with the myth that everybody's bailing out of the dollar.
Ed Yardeni, if Yardeni Research is going to stick with us, I'm right there with you, Ed. Some of these narratives at the moment, overly simplistic, I think, and failing to stand up to basic scrutiny when you look at the basic data.
There seems to be an incredible tension right now between the sentiment that people have towards some of these policies and some of the rhetoric coming out of the administration versus the tech boom, the energy in the consumer, and the growth that you're seeing in the United States that leaves it as a place so many investors feel like they need to be exposed to.
Stocks very close to all-time highs on the S&P 500. Futures up by about 1/10%. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. We're seeing Microsoft's shares falling 6.6% in the pre-market. The company saying spending hit a record while cloud growth slowed, fueling concerns over the payoff from its AI investments. CapEx in the fiscal second quarter hit almost $38 billion, up 66% from a year ago. On the flip side, Meta shares are surging 8% in the pre-market. The Facebook owner reporting fourth quarter revenue that topped analyst estimates and gave a strong forecast for the current period. The company projecting record spending in 2026, driven by CEO Mark Zuckerberg's aggressive campaign to amass AI infrastructure, computing power, and talent. And the Fed holding rates steady, marking the first pause in its cutting cycle since July. The decision was approved in a 10-2 vote, with Governors Christopher Waller and Stephen Myron dissenting in favor of a 25 basis point cut. Waller's dissent in favor of a rate cut is seen as keeping him in the race to replace Powell as chair of the Fed. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. More from Yahara later this hour in about 30 minutes' time. Up next on the program, dollar whiplash.
If we lost the world standard dollar, that would be like losing a war, a major world war.
Dollar's doing great. I could have it go up.
or go down like a yo-yo.
And that's exactly what it has done in the last 48 hours. Up next, Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Later this morning, 8:30 Eastern Time, jobless claims. Then, in the mix after the closing bell, a big earnings report after the bell. After the market close, we'll hear from Apple. Apple earnings a little bit later. Equity futures doing okay on the S&P 500. Positive so far this morning on the S&P by 0.1%, on the Nasdaq up by 0.15. In the FX market, the volatility of the last few days, euro-dollar, proving over the past few days that life above 120 is difficult at the moment. 119.48. Just think about the last two sessions we've had for the euro. The worst day since August and the best day since August, back to back over the past two sessions.
Yeah, and on what, right? Here's the question. Is it because some incredible data came out? No. Is it because of something substantial that happened in earnings? Nope. It has to do with comments coming out of the president about being okay with a weaker dollar, and this real question of why the knee-jerk reaction was so extreme, right? At a certain point, especially if Scott Bessent's going to come back and do his thing, we saw the strong dollar policy, why was there this whiplash in markets?
Euro-dollar 119.48. Under surveillance this morning, dollar whiplash.
If we lost the world standard dollar, that would be like losing a war, a major world war. We would not be the same country any longer.
It's hard to explain to people. The headline was, oh, Trump wants a weak dollar. Not a weak dollar.
Dollar's doing great. I could have it go up or go down like a yo-yo.
So here's the latest this morning. The dollar trading near four-year lows despite Treasury Secretary Scott Bessent's efforts to ease concerns about the greenback. With the latest, here's Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John, good morning. Well, as you just mentioned, we heard from the U.S. Treasury Secretary Scott Bessent yesterday, where he maintained that the U.S. always has a strong dollar policy. He added that the administration's broader agenda would help make the U.S. the, quote, best place to come, in his words, and said that efforts by the administration to bring down the deficit would contribute to the dollar strength over time. The thing is, our own analysts at Bloomberg assess that the Treasury Secretary's more measured response is unlikely to alter alter the dollar's bearish trajectory. And while we have heard competing views from President Trump, as you just played out there, our analysts also point to the fact that he has long maintained that a weaker currency could help drive U.S. exports and bolster those very industries that he has been really focused on, particularly domestic manufacturing. Plus, we know that a lot of issues are weighing on the currency, driven in part by the unpredictable policymaking here in Washington. Perhaps most notably, we know tariffs have been a big driver of the currency's weakness, and we've just seen in the past month a whole new slew of threats out of this White House, from allies like South Korea to even our NATO partners. Plus, I'll just throw in the fact that it is still unknown if we will avert a partial government shutdown this weekend if lawmakers are unable to reach a deal when it comes to funding by Friday at midnight. Though John knew overnight, a person familiar does tell us here at Bloomberg News that Democrats and the White House are inching closer to a deal, but at this point, it's just too soon to tell.
Tyler Kendall with the latest down in Washington. Tyler, thank you. The Treasury Secretary engaging in the conversation, the President engaging in the conversation, Chairman Powell having absolutely nothing to do with it in the news conference yesterday.
We don't control the currency. That's not our business. That's the Treasury. Don't look at us. I was actually a little frustrated that there wasn't a follow-up question. Well, if you do get a weaker dollar, does that import more inflation in a way that could potentially be something that you would have to address? At what point would you actually have to entertain this as something that you do take up, because it does have an economic factor? But, you know, no comment, and he got away with it.
And that's the playbook when you interview anyone at the ECB. The ECB is engaging in the conversation for that very reason. Ed Yardeni's with us now of Yardeni Research. Ed, let's continue that conversation. Does it have consequences for the outlook for price stability?
Absolutely. I mean, a weaker dollar does tend to be inflationary, and if the administration or if the president is saying, basically saying on balance, I mean, you have to kind of average all of his comments, but on balance, I think he does want a weaker dollar because he wants more manufacturing in the United States. So that's already having an impact on commodity prices. Commodity prices obviously are a leading indicator of inflation. So if you ask the commodity markets, not me, what the outlook for inflation is, it's coming back.
Financial conditions are easing.
Very easy.
The administration is going to boost potentially more fiscal stimulus. We're going to see that in tax refunds maybe in the next couple of months. And then you've got the dollar story on top of that. And everyone's talking up a better growth profile. Yet, still not in the consensus is this idea that inflation is going to pick up, and I'm surprised by that.
Well, there's a lot of moving parts here. I think that actually inflation is going to go down. Doesn't mean that I'm going to be right. It doesn't mean that isn't going to be a concern in the market about inflation coming back. But I'm a big believer in productivity. I think the productivity story was awesome last year, and I think it's going to continue to be surprisingly strong. And productivity is like fairy dust. Everything's better growth, lower inflation, better real wages, and better profit margin.
And to Jonathan's point, though, we are going to have a lot of fiscal policies coming out
Stimulus,
of Washington. Yeah, not just the tax refunds, but this is an election year. The administration's going to run it hot. So why do you think inflation is actually going to come down?
Well, there are inflationary forces like the weak dollar and the fiscal stimulus that you mentioned. The fiscal stimulus obviously is one of the reasons why the economy is so strong. In addition, the consumers held in there because the baby boomers are retiring and spending a lot of money. So the demand side of the economy looks great, and it's going to be even stronger with the fiscal stimulus, and that could be inflationary, certainly. But if you continue to have a relatively quiet employment market, then the implication is that productivity is extremely strong. So I would just say, with all the factors, all the moving parts here, and the yo-yo of arguing inflation is going to go up or it's going to go down, I'm in the camp that thinks that inflation is going to be surprisingly low this year because productivity is going to continue to be surprisingly strong.
Tyler mentioned the fact that the president just this week was talking about increase in tariffs on South Korea. Do you think the market has just completely blown past that story and it's no longer of interest almost?
Yeah, the market has its own resilience. You know, I've been doing this for a while, and what I've learned over the years is that the markets, the stock market and the U.S. economy have done remarkably well despite Washington. And in the current situation, I think you have to keep your eye on the prize, and the prize is productivity is creating tremendous resilience for the U.S. economy, which in turn is creating remarkable resilience for earnings. And earnings are at a record high and going higher.
The headline for my dinner tonight with my children is productivity is like fairy dust. And then I'll say, discuss. I mean, to me, I guess that the ultimate question is for who? And you just led to it, which is earnings. It's not necessarily for people who might be losing their jobs. And we've seen announcements from Home Depot cutting 800 corporate jobs, Amazon cutting 16,000 corporate jobs. This has to do with how people feel, sentiment. It has to do with politics. I mean, how does that factor in to how this goes?
I think this is one of those kind of historic transition environments that's resulting from the technological revolution, digital revolution. And there are certainly people that are losing their jobs because of the improvements we're seeing in technology, and that's obviously hurting. But you know, it takes a couple of years, but I think we're going to be amazed at how resilient American workers are, and they're going to reinvent themselves. One of the things that's just astounding to me is that we had over 5 million business applications, new business applications last year, all-time record high. So I think a lot of people are saying, you know what, I'm not going to try to get a job in a company. I'm going to start my own business.
Right now, looking at this backdrop, why would anyone want to invest in debt over equity? Because it is a growth picture that is being juiced on all fronts for the equity picture. Right. And on the debt picture, they're only going to incur more debt to try to ameliorate some of the concerns in the average population that do not feel these gains, the fairy dust.
Well, it's really, it goes to our previous conversation about rebalancing. As the stock market goes higher and higher, as gold goes higher and higher, people are enjoying the gains. But on the other hand, they get a little bit queasy about, you know, getting too close to the sun, like Icarus. His wings kind of melted off. So they tend to start to rebalance. And so they will rebalance. I mean, why are we have a record amount of money in money market mutual funds? A lot of people are missing a great rally in gold and in stocks. Well, maybe not. Maybe they are enjoying those rallies, but they also say, you know what, I got to have some liquidity here just in case things don't go well.
Bridgewater, by the way, agrees with you. Stocks over bonds.
I think a lot of people agree with us. We've been talking about that for a while, and people are saying in this pro-growth environment, why would you want to own the thing that people are only going to issue more of and then it's getting less valuable? And that ultimately seems to be a bet that's playing out.
Yeah. AI is covering a lot of cracks. Let's put it that way. Anne-Marie talked about the threat of tariffs on South Korea. The Kospi this week is up by almost 5%, and it's up by 24% year to date.
Thank you, Samsung.
Massive movement.
Massive,
One other name in the mix as well. Just feels like that's the story of the moment. My big takeaway from the Fed program yesterday was Diane Swonk, KPMG. She's talking up an economic boom that could come with a payrolls recession. Just think about that. How do you set policy for that? An economic boom with a payrolls recession.
I mean, the initial claims data looks great. I mean, initial claims have been coming down. So layoffs are actually going down. Maybe the Amazon news is going to affect it in the week ahead. But Amazon, I think, is talking about global employment. It's not like all those 16,000 jobs are necessarily going to be lost right here in the United States. So I think that I think the payroll situation is going to be surprising to the upside.
I hope you're right. Ed Yardeni, of Yardeni Research, this is a week where we're talking up growth north of 4%, maybe 5%, and yet consumer confidence is rock bottom. It has never been lower in the last decade.
And this has to do with the fact that people are not feeling it yet. And they're seeing the layoffs, they're seeing the inflationary impacts, the year over year, the 5-year over 5-year impacts, and it's weighing on them. How do you set policy? You asked this question, no comment. I don't have anything for you on that. Not going to really go there. Look at my statement from last month.
I know there's an industry in criticizing the Federal Reserve, but given the president's comments, the chairman's comments a few weekends ago, he took on the White House in a way we've never seen before in the modern history of the Federal Reserve, and wasn't prepared to answer some basic questions about why. And I think we need to follow up on that.
I think he will be continuing to ask that question. Let's see when he has a follow-up.
Up next on the program, we'll catch up with Angelo Zeno of CFRA as Meta and Microsoft ramp up AI spending.
have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Snapping a streak of 5 days without losses on the S&P 500 yesterday with the smallest of losses in yesterday's session. Futures bounced back by 0.1%. The rally continues on the Nasdaq. 6 consecutive days of gains on the Nasdaq 100, the longest winning streak going back to September. For the year so far, some outperformance for the Russell, the small caps. That outperformance beginning to fade over the past few sessions. Let's keep an eye on that. This morning, some outperformance on the day, up 1/3%. Let's turn to the bond market. Bit of a snooze in the bond market right now. 2s, 10s, 30s, 10s at the upper end of the range for the year so far. 425.12 and 2s anchored around Fed policy. That Fed is going nowhere anytime soon. 356.93 on 2s. And in precious metals, this move right here, gold, absolutely flying year to date. Gold up another 2%.
Honestly, it just raises this question of how vulnerable is this trade? And I know I'm sort of going against the grain here, but at a certain point, liquidity starts getting really thin. And then if two people over in Asia buy gold, suddenly that kicks up the price significantly. So you start to wonder how sustainable this is if institutions are pulling back to some degree from some of the daily trade.
What's hilarious is these year-end price targets we've already gone through. Goldman, just at the start of the week, changed their year-end target to 5,400. Now we're past that. So I think they need to recalibrate where they see this precious metal
So
going.
you've all heard that story about the debasement trade, Sell America, all of that stuff. We talked about this over the past few days. This is also pretty consistent with a pickup in global risk appetite. You see that in copper, trading close to record highs. You see that in the Kospi with an AI twist. South Korean equities, record highs up by more than 20% year to date. You see it in foreign exchange, the Aussie outperforming a G10 over the past 12 months. Caterpillar just dropping earnings. EPS coming in at 516, the estimate 469. Revenue for the fourth quarter in at $19.13 billion, the estimate 17.91. That is an upside surprise.
And you're seeing the shares jump some 5% in response to that. Their machine power and energy revenue also coming in almost 20% year over year. When you start talking about this, the physical world is having its revenge. And what you're seeing is people right-sizing their understandings of how much more equities have to rise to match that. In bond markets, they've been punched across the face with so many different headlines that they're just in a stupor of malaise. I mean, honestly, the MOVE index is going nowhere. So the excitement is really in equities. The excitement is in the real world. It's not necessarily in the debt profile.
We have some problems in the real world. There is no doubt about that, but it's being insulated by some massive spending taking place at the moment. Caterpillar is up by more than 5% of the pre-market. As we count you down to the opening bell, let's get you some more single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Well, we have some clear winners and losers in the tech trade this morning. And we start with Meta, the clear winner, up 8% in the pre-market as it gets a pass to ramp up spending, wrap up CapEx, up to $135 billion worth this year because the payoff is already starting to show up. On the call, executives were pointing out how ad targeting is getting stronger. Meanwhile, Microsoft not getting the same pass. Shares are down nearly 7% in the pre-market because it's facing scrutiny for its record CapEx since Azure did slow. It did slow from the prior quarter. Meanwhile, that CapEx spending spree isn't just affecting tech stocks, it's also causing a metals boom. We are seeing shares of Freeport-McMoRan up 4.6% and Southern Copper up 4%. And moving on to SAP, the German company, those shares are plummeting down nearly 15% after missing expectations on its cloud backlog. And the timing really matters here since software stocks have been struggling as investors worry that AI is upending their business model. John?
Yahara, thank you. Thanks for the update. More from Yahara in just a moment. On our radar this morning, talks to avert a government shutdown gaining momentum ahead of today's vote in the Senate. Sources telling us here at Bloomberg the Trump administration is moving closer to Democrats' demands over homeland security funding. Elsewhere, NVIDIA, Microsoft, Amazon reportedly discussing plans to pour billions into OpenAI. According to the information, these investments are part of a massive funding round, which could value the ChatGPT maker at over $750 billion. And finally, Tesla, discontinuing its Model S and Model X EVs, clearing factory space to build humanoid robots. This coming as part of a $20 billion AI push that includes a $2 billion investment in Elon Musk's XAI startup.
This, to me, is actually really important. This marks, as one analyst was saying, the transformation of Tesla from an EV maker into a robotaxi, robot, and electronics company. And I think that's really important, along with their announcement that they're looking to build a factory. They need to create more of some of these chips to really go into a lot of their different products. Look, this is the future. He's talked about this. People are not talking about the fact they actually beat expectations. This isn't to try to mask some sort of underlying weaker performance than expected. This is sort of the hopes and dreams of the next phase after the EV industry has faced a lot of issues and a lot of competitive.
And when it comes to the chip making, he wants to do it here in the United States. You talk about the physical world. That is the build out. Everyone is pretty much why you see these valuations so high and everyone pouring into the stock market. It's the physical build out all these companies are talking about. Steve Mann, an analyst on this, was talking about everything they've almost wanted and have heard about for years from Tesla. They're finally seeing it on paper, and they're finally seeing it come to fruition. So for Elon Musk, when it comes to robots, autonomous, they actually see the next chapter beginning, when for a while it was very much, maybe next summer, it's now real.
Do you think they can find a partner in the White House?
Yes, I think so. I think they can. I think that they're not bromance anymore, you know, but I wouldn't say they're enemies. I think they've hatched things up.
Tesla right now up by about 2.8% of the pre-market. Let's stick with tech. Meta, Microsoft reaffirming commitments to record AI spending. Wall Street rewarding one tech giant, punishing the other. Angelo Zeno of CFRA has a buy rating on Meta and a strong buy on Microsoft. Angelo joins us right now for more. Angelo, a lot of spending, two very, very different looking price moves in the pre-market. What explains the difference between Meta and Microsoft?
Yeah, John. So I would say, first off, we're not surprised by the higher than expected spending from these companies. I think most anticipated that going into the print here. I would say Meta's spending definitely even more than we anticipated. But that being said, at this point in time, you're looking at a guidance of essentially 30% top line growth here for Q1, and that really is what explains it, right? This is a case where it seems like Wall Street is willing to bid your stock higher if you're showing the top line growth. And it's really phenomenal in terms of the type of growth you are seeing at Meta at this point in time, and really kind of demonstrates the fact that, hey, listen, maybe all these investments that Zuckerberg has made here over the last year is starting to pay off. I think Zuckerberg in many respects is treating his company like a startup, pumping a ton of money into it. You're looking at capital intensity ratio now close to about 45 to 50% in 2026. So we've got some enormous spend going on here. We'll see what the products look like as they trickle through 2026. But as we kind of look at the performance here, at least for today, the street likes what they say.
A $1.6 trillion startup. It's not bad, is it, Angelo? Yeah. I want to talk about Microsoft. Sometimes sentiment is just shaken, and there's a dark cloud that hangs over a stock and an ecosystem. Software names at the moment, Angelo, to Yahara's point, are struggling. What's behind it?
Yeah, I mean, and when you look at Microsoft, right, they are the king of the enterprise king of software in many respects. But whether it be ServiceNow that reported last night, and SAP, and others that are probably going to report this earnings season, and just the numbers we've seen over the last couple of weeks, there's just a dark cloud over the SaaS space. And as far as what we've seen from Microsoft posting the December quarter results, the March quarter guide, it was very solid in nature. And if there's a company that could navigate some of the uncertainties that are out there, and where the enterprise space should continue to buy their offerings, it should be on Microsoft's side of things, right? So we do think that Microsoft is well positioned to navigate some of the uncertainties, the low visibility across the SaaS space here over the next couple of years. But nonetheless, that's just the narrative that's going on right now. There are other negatives, I think, from the print here in the December quarter, whether it be the higher OpenAI concentration risk, whether it be the lower expected cloud gross margin guide for the March quarter. I think some of that also seeping into the negative reaction you're seeing from Microsoft.
Angela, let's dig into both of those things. This question around just the cloud computing growth and the pace that seemed to miss some of the more lofty estimates, and the dependence on OpenAI. There was one stat for the first time Microsoft disclosed that 45% of a $625 billion book of future cloud contracts was from OpenAI. How much of a concern is this to you, this concentration risk in the likes of Microsoft?
Yeah, I mean, I think it's something you've got to be mindful of. But, in the same respect, their non-OpenAI RPO is still growing at a fairly healthy clip, I think at about 28% or so in the quarter. It's going to be lumpy here over the next couple of years. I do think that 45% figure, while large in nature, likely comes down here over the next couple of years. So yeah, I mean, on the surface, it's concerning. I don't think it's as concerning as a Oracle type of situation. Clearly the fact that the Microsoft, if they don't get it from OpenAI here over the next couple of years, should see it from other enterprise-related vendors. But nonetheless, yes, I mean, on the surface here, the narrative again is one where the street is very concerned about OpenAI at this point in time. I do think that funding round will probably help the narrative in terms of the cohort of names tied to OpenAI, like a Microsoft. So again, we have to wait and see.
With respect to the Azure side of things and the cloud computing, how much is this an issue that Microsoft just can't meet the incredible demand as quickly as some people would have hoped? And how much is this truly competition from Alphabet or from the likes of Amazon that both report next week?
I personally think it's more the supply constraints. I mean, they did highlight the fact that, hey, listen, they could have grown their numbers north of 40% if they had the supply. So, so I do think it is more supply constrained in nature. But, in the same respects, this is a company that's going to see also much more difficult comparisons on the Azure side of things over the next couple of quarters. 2 quarters from now, you're going to have to lap numbers like 39% year-over-year growth. So I would expect the numbers to potentially even decelerate further. Let's call it into the mid-30s range as we kind of progress through the year. But nonetheless, I mean, these are still pretty phenomenal type of growth numbers from Azure. And in fact, they actually ended up beating our expectations.
Just taking a step back, what caught my eye overnight was Jensen Huang talking about how we don't have the energy. Potentially, there's going to be constraints in Taiwan when it comes to chip making into the United States and into Europe. Are these CapEx numbers so big that actually the energy demand, the physicality of building it out, doesn't actually work yet?
I mean, well, we've got to see. I mean, at this point in time, energy bottlenecks are clearly a risk out there. I mean, I'd say personally, at this point in time, the street is probably more concerned about some of the memory bottlenecks. And to be honest, I mean, when you start thinking about the higher planned CapEx plans, it probably takes into account some of the higher boost in memory prices as well. But as far as the energy bottlenecks are concerned, it's going to get lumpy in nature here. There are going to be more challenges and uncertainties. I think that's going to be more of a 2022, second half of 2027 event and thereafter. But nonetheless, definitely something to be mindful of.
Just as a market analyst and a market participant, Angela, you've witnessed markets for a long time. If we can get away from these names just for a moment, I think Lisa's doing a great job this morning of talking about the constraints in the physical world. Do you think that's the trade so far of the year, that people are just chasing that story, cross-asset?
I mean, it seems to be. I definitely think there's definitely something to be said about that. You kind of look at really where the narrative is across the tech ecosystem, right? It continues to be a pile up in a number of these chip-related type of names that would benefit from that physical AI world. as well as hardware-related names as well. So yeah, it may not be as exposed to some of the constraints tied to memory. But nonetheless, I mean, you kind of look at the play here, at least across the tech ecosystem, and it would support that thesis here. And I don't know if it lets up here. In the near term, you'll definitely get some choppiness. But over the next 3 to 5 years, when you start thinking about the shift toward an AI world, it is going to be dictated more on the physical AI opportunities, where there's also greater uncertainties tied to this SaaS-oriented trade, and we've kind of seen this accelerated shift away from SaaS to kind of the more chip-making related names here, even over the last couple of weeks.
Angelo, good to see you. Angelo Zena there of CFRA. Caterpillar a little bit earlier on this morning. Great numbers about 15 minutes ago. Copper on my commodity screen on the terminal right now. Copper up by 6%. These moves are just popping up all over the place.
And it just shows that the race to achieve enough capacity to really meet demand is the main constraint for so many of these. Apple, after the bell today, how much is the focus going to be on how much more they're having to pay for some of the chips that go into their smartphones and how that's eating into margins as they try to keep prices within a range? It is the physical world that keeps coming back and biting a lot of different companies.
That's the next big earnings report after the closing bell. Elsewhere, let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. UK Prime Minister Keir Starmer calling for a more sophisticated relationship after a meeting with China's President Xi Jinping. Starmer's visit to Beijing marks the first of its kind in 8 years. Xi adding China will consider giving UK citizens visa-free entry in a sign of thawing relationships between the two countries. Starmer is scheduled to travel to Tokyo before returning to the UK. Meanwhile, Deutsche Bank reporting a record profit for the year with higher trading income and a new share buyback. The results, though, are being overshadowed by a raid on the bank's headquarters. It's part of a money laundering probe looking at past dealings by staff with firms linked to Roman Abramovich. Deutsche Bank says it is cooperating fully with the investigation. And you mentioned this, Caterpillar shares are up 3.8% after delivering an earnings beat for the fourth quarter. The construction manufacturer reporting a revenue beat with more than $19 billion. That's an 18% year-over-year increase. The company's CEO saying, quotes, "These results demonstrate the strength of our end markets and our disciplined execution." That's your Bloomberg Brief. John.
Yahara, thank you. Thank you very much. Up next, risk coming into balance.
In the labor market, indicators suggest that conditions may be stabilizing. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. We'll find our way forward as the data evolve.
That conversation up next with Claudia Sam of New Century Advisors, live from New York City. You're watching Bloomberg TV.
Is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Two mega-cap tech names to look at in the pre-market, Meta and Microsoft, both putting up massive spending numbers, but one impressing more with actual growth relative to expectations. Guess which one? Meta up by 8%, Microsoft down by more than 7%. If you push this into the equity market at the index level, equity futures doing okay, up by 0.2%. The NASDAQ just about positive, up by 0.16%. That was the headline yesterday. It was after the closing bell. It was not the Federal Reserve. Under surveillance this morning, risk coming into balance.
In the labor market, indicators suggest that conditions may be stabilizing. I think that the upside risks to inflation and the downside risks to have probably both diminished a bit. It's about how you weigh the risks to the two goals and how big those and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
So here's the latest this morning. The Federal Reserve hitting pause on rate cuts for the first time since July, pointing to a steadying labor market and improving economy. Claudia Sam of New Century Advisors writing, there are reasons to be cautiously optimistic about the labor market, reduced rates, fiscal support, and solid consumer spending. Claudia joins us now for more. Claudia, it was the least anticipated Fed meeting in quite a while. In that regard, Chairman Powell did not disappoint. It was an absolute snoozer. Claudia, they seem to have this confidence in the outlook, a better outlook. How much weight should they put on recent data?
Right. Well, I think there was cautious optimism, right? There was a path forward where there's stabilization in the labor market that had been what had motivated the cuts before, concerns about the labor market. So there are some signs, didn't want to overplay it, but some signs. And Powell did sketch out a path for inflation to start turning back down. But there wasn't full conviction, right? There wasn't, enough conviction in that outlook to actually see cuts. They're still going to want to wait and see the data, but Powell is painting the picture of further progress on inflation, further potential cuts in rates, just not yet.
Claudia, there was an element of that meme where there's someone sitting in a room saying everything is fine and there's burning all around them. This question of all the questions that he wouldn't answer going forward. I mean, can a Fed give forward guidance if there isn't a sense of who is going to be the next Fed chair and what some of the response are to some of these pretty significant questions that were asked about Fed independence, about the dollar, about a lot of other issues that were, I have no comment, I've got nothing for you for that.
Right. So in terms of the questions about, the investigation from the Department of Justice, the Supreme Court hearing on Lisa Cook, those are questions the Fed will be answering. We should remember the press conference is really a window into the 2 days of deliberations about the monetary policy decision. He really needed to keep it to the economics because that's what they talked about for 2 days. Soon, Powell will be going to Congress for his semi-annual Humphrey Hawkins hearings, and that is absolutely the appropriate place to be answering these questions about politics. Powell even gave a hint to it in very Fed speak where he said, Congress is the window to democratic accountability for the Fed. That's where the Fed goes and has to answer those tough questions. So we're going to hear more on that. It's just trying to get the timing right and the form right. Yesterday was really for him to speak for the committee on these deliberations, and I think he did a good job on that. But, the politics are there, and they're going to have to address this more fully.
There was another issue, another aspect of this press conference, and frankly, the decision more importantly, and that is one of the dissents. There were two dissents. One of them was Chris Waller, the Fed governor who is in contention to be the next Fed chair. Did you see this as a more political type of dissent, or one that actually did come with consistency in terms of some of the rationale in previous decisions?
So I expect that we'll hear from Governor Waller for his thinking on his dissent, but it does fit a pattern. Waller was early to sound alarms about the labor market. He may be late to saying all's clear or signs are clear. I think it would be very consistent for him to still have concerns about, how much stabilization really is there in the labor market, and concerns on that front. And also this piece about the inflation outlook. I mean, Waller is a forecaster to the core. He may have more conviction that those tariffs, we've seen the tariff rates that are there. We're going to have a textbook case of them rolling off. And he feels like it's worth going ahead and pulling some more restriction out of the economy. So I think there's a clear economic case that is consistent with not just Waller of the past year when he's been in potential running for Fed chair, but really Waller over his whole career. So I would really be hesitant to jump to the politics in this moment.
This is consistent, but to the same time, he is in the running to be a Fed chair, and we immediately saw his chances spike up because of that. Do you think, because he did dissent, that actually his chances are in fact better today than they were 24 hours ago?
I have no insights on who will be the next Fed chair.
I mean,
really, the market, prediction market response, that makes a lot of sense. And yes, he's pushing for cuts, but, this has been a really complicated process. The president clearly has, struggled to kind of come up with the person that he wants to see in that Fed chair position. I think, big picture, we should step back. Yesterday, it was a 10-2 vote in terms of pausing. The Fed chair is not the swing vote on the committee, right? Whoever goes into that position, there would have been a pause yesterday. So I think, I understand the speculation and maybe it did help Waller's odds yesterday, but we want a Fed that's focused on the economic conditions and making its decisions, and pulling the politics into it any more than is absolutely necessary. It's a really risky path for us to go down.
Claudia Salm of New Century Advisors. Claudia, thank you. Appreciate your words of confidence in the governor, Chris Waller. He has such an extensive, deep, credible body of work that he deserves the benefit of the doubt. If he wasn't in the race, would he still vote for this rate cut? Based on recent communication, probably. Based on the interviews we've had with him, likely. He's worried about this labour market. And guess what? Consumers are too.
Yeah.
They're telling you in a recent survey.
Yeah, and he's been saying you've got to follow what they're doing, and you start to look at some of the job cut announcements, and that would seem to fortify it. The bigger question is, why didn't Stephen Myron go for 50 basis points? Because that seems to be his modus operandus. I mean, honestly, sort of interesting. Maybe he's out of the race.
I also thought of that. But Neil Dutta says this does keep Waller's chances alive.
I'm sure it does.
In the Apprentice Fed edition.
I'm sure it does. And we get another, how many episodes?
Multiple, I think.
Right?
Yeah.
Maybe a few more seasons.
Yeah, true.
This is going on for weeks and weeks, months and months. Tom Becker of BlackRock joins us next. Jeanette Lowe of Strategas, Krishna Gua of Evercore, Matt Hornback of Morgan Stanley. The second hour of Bloomberg Surveillance, just around the corner.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
The game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
This is going to be, as we all know, a really interesting week for tech.
It's more about tech than it ever has been.
Investors are starting to demand a little bit more.
Anytime you have a technology shift, you're going to have big winners and big losers.
The big question is, can we still see the degree of margin expansion out of the tech names?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your price action looks like this. The rally resumes. Equities on the S&P up by 0.2% on the S&P 500. Likewise on the NASDAQ 100 up by 0.2. Later, a big afternoon for the NASDAQ and big tech. Apple reporting after the closing bell. Later on this morning, about 90 minutes away, another read on the labor market. Jobless claims in focus at a time where Chairman Powell is encouraged by the recent data.
Honestly, what will jobless claims actually mean at a time where you might see a low firing rate, but the hiring rate is so low? There has been an absolute somnolence in the jobless claims. It has remained around 200,000 for a long time. A real question of what kind of signal comes from this at a time where the labor market is not cohering with the growth profile that we're seeing in this country. I mean, really, that is one of the key conundrums and features of this particular growth picture.
GDP sky high, payrolls growth super low, rock bottom. There are reasons for that on the supply side. We've talked about them extensively, but there is something else going on here. Attitudes to the labor market are pretty negative right now if you survey consumers. I keep going back to the words of Diane Swank of KPMG just yesterday. Diane Swank is talking up the prospect of an economic boom with a jobs recession. Now, to get philosophical, what is an economic boom if there is a jobs recession?
It means Home Depot is cutting 800 jobs. It means Amazon is cutting 16,000 jobs as they look for efficiency and try to shift into other things. Productivity is the fairy dust. That's what we heard just earlier from Eddie Ardeni. A fairy dust for who? For profitability, not for sentiment, for people who are concerned about what their future looks like.
We're just insulated, flattered by massive spending coming from some of the biggest companies on the planet right now. We saw the CapEx figures yesterday. You're seeing it in copper this morning, up 6%. You see it in the numbers from Caterpillar, upside surprise after upside surprise. You're seeing it everywhere at the moment.
There were decades where rates were around zero and it was a financialization of the world. This is the revenge of the physical world in every which way. CapEx, metals, everything. You need to actually create a world that can match some of the hopes and dreams that are coming from the AI space and technology. Question is, what does that look like in terms of inflation? What does that look like in terms of jobs growth? And what does that look like in terms of some of the financial instruments that are funding it, including, for example, debt?
And also you have Tesla coming out saying they want to make a domestic fabricator. They want to make chips inside the United States overnight. Jensen Huang is in Taiwan. He's talking about the fact that actually what we're trying to do, there is not enough energy for it right now. Not in the United States, not in Taiwan, not in Europe. Maybe in China, because they have been hoarding minerals and energy for decades. But in the rest of the world, this is going to be a real constraint, a real problem.
Speaking of energy, there is a big rally developing in crude so far this week, kind of under the radar and not talked about much. Guy Johnson out of London doing a fantastic job early on this morning, going through some of the moves, I think up 6% so far on Brent and WTI. Yes, there's an Iran story here, but there are consequences with Brent back to 70 and WTI up to close to 65 on my screen.
Yeah, some of the highest levels that we've seen since last September as that armada gets closer to Iran, and there's this question about what kind of disruption there could be. This is sort of the one aspect of this whole upswing that we've seen in growth. It has come on the heels of lower gas prices. If that changes, how much does that potentially eat into some of the narrative?
And lower gas prices are certainly needed right now for this economy, especially when you look at the conference board, how individuals are struggling still, they say, with everyday goods and prices, and electricity prices, especially in this cold front, are so much higher. At the minimum, you need the lower gasoline prices. And right now, with Brent ticking a little bit higher, that's going to make that story a lot more challenging.
We've said this a few times. Tax refunds, stimulus for the utility companies. We've got to pay some big bills in the next few months.
Which is the reason why there's an increasing focus in getting some of the AI companies to pay them. But yeah, if you look at energy prices and how much they've increased when it comes to electricity, and I'm telling you right now, kids are cranking the heat, and I'm not pleased about it.
Yes.
You sound like my dad
when you leave, do you
visit.
turn the thermostat down?
You have to turn it down. 60.
Even though you leave the kids there, 60.
I think
60.
it helps people sleep better.
My goodness.
Get used to it.
Okay, all right. Coming up on the program.
It's brutal.
Tom Becker of BlackRock as big tech fuels the equity rally. Jeanette Lowe of Strategas as Democrats demand an ICE overhaul. And Krishna Gua of Evercore as Chair Powell insists Fed independence is intact. We begin this hour as the stock rally resumes as big tech ramps up spending. Tom Becker of BlackRock writing, the finance literature is replete with historical episodes of capex overinvestment. We are neutral, directional stocks with reduced exposure to U.S. equities. Tom joins us now for more. Tom, good morning.
Morning, John.
Is that what this is? A massive overinvestment spree?
Some of it is going to likely be overinvestment. I think a lot of it is very valid investment. So the great power rivalry, that's happening separate from the AI build-out. You've got multiple companies that are competing to kind of be the next winner of the AI race. So they're all building kind of the supply that they need. And if it's a duopoly or a monopoly in the end, and you have 5 companies, 6 companies globally all investing to kind of be the winner, you can potentially have a setup in a few years where it's sort of like Global Crossing, where you build all this capacity and all of a sudden, the price of the capacity drops. That's great for society. It's great for the economy. But I think we're kind of still early innings in that investment cycle.
What do you think the stock market opportunity is right now?
So we're neutral on directional stocks. We think the dispersion is much more interesting. What you were just talking about, kind of is flat, chips up a lot, metals up a lot. You've got countries year to date, Korea's up 25%, Germany's flat. So the dispersion that we're seeing in country equities as kind of these terms of trade shocks, as these competitiveness shocks, as the tariffs kind of bite for some of the companies that are trying to export and don't have a leg up anymore. We think that's where we can really kind of add value to portfolios, is sort of playing for the winners versus the losers.
I want to dig into this idea that you were just talking about, how it's sort of this overbuild, or at least building very quickly, to pay whatever you need to pay in order to get capacity to meet demand. Who do you think is most susceptible to overpaying in the short term for something that will become increasingly commoditized in the long end? Is it the hyperscalers? Is it some of the other potential tech players?
I think it's super unclear how it shakes out. Typically, Jensen said, the cost of the compute keeps coming down. The demand for it keeps rising as kind of companies look for new ways to deploy it. But then there's the parallel set of investments related to kind of the NATO expansion, U.S. versus China. You've got, real going in the ground for factories, but also the armament for kind of duplication of different countries that, felt like maybe they had an alliance that was a certain way and now they want to have their own means of production. And so I think all of it is going to play out over multiple years. And so we're still, the capex is what's driving the cyclical growth. And like you were talking about, the consumer may not be happy with the high prices, but they're still spending. And I think the companies are still going to be competing to win. And so it's the competitive spirits, I think, across countries and across companies that's going to, propel growth.
How do you identify winners in terms of regions? Do you just follow government spending? Do you follow, in terms of what kind of stimulus each government wants to provide to their sector?
Yeah, so 10 years ago, we were in a very dominated environment, and so you really cared about what every central banker was about to say, and rate differentials at the front end were what it was all about. It really is the amount of fiscal insights added to portfolios in the last 5 years. It's been the whole research agenda has been understanding where the deficit's going to rise, where the country's going to term it out versus issue at the front end, where is the spending have a higher multiplier versus a lower multiplier. So tax cuts, some of the OBBA is going to go to consumers. That's a pretty high multiplier. The corporate tax cuts are a lower multiplier. So one is going to be more the financialization you were talking about, Anne-Marie, and the other is going to be kind of another stimulus and injection into the economy. Similarly, in Germany, it took them a really long time to kind of ramp up. It's a year on, and now they're finally saying, okay, you can spend some money on this, but it's coming. And so last year was a bit of a fiscal pullback, and this year you've got kind of a coordinated developed market fiscal thrust. Japan with kind of the consumer tax cut. There's just a lot of fiscal coming back into the system when growth is accelerating.
And at the same time, the dollar is weaker. Has that changed how you're thinking about where you should be allocating money?
We've been underweight dollars for a couple years. We think kind of the global rebalancing that's coming with kind of some of the changes in trade balances. So under the old system, everybody was kind of trying to keep their exchange rates undervalued and sell their exports to the U.S. consumer, kind of the consumer of last resort. And they wouldn't recycle their revenue back into their own currency. So they're all keeping their currencies low, keeping their financial assets in the U.S. We think the incentives here with U.S. hedged yields being really unattractive to foreigners, other yield curves being really steep and attractive. In Japan, why would you buy a hedged treasury? You can just invest in a dislocated, 20 or 30-year government bond. Same thing in Europe. And so we think some of the pullback of kind of that old order of kind of recycling surpluses back into U.S. financial assets, that's just going to moderate, and that's going to be kind of pressure on the dollar to just equilibrate lower.
And I'm guessing you didn't hear anything from the president that made you think that he's going to come out and get in the way.
I think, so you heard something from Jay Powell yesterday, which is
Treasury
the Treasury.
I think we heard nothing from him.
Well, the first 4 or 5 questions, you heard nothing. And then he got going. But I do.
Sort of. Sort of. It was boring.
I do think kind of where the dollar settles for kind of U.S. competitiveness is really first order. And so, tariffs are part of the agenda, but a weaker dollar is also part of the agenda, I think.
I know this is exhausting, but when was the last time markets were this interesting?
It's super interesting because the dispersion is very domestically oriented, kind of that fiscal question. Countries are trying, it's the Carney speech, right? So you've got countries trying to decide, how am I going to navigate this? I'm going to change some of my domestic policies. I'm going to make some alliances. I'm going to make some trade deals. You've got kind of, corporate champions that are being played by different countries to try to kind of bolster their domestic outlook. And so I do think the dispersion is really much higher.
The character of financial markets has changed as well. I'm finding it absolutely fascinating. These used to be cyclical bellwethers, things like Caterpillar, Copper, the Kospi, South Korean equities. Now they're secular stories. And it's really confusing. Payrolls used to be a fantastic macro indicator that influenced people's views on how the equity market would trade. Hopeless in the last 12 months. It's driving the Fed, sure. Hasn't really driven equities at all.
If you just take that one step further, the Fed used to be a big macro indicator. Now it's the earnings from Microsoft and Meta, even more so. And so it raises this question of how do you get signal from noise at a time where all the signals are changing and the noise is mounting? And that, I think, is what people are looking at, these specific stories, the fiscal, the specific national champions.
Then you've got this big spread opening up between growth and how people feel about that growth. The tension in between is where the politics is playing out, the remedies being introduced to address that. It's a pretty crazy time, let's put it that way. Tom, it's fantastic to see you.
Good to see you, John.
Thanks for dropping by. Tom Becker of BlackRock. There's so much to think about in this market. I have to say it's the most interesting financial market for me, never mind the pandemic, maybe since the Eurozone debt crisis. Different moment, but really interesting moment.
It's a transformative moment, one that historians are going to look back on and really pin an entire new regime. And we talk about Bretton Woods Accord. This is going to be that type of shift on a whole global scale.
Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Comcast reporting a higher than expected drop in domestic broadband customers in the fourth quarter. The telecom giant says it lost 181,000 customers, a 30% dip versus a year ago. Comcast's streaming service Peacock also missed estimates. Shares are in the green. Meanwhile, Tesla shares are also in the green, up 2.3%. The EV maker announcing $20 billion of spending this year to streamline its EV lineup and shift resources towards robotics and AI. Elon Musk's company is discontinuing its Model S and X vehicles. It also plans to invest about $2 billion in Musk's xAI. And NVIDIA, Microsoft, and Amazon are in talks to invest as much as $60 billion in OpenAI as part of a new funding round. That's according to the information. The startup is looking to raise at least $50 billion in the round at the valuation of up to $830 billion. That's your Bloomberg Brief. John?
Johanna, thank you. Appreciate it. I'm next on the program, negotiating in Washington.
If there are things that the Democrats want that the administration can agree, with them about, then let's do that.
Senate Democrats are united on a set of common sense and necessary policy goals that we need to rein in ICE.
A conversation up next with Jeanette Lowe of Strategas, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Stocks are up by 0.2% on both the S&P 500 and on the Nasdaq. On the Russell this morning, small caps up by 0.4. Under surveillance this morning, negotiating in Washington.
A government shutdown is not in anybody's interest. If there are things that the Democrats want that the administration can agree, with them about, then let's do that.
This is not border security. This is not law and order. This is chaos. Senate Democrats are united on a set of common sense and necessary policy goals that we need to rein in ICE and end the violence.
So here's the latest this morning. Senate Democrats and the Trump administration making some progress in talks, aiming to avoid a partial government shutdown. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John, good morning. Well, it's our understanding that progress is being made towards a potential deal. We could be headed towards at least a short-term shutdown just based on how the calendar is working out. Now, it appears the agreement that's emerging would strip out DHS funding and allow lawmakers to pass the other 5 appropriations bills. There's also talk that we could see what's known as a short-term stopgap measure to fund DHS in the meantime while they work out a broader, longer-term agreement. Now, Democrats have outlined their full list of demands. This does include body camera mandates, new warrant requirements, a uniform code of conduct for federal officers, and an end to immigration sweeps. But it's not clear what the White House will agree to. And the real issue is, even if there is an agreement, this plan is going to require it to be kicked back down to the House no matter what. And lawmakers in that chamber are out of session and out of Washington until next week. And the funding deadline is this Friday at midnight, which means that we are likely looking at a lapse in funding at least over the weekend, and the House gets back into town. Plus, there's no guarantee, I'll point out, that the House is even going to get behind this plan. We're already starting to hear from some House conservatives that are making some demands of their own. Though, of course, if it has the White House's backing, that would pave the way. But unless another solution emerges, that could be the pathway that we're headed down. I will quickly add, some of those other solutions could be a separate legislative vehicle or executive action. But Democrats have maintained that this is their best way to maintain leverage, by tacking it on to this legislation and threatening a shutdown. John, I will say I was on Capitol Hill yesterday, and the overwhelming sense was at least these two sides are talking, compared to the last shutdown where it seemed like they weren't even going to engage, perhaps giving us a little bit more insight into how potent a policy and political issue this is now becoming for Republicans.
Tyler Kendall, thank you. Tyler down in the nation's capital in Washington, D.C. To build on that, Jeanette Love, strategist, writing this: any shutdown would likely be short-lived, or short-lived, as Chairman Powell once said.
I think we need no, short-lived.
Okay, all right.
That was a short-lived issue of pronunciation.
Short-lived, particularly if the Senate does not strip out the Homeland Security funding bill. Jeanette joins us now for more. Jeanette, apologies for getting off track there. Let's get back on track. Going into the weekend, is this shutdown avoidable?
Yeah, I mean, it looks right now like we're going to, again, as Tyler mentioned, have a short-term shutdown over the weekend, which would be less impactful than obviously if it was lasting much longer than that. There is this issue about the fact that they are not going to do a separate legislative vehicle. As Tyler said, it does seem like the Democrats want to use the funding bill as the vehicle for some of these changes on immigration enforcement. And so that's why we're probably going to have this shutdown. Now, obviously, this could, we could have at least a continuing resolution to cover the Homeland Security bill once the House comes back in on Monday. So this could be very short-lived. It could last only 3 days. But obviously, depending on how this plays out, this could have big implications. A shutdown would only be a partial shutdown. 6 appropriations bills were passed, but this is still about 75% of the government funding, and it includes important things depending on how this plays out. Do they pass the defense spending bill, because we obviously are trying to threaten Iran with action right now. So that is not exactly good to have a shutdown when we're trying to have a very strong U.S. national security strategy. What happened to IRS funding? We're in the middle of tax refund season, so that could have a really big impact. And then obviously labor as well. So if that's not taken care of, we could actually miss another jobs report at the end of next week. So I do think that Congress has been on a path to avoid a shutdown. They will probably try to get these 5 bills passed immediately and get that taken care of. And then we'll be dealing with this Homeland Security bill, and it would be a partial shutdown that may last hopefully just a short amount of time, and that is our overall thinking.
Well, let's deal with the Homeland Security bill, because that's going to be where the huge debate is going to lie. What is Senator Schumer actually asking the Republicans to amend in that bill?
Yes, I mean, they want to obviously tack on some policy provisions, as Tyler mentioned, where they want to make sure that there's no use of masks, there's the use of body cameras, there's a code of conduct, things of that nature. So obviously this would have to go back to the House. There was some options. You heard some Republicans saying that they were open to this, but then you've started to hear others start to say that there have disagreements, particularly about like the mask issue and things of that nature. And so this could be a little bit of a friction point. But obviously, the administration does know that something needs to be done in the wake of what's happened over the weekend with the shooting of a U.S. citizen. They do realize that they need to make some changes here. And so I think they will ultimately push to get this bill done one way or another.
Jeanette, though, if the Republicans do decide to go along with these Democrats' wants to pass that bill, are they basically acknowledging then that their strategy when it comes to DHS and ICE hasn't actually worked?
Not necessarily. I mean, I think you've heard from a lot of Republicans the way they've framed the issue, that they can say that, there's been less safety for everyone involved. There are ways that they can show that just the tactics have maybe become a little bit too strident and they need to make some changes. So I think that they can do this in a way that creates not a losing message for the Republicans.
Jeanette, is it a good strategy to hold government funding hostage to try to get some leverage? I mean, this seems like voters are not particularly pleased with that. The last time around, it didn't really work out for Democrats. There were a lot of concerns around air traffic, and we're still trying to work through the lack of data releases. I mean, is this something that's sort of running out of power in terms of the voter base?
Yeah, I mean, one of the things that obviously when we came into, let's say last Friday, there was an effort to have this bill done, have funding completely taken care of before the deadline tomorrow evening. But what happened with the shooting was obviously a stark change. It created the need to find some sort of leverage to change tactics. Otherwise, I think both parties were completely against having another shutdown. They felt the pain on both sides of that 43-day shutdown that we had last fall. But there is the concern, obviously, that if they try to do a separate legislative bill, there's worry that maybe it passes the Senate, but it never passes the House. And so there's also this fear that that ruins their own leverage on the Democratic side if they have to give up the option to try to hold the government funding hostage. Obviously, I don't think people would want a long-term shutdown. I don't think the White House, the Republicans, or the Democrats want a long-term shutdown. I think they do want to find a solution here, and hopefully this will just last a few days to get this over the finish line.
Jeanette, you mentioned something else, that the administration understands that something needs to be done. I just wonder if you expect other personnel decisions to be made from either the cabinet level or beyond to try to address some of the unrest.
You know, I mean, it's obviously always an option. Can't necessarily say whether or not we see that happening at this time. Obviously, the one big move is to move Tom Homan into Minnesota. That was obviously a strategic decision to try to change the tactics that are being used and to do some de-escalation. We'll see if other things come out of this. Obviously, it's been just a week. We'll have to see how some of this plays out and see if there are other ramifications that happen down the line.
Jeanette Lowe, a strategist. Jeanette, thank you. I don't think you can overstate just how popular the president's push was on immigration in the election and how deeply unpopular the execution has been over the past month.
Yeah, people were really for this whole idea of cracking down on immigration, and there was a feeling that the border was really open. And now, as people see these images, it has flipped completely. If you take a look at the approval of ICE has gone down dramatically. So you start to wonder, at what point does that force some pretty big changes at the leadership of ICE, but also just potentially the approach that they're taking?
They've lost the argument here so quickly. They did such a tremendous job of shutting down the southern border, and then this. And the imagery of the past few weekends, not good.
It's not good. It's not what Americans want to see. And you can see this, along with the president overall approval rating, is now tracking lower. And you have senators like Tom Tillis saying individuals' heads need to go, like Kristi Noem.
Up next on the program, coming up, we'll catch up with Krishna Gua of Evercore on the future of Fed independence. Plus, Yahaira has some morning movers. Check out Caterpillar this morning, rising on a big earnings beat. Their stock is up by 1.3%.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Equities positive by 0.2% on the S&P 500. The Nasdaq higher, some outperformance on the Russell. That's the story of the year so far for small caps. Not the story of the past few sessions, though. Small caps up by 0.4%. As we count you down, let's get you some morning movers with more. Here's Yahira. Hey, Yahira.
Hi, John. The AI spending race is splitting the tech giants this morning. We're seeing Meta shares up nearly 9% in the pre-market as investors give it a pass to spend big on AI, up to $135 billion worth, because the payoff is showing up when it comes to improved ads. So Microsoft not getting the same pass. Shares are down 7% as investors scrutinize its record AI spending. And speaking of all that CapEx, well, someone's got to build it and power it, and that's where Caterpillar comes in. Shares are up 1.25% in the pre-market. It posted a strong beat in the fourth quarter as the industrial giant now becomes an AI play. A surging electricity demand from data centers is lifting its power generation units. And we end on some fun with Royal Caribbean. Shares are up 7.5% in the pre-market. It was a beat and a raise for the premium cruise line, as the CEO says about 2/3 of 2026 cruises are already booked, and that momentum continuing into 2026, according to him. We'll see if we see the same strength from the non-premium cruise lines amid this K-shaped economy, but for now, people want to be at sea. John?
Who are these people? Who are they?
I think it's you.
You,
right? So you could do 7-night perfect day Bahamas cruise, starting for $859 a person. I mean, I could tell you, go to Nassau, perfect day at Coco Cay.
That sounds terrible.
Sounds completely your speed, John. I think you should go there.
Is there a premium cruise line?
Yes, it is. It's called...
Yeah. Is there?
Yeah. You do a river cruise.
Yeah, it's
you
called,
do for the
it's
fjords.
called, you know, chartering a yacht.
I've acknowledged that's the one thing I would do.
But,
that's
you know,
my premium cruise as well.
Yeah, you charter your own yacht. That is a premium cruise.
I think Coco Cay has your name written all over it.
Okay, I'll make that happen.
I think you should.
Yeah, all right. How much is it?
That is $800.
That's what's going to shock me. That's what's going to shock me.
$859 per person. $1,718 total per room.
It's
That's
expensive quick.
Yeah, exactly. I mean, but it's, you know, all inclusive, so
that sounds
you can
exciting.
have, you know, a lot
For a
of
man that
flavor.
doesn't drink too much, I might take up drinking if I have to go on a cruise. And I read out this morning, President Donald Trump issuing a warning to Iran: make a nuclear deal with the US or face military strikes. Iran saying it's ready for dialogue, but that it will defend itself. The tensions pushing Brent crude back towards $70 a barrel. Crude up by 2% this morning. Elsewhere, NVIDIA CEO Jensen Huang saying customers in China have yet to place orders for H200 chips. Huang adding Beijing has not decided on allowing the chip makers imports. The comments coming after NVIDIA CEO met customers and government officials in China. Their name is down about 0.2%. And finally, the New York City mayor, Zohran Mamdani, asking Governor Kathy Hochul to hike taxes for the richest residents and corporations. Mamdani arguing that the additional money would close the city's budget gap. Hochul insisting she would not raise taxes.
She was asked about this yesterday in an unrelated press conference, and she said, we're not raising taxes in the state of New York. I'm not raising taxes for the sake of raising taxes. He's been saying it since he was running for office a year ago, so I don't know what the news flash is. talking about the strong partnership that she continues to have with the mayor. Look, she's running for re-election, and if she raises taxes, well, I guess that we are going to have a Republican as the governor of this state, and I think that that really is the tension. How feasible are some of these proposals coming from Mayor Zoran Mamdani?
Please don't confuse this with an opinion, because I don't have any. But does Governor Kathy Hochul have a credible position on anything? On anything?
So there is a question. Are you saying that she would raise taxes, or that just she doesn't have a position? None.
The last time we had this debate in Midtown Manhattan about a congestion charge, she changed her mind pretty quickly, right? And that was in the lead up to an election.
So it sort of raises the question, how much is the election going to determine her position? And right now the election is going to determine that she's not going to raise taxes. And that ultimately is what people are betting on.
And then what happens next? Isn't this just the direction of travel for New York? Isn't this where things are going?
If it's not this year, it might be the following year, yeah. But we always have this budget dance between the city and the state. He has to come out and say that he's going to get this done. But Kathy Hochul is saying, she's been saying for months, I can't lose any more people to Palm Beach, because she sees the capital flight. And this would be the best opening you can imagine from the Nassau County executive, Bruce Blakeman, who's running and is backed by Trump. And they are going to do a ton of press around this if she ever entertains the idea of raising taxes for New Yorkers.
It does raise a question. If Mayor Zoran Mamdani was so popular to get into office, how much of a groundswell of support is there for some of these proposals on a broader level? And at what point does the electorate start to push for some of these types of measures? And I do think that that is a broader point that has to be recognized, especially given the fact that we haven't seen consumer sentiment this low since 2014. So you start to wonder, yes, you could say, well, it's not going to happen, so forget about it, ignore it. But this push for higher taxes to fuel some of the proposals that we're hearing, like free childcare, like free buses, like free a lot of things, there is a question of whether this is the path of travel, and I think it's decent to bring that up.
Feels like that's the direction of travel at the moment. Matt Miller, I'm going on a Disney cruise next month, so Matt...
Ew, is he really?
Matt is that guy.
But he has kids, young kids, and if you have young kids and you want to just check out while they run around the pool, I get it.
But we all know for Matt, a Disney cruise is probably actually for him.
It's for Matt,
He's
not the
biggest
kids.
kid of all.
It's for Matt.
Yeah,
you ever been to Matt's house?
No.
Open up the cupboards. There's
Mickey
just
Mouse?
cereals and like
Lucky Charms.
candy and stuff. And that was when he didn't have kids.
Reese's Puffs.
It's
Okay.
like my dad.
Yeah. Let's turn to the Federal Reserve. Fed Chair Jay Powell defended the central bank's independence.
And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important. And the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Powell warnings his successor to, quote, stay out of elective politics. Krishna Gua of Evercore writing this, in voting to cut, Waller stays in the competition for the chairmanship, even though the odds currently favor Rita Walsh or even a reset to try to persuade Besson. Krishna joins us now for more. Krishna, welcome. We'll talk about some of the substance and the economy, but I do want to pick up on this story of who's taken over the Fed Reserve. You've seen these twists, these turns in previous runs to replace the Fed chair. What's unique about this one?
Oh, where do we start? I mean, this is a chair selection race like none before. Obviously, first and foremost, because the president has such strong views about monetary policy, but also has strong views about the relationship between the central bank and the administration. So all eyes on this to an extent that we've never seen before. The search itself has been very interesting, right? We have come down to this short list of candidates, but we've seen different candidates that look like they were in pole position and then fade. First Hassett, then Walsh. Now Rita is being talked about as the guy who's maybe in pole position. But we haven't yet seen a definitive convergence on any of those candidates. Waller's still in the running. And as I wrote, just some chance that Trump's roving eye is telling you he's not completely sold on any of these guys and might yet hit reset and try to have another go at Scott.
Krishna, this seems to be what a lot of people keep coming back to. We've heard that from Neil Dutta over at RedMac as well. I do wonder how relevant it is, who the pick is, given the fact that Senator Tom Tillis of North Carolina said that he wouldn't pass anyone through the nomination, the confirmation process to be the next Fed chair, as long as the subpoena was outstanding of the Federal Reserve.
So you're right that that is obviously an important impediment at this moment. I think the sensible path, and we're not in a world where sensible paths are always the ones chosen, but the sensible path here will be for the DOJ to quietly close out that investigation around the time that the new nominee is put forward, so that the new nominee has clean sailing in the Senate. And then, of course, the greatest possible ability to influence the Fed in the direction of deeper cuts, which is, of course, what the president's actually shooting for.
Krishna, how can a Fed give forward guidance if we don't have a sense of what the reaction function is of the members, because we don't know who the members are? I mean, how much does that really hamstring one of the main tools that the Federal Reserve has?
So it's a super important point, and I think the short answer is anything that the current chair, even more broadly the current committee to some extent, says right now, you have to take with a little bit of pinch of salt, because it can really only provide maximally credible guidance from here up to May, when Powell steps down as chairman. So I think that's how we should interpret what we heard from the Fed this week. The Fed is clearly indicating that they're comfortable in a potentially extended pause posture. And why wouldn't they be, right? Growth has stepped up. It looks like the labor market is starting to stabilize. We've been saying this for a while. Came into the year with an above consensus call on growth. The underlying inflation picture, I would emphasize, Powell also emphasized, is still looking pretty good. And I think that still holds out the prospect for some cuts later on in the year. But I think the way we should read Powell and the current committee is saying, doesn't look like we'll be doing anything much this side of May. And they're being very circumspect as to what will happen from the summer onwards.
Krishna, do you think he leaves in May, or does he stay on as a governor?
So if you'd asked me that question before the subpoenas were issued, I would have said strongly likely that he leaves. I think one of the aspects of the stupidity of that move was that it backfires against the president's own interest by making it more likely that Powell stays on as a regular governor, because he can't be seen to be yielding to that pressure.
Right,
now,
but we just heard
I
a
think,
clip from him.
therefore, it's kind of endogenous from here, right? If the administration de-escalates in a sustained and serious way, I suspect he still goes. But if they don't, he won't.
Sorry, Krishna, but we just heard a clip from him, Jay Powell, saying he's committed to Fed independence. If he stays on,
Yes.
isn't he also showing that he is very political as well?
Not really. I mean, I think the most important thing at this juncture is that Powell needs to make it absolutely clear that the administration is not able to push out Fed officials by using DOJ investigations against them. That is the most important thing in this particular moment. Now, as I said, if the DOJ is smart enough to close out that investigation, and if in general the Trump administration sees the wisdom of de-escalating from here and backing their guy for success, then you've still got several months to go to May. You could end up with a situation where Powell can indeed walk away in good conscience.
It's such a shame, Krishna, that this has become such a big distraction, because there's an important economic debate that needs to be had. Many people on Wall Street are expecting growth to pick up, and at the same time they think inflation will be contained. You yourself say the economy will be stronger, not hotter. How convinced are you of that for the year ahead?
So I think this is absolutely a strong growth year. And as again, we have had an above consensus forecast on growth for 26 all along. The issue is really this debate. Does stronger mean hotter, or does stronger mean not hotter? Now, I'm in the second camp, but we're going to be pragmatic and have to listen to what the data tells us. Why am I in the second camp? First, because I think a big part of this story, the dominant part of this story, is a step up in productivity. It was very interesting to see Powell turn to that when he was asked about what are the implications of stronger growth. It depends on whether it's driven by and accommodated by productivity or not. I think all the data right now is still very benign on the inflation front. I expect that to continue, but I'm going to be on the lookout for any signs that I'm wrong. One thing to watch, of course, is whether unemployment stabilizes and drifts down a bit, which is my base case expectation, or instead starts to plunge on this faster growth. If it's plunging, that's suggesting the neutral rate is higher than we thought. That would be the case where there isn't really room for cuts. But right now, I still think that you've got a pretty good bet of getting 2, and you can still have a shot that the new chair can even get you to 3.
Krishna, thank you, sir. Krishna Govardhan of Evercore. That last point is so important. It's just such a shame we're distracted by all of this nonsense in Washington when that's the conversation we should be having.
Yeah, productivity is the fairy dust that people are looking for. And the question is, do we have that, or do we have a boom that's going to come with inflation that needs to be tamed? And ultimately, that's what people don't have an understanding of. And if you really were confused enough, we don't even have the data necessarily, and we could be heading into another shutdown. We're just working through all of that. So, yeah, exactly.
Let's not do that.
I mean, that's what I was thinking. I mean, I'm just thinking about Ed Bastian and Scott Kirby over sitting there. Why us? Why keep attacking the
economists? We might not get the jobs report.
Why keep doing it? Wall Street problems, right?
Yeah.
Lack of data, all that stuff. All right. Matt Hornbeck at Morgan Stanley is going to join us in just a moment to talk about that. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Well, we may avoid a shutdown. President Donald Trump and Senate Minority Leader Chuck Schumer moving toward an agreement to avoid that government shutdown. The New York Times reporting the two sides are close to agreeing to Democrats' demands to remove long-term Homeland Security funding from a massive spending bill to keep the government open past Friday. Meanwhile, Starbucks reporting stronger than expected growth in its fiscal first quarter and a solid outlook for the year. Global same-store sales climbing 4%, beating estimates. CEO Brian Niccol telling analysts the company has identified $2 billion in cost cuts as it works to streamline operations and improve service. And Jersey Mike's Subs, the sandwich chain with more than 3,000 locations, is reportedly working with Morgan Stanley, JP Morgan, and Jefferies on a potential IPO offering. Sources telling us here at Bloomberg, the company is seeking a valuation of at least $12 billion, and more banks are expected to be part of the lineup. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate the update. Up next, the case for holding.
The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. There was broad support on the committee for holding.
Matt Hornbeck of Morgan Stanley joins us next.
For us is the year that everything just comes together, right? We're not just moving money. The last decade, literally, we've immune the race for Africa's growth, right? And the future of Africa, in our opinion, is not hype, it's infrastructure-led. When Africa wins, the global economy wins. We're building the pipes, and those pipes are now of age. Now, as of right now, we are the biggest fintech in Africa, the most licensed non-bank entity. In the last 10 years, we built that muscle. Now we're putting that to the test, all right? Now we've covered the entire world. We have UK, US, UAE, Canada, Europe covered through our partnership with Global Open, for example, and Nuvian. And the point behind that really is, how do we ensure we use that infrastructure to drive the next phase of growth for Flutter Wave by empowering our customers across all our segments?
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equity futures positive by 0.1% on the S&P 500. On the Nasdaq, just about in positive territory. Under surveillance this morning, the case for holding.
The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. Available indicators suggest that economic activity has been expanding at a solid pace. There was broad support on the committee for holding.
So here's the latest this morning. U.S. Treasuries holding steady as the Federal Reserve pauses its rate-cutting cycle. Matt Hornback of Morgan Stanley joins us now for more. Matt, good morning. Good to see you.
Good morning.
How much heavy lifting is 1 month's data doing for the Federal Reserve?
Well, it seems like quite a lot. I would not look at a chart of the unemployment rate and see it tick down once in a very clearly defined uptrend and call that stability, personally. You can look at the U6 measure of unemployment. It did also tick down, but it is also very clearly still on an uptrend. So I'm a little bit boggled by that definition of stability myself, but to each their own.
But you are forecasting strength this year in the U.S. economy.
Absolutely. I mean, I think our economists look at the situation, they look at the fiscal impulse, they look at the AI CapEx spend, and they see signs of strength. And by the way, I mean, the U.S. economy is not weak. If you look at final domestic demand, you can see that the economy is in fact operating just as it had prior to the pandemic, which means strength. But it doesn't mean 4%, 5% strength.
Why is that wrong? Why is that misleading?
Well, one of the quirks in how the GDP accounting ends up coming out is net exports. And net exports involves imports. Imports today are adding to growth, and usually they subtract from growth. But the reason why imports are adding to growth is because of tariffs. And it's because we aren't importing as much as we used to as a result. So we actually have a situation in which the underlying economy is in fact just fine, but it is just fine in the context of where we were before the pandemic. And if you recall where we were before the pandemic, we had 2% real growth, and we had basically 2% inflation. It was actually a little bit below 2% inflation on core PCE. So this actually all aligns with how the Fed, I think, is generally thinking about the U.S. economy. But don't look at the Atlanta Fed's GDP Nowcast, which everybody does, and be hypnotized that something else is going on. The economy is just fine.
Well, if the economy is just fine and unemployment rate, you think that stabilizing is the wrong way to maybe characterize it, how much more room for cutting do you think that there is? I mean, do you think that right now this Fed is underestimating how much they really can continue to slash rates?
This is a question about where is equilibrium in the economy, both in terms of growth and inflation, as well, and importantly, with interest rates. And when we look at what's going on with population, in fact, the population estimates were just updated yesterday. And when we look at those, it leads us to believe that trend growth, potential growth, is probably coming down. And so if trend growth is coming down and we are in a pre-financial crisis world, then so too is R-star, or the real equilibrium interest rate. And as that comes down, the Fed can continue to lower interest rates. In fact, they would have to continue to lower interest rates just to maintain the current level of accommodation in monetary policy. So there is definitely scope for them to keep cutting rates. Our economists, as you know, led by Michael Gapin, is looking for 2 more rate cuts this year. It's 1 more than the Fed, and it is about the same as what we have priced into the markets today.
But there was no sense of urgency to what you're outlining in the press conference yesterday. Are you surprised?
Well, it's not clear that there needs to be an urgent set of rate cuts, right? These concept of potential growth equilibrium interest rates, they move very slowly. And so it makes sense that the Fed may be taking its time lowering interest rates. It needs to figure out over time where is the equilibrium interest rate in the economy. But we do have data coming up, as always, and the BLS is making a change to the labor market report that I don't think that many people are aware of, but they're making a change to their net birth death model, which could have implications for how this labor market data ends up coming out this year.
Still, when you look at the consumer sentiments yesterday, the conference board, consumers who said that jobs are plentiful plunged to 23.9%. It was at 28% in December. Based on what Wall Street is saying and what consumers are saying, it's two very different economies.
It seems that way. I think one of the problems with sentiment surveys is that we generally don't know how many people respond to them. And one of the things that we have seen since the pandemic, as you're well aware because you're all smiling at me, is that the response rates to data have come down. So when we think about the S&P Global Purchasing Manager Indices, when we think about the ISM Purchasing Manager Indices, one thing that they don't tell you is the response rate. How many people are actually responding to these surveys, which is why I think they've generally become more disconnected from reality, is because not as many people are responding.
Matt, what's the bond market call now for you and the team?
So we're basically seeing the long-term Treasury yields remain range-bound. But we do think that with more rate cuts will come lower short-term interest rates. So we think the curve will continue to steepen. Short-term interest rates come down. Long-term interest rates remain generally range-bound.
Dollar weaker?
And the dollar weaker, absolutely. That's been one of our core calls for the past year, is that the dollar was in a downtrend. And that downtrend, of course, doesn't happen by appointment. It takes catalysts to cause it to trade weaker. Obviously, what we saw last Friday with the rate checks, both from the Japan Ministry of Finance and the U.S. Treasury, was a catalyst to push the dollar weaker.
Are you expecting some intervention on that side of things?
Well, it's not clear. Well, I would argue we've already seen intervention. It's called verbal intervention. It's not clear that we actually need physical trade-based intervention at this point. The dollar has come off quite a bit. And if the data come in like we think they will, softer inflation over the course of the year, labor markets that generally remain in a malaise, then the dollar continues to go down on the data.
The dog has barked. Let's see if we get a bite. Matt, thank you, sir. Appreciate it. Matt Hornback there of Morgan Stanley. The president weighing in on interest rates. This is what he's got to say on social media this morning. In a statement, Jerome Powell again refused to cut interest rates, even though he has absolutely no reason to keep them so high. He is hurting our country and its national security.
This is a very long statement from the president, so clearly he's digesting what Jay Powell had said yesterday and once again saying he wants lower interest rates, and the man in charge right now is talking about how actually we're more in balance when it comes to the Fed's dual mandate.
He does have a decision to make. It's the replacement for Chairman Powell, and I don't see that in this very long statement this morning.
No, I'm doing a quick Control F, trying to find anyone's name. Not there
Control
yet.
F, that's it.
Coming up on the program, David Levovitz of JP Morgan Asset Management, Ed Ludlow, Nancy Lazar, and Earl Davis of BMO.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersetchi in Davos, Switzerland, and this is Bloomberg.
I think it's a Fed that is comfortable with the backdrop of data. The data seem to be improving from here.
They're now in wait-and-see mode, and they're basically waiting to see what's happening on inflation.
There doesn't seem to be the market pricing in a huge risk of inflation going forward.
We know somewhat where inflation is. The markets are extremely confused.
In the next 6 months, there's really no real movement towards a cut.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500, close to all-time highs, up another 0.2% on the S&P, on the Nasdaq up by 0.1. Big afternoon for the Nasdaq coming up. Apple reporting after the closing bell. Your data drops in about 30 minutes' time. We'll get jobless claims. Already getting a statement from the President of the United States, a statement on Jerome Powell, the Chairman of the Federal Reserve. Now, the news here is not what he's saying, it's what he isn't saying. Yeah. This is the same old complaint about interest rates of the Federal Reserve. The President has an opportunity to announce who the next chair of the Federal Reserve is going to be. And even though he's complaining, he's not taking that opportunity.
I haven't counted all the words, but there are a lot of them. And in this, there are a lot of discussion about the billions of dollars that could come into the U.S. with the stroke of a pen. With more tariffs, there is a lot of discussion about interest rate expense. There isn't any definitive action, which raises a question: how is he going to achieve these lower rates that he's looking for, these lower interest expenses, while getting someone who is credible to markets? This is sort of the person, the unicorn that has not yet emerged.
I think the president is saying to Wall Street, I have nothing for you yet on that. Basically, in the words of Jerome Powell yesterday to all the journalists. It is interesting that we do not have a decision yet for this administration, and they keep pushing it back. The Treasury Secretary said we're going to get something before at Davos, maybe a little bit after Davos. Well, tomorrow is Friday of the week following Davos, and we still don't have anything. And right now, given the fact that Senator Tillis is putting this roadblock in the way until the DOJ investigation into Powell is wrapped up, this administration might take a lot longer to mull over their decision and make that announcement.
Mismanage the process, and because of that, it's going to take a whole lot longer. It's kind of out of their hands now. Even if they nominated someone right now, today, no one can really tell me how long this is going to take based on what the senator from North Carolina told us in the last week.
Yeah, and it doesn't seem like President Trump is backing down from the subpoena of the Federal Reserve, because yesterday he tweeted out a story from another news outlet talking about how the Fed has yet to respond to that subpoena. So there is this question of, okay, they could make this go away by just simply withdrawing some of this request, and yet doesn't seem like that's in the cards, at least not yet.
If the Fed's not complying yet with the subpoenas and they're going to drag this out, at this moment, Powell really is in the driving seat in terms of how long this is going to go on.
Equity futures right now in the S&P still positive by 0.2%. Coming up this hour, we'll catch up with David Lebovitz of JP Morgan Asset Management, with stocks trading at record highs. Nancy Lazar of Piper Sandler breaking down the latest labor market data, and Earl Davis of BMO Global Asset Management saying the Fed's easing window is closing fast. We begin this hour with stocks rising to fresh records as tech earnings fuel investor sentiment. David Lebovitz of JP Morgan Asset Management writing, we see room for growth to be driven by both investment spending and consumption in 2026 as the AI story continues to play out and U.S. consumers benefit from the one big beautiful bill. David joins us now for more. David, good morning. Good morning. Consumers feel like crap right now. You can see that in the surveys. It's pretty clear. I mean, really, really clear. Are they going to spend that money in the way you think they will?
So I think that there are two things that are going on here. One, people are going to find themselves with more money in their pocket. Two, affordability is still the biggest issue facing the consumer today. And to my mind, that's why you're seeing the sentiment numbers continue to come in with such a downbeat tone. I think, though, if we see a world where growth begins to pick up, where labor markets importantly begin to stabilize, and where the pace of inflation doesn't reaccelerate, consumers will be comfortable spending. Now, what they spend on, we've already seen people move away from name brand to private label. I think that those trends could very well continue, but it does look like the consumer is going to be a key staple of the growth story as we look ahead across the year.
Does that speak to the outperformance in small caps to start the year? Does that speak to some of the moves we're seeing worldwide, just a pickup in global risk appetite?
So I think part of it is a pickup in global risk appetite. I think part of it also has to do with the fact that we're just looking at a more balanced environment than where we've been over the past couple of years. You know, we've talked many times on this show about kind of the echoes of COVID and how we've seen these mini recessions roll through the economy. You've seen it in housing, you've seen it in services, you've seen it in manufacturing. It feels like everybody is coming back together, right? The orchestra is sounding a little bit more unified and coordinated, and that's why I think you're seeing risk assets in particular, whether it be small caps, whether it be EM, perform well so far this year.
Is this an environment, this is something we were talking about earlier, where equities just will continue to outperform all other asset classes, or debt in particular, given the fact that it's all about growth? It isn't necessarily about disinflation. It isn't necessarily about the financialization of the economy.
Yeah, I think the market has moved past the inflation story, to your point. I think it's all about growth, and it's all about profit growth. And that's part of what has kept us constructive on owning risk in portfolios over the past couple of quarters. Is it is very rare to see a world where the labor market cracks and corporate profits remain solid, right? You would need corporate profits to roll over in order to get concerned about a downshift in growth, and that's just not materializing. And so with the earnings story there, with the economy well supported, and with an expectation that, to the conversation you all were just having about the Fed, we will get some rate cuts this year, right? I think that's what's fueling the appetite for risk. That's what's allowing equities to continue to grind higher. And you look at credit markets, and it's like, where do we go from here? You know, 260 on high yield, that's not looking like a place where you can get a whole lot of capital appreciation. And so if you want that upside, investors are being forced to play the equity side of the risk bucket.
HSBC put out a note yesterday talking about how so far this year it has been the Russell 2000, it has been the small caps that have been outperforming, and that's rotation trade that tries to gain steam every beginning of the year seems to have played itself out. They're already shifting back to the mega caps. Are you agreeing with that? Are you seeing this sort of trade as having had a nice month, but now it's time to go back to the others?
So we prefer to lean into the higher quality, larger capitalization companies. We think that that's a better way to play this late cycle environment. And I do think that we are now in a late cycle environment. I think part of what might be supporting small caps and may lend further support to small caps this year is, the return of animal spirits, more conversation around IPO activity, M&A activity, buyout activity, right? All of that is very positive for smaller companies. You then look at the nature of some of the IPOs that are coming, and they're going to be pretty big companies, and that's why I think that you'll see this begin to fade, and that's why I think the opportunity is still in things like tech and communication services.
We build on where we started with the consumer. Wall Street is putting so much emphasis on the tax refunds. What's to say that consumers didn't spend it? They all knew for months this was going to be trickling down, and we just got over the Christmas holiday season.
So the thing that I've noticed about the U.S. consumer is that when they have money, they spend it, and when they don't have money, the credit cards come out. And so I think that's going to be the story this year. I actually think my favorite non-consensus view today is that the risk to growth this year is to the upside. Everybody tells me we're going to have this gangbusters first half of the year. Things are going to fade in the second half of the year. I don't see it. I think people are going to be feeling good. The wealth effect is real. The labor market is going to stabilize. We also have things like the World Cup, America's 250th birthday. There's a lot working in favor of the U.S. economy in 2026. That may well change in 2027. But over the next 12 months, I think that you're looking at a pretty interesting opportunity.
At least it's got doubts, clearly.
Well, 250th birthday party, what? Because everyone's out buying a gift for the United States? I mean, what is
People
that?
throw parties.
And then
to get together.
Yeah,
Well,
but then
I might throw a party.
Happy birthday, the World Cup. Are people even going to come? I mean, there's a lot of questions here.
I hope they do.
Yeah,
I hope they
you're
do.
not buying tickets because they're too expensive.
They're ridiculously expensive.
And I think that there is this question about, look, I agree. I'm just, in general.
I'm waiting for someone to take me.
But it's a very fair point, and that's why
we're... careful.
I'm not allowed to accept tickets. Don't offer me tickets.
But that's what leaves us comfortable with the outlook. Is the consumer is really only one piece of that puzzle, right? To the birthday point, my guess is that results in a bit more government spending, and then you have the whole AI story that we haven't even discussed this morning. That is something where if you look at the results that we got last night, there is more capex in the pipeline. There is more money that is going to get pumped into this economy.
They're committed to it. They've got the balance sheet to lever up if they want to. They're absolutely committed to it, and you see it showing up in Caterpillar, Copper, you see it all over the place. Let's say you're right. Let's run with that.
Yep.
What's not priced for it? Because equities are leaning that way. What isn't priced for it?
So I think that equities are very much leaning that way. Equities around the world don't look particularly attractive from a valuation perspective relative to their own history, relative to the U.S. And so that's leading us to lean into markets like EM and specifically China. We continue to really like Japan. For us, Europe is interesting because Europe doesn't have the tech exposure. And as somebody who graduated in the financial crisis, I've never really seen Europe work. So recency bias is a real thing. But we think that you can get diversification benefits from owning that market because you're not going to be subject to the same forces and the same trends that you're getting from EM in the U.S., which are very much focused on
I was trying to get you to talk about bonds, so I'll do it directly. What does it mean for fixed income and bonds? Equities are there. Growth, give it to me. Got it. What about fixed income? Can yields stay this range bound, this stable in the face of a much, much better growth profile?
So I would argue that the risk to rates is to the upside, but I would argue that if you see rates move higher on the back of better growth, that's going to have a very different impact on the equity market than when rates move higher on the back of an increase in term premia, i.e. the government saying something that upsets the market. And so, higher rates from a growth perspective, I think leave equities okay. But for us, you're not really looking at, back to our conversation earlier, significant opportunity for capital appreciation, whether you're looking at government bonds, whether you're looking at credit. EM debt continues to perform well, but the juice has effectively been squeezed out of that orange. And so our view from a credit perspective is you're basically going to get your carry. We have a lot of conviction that you're going to get your carry, but we're not sure that there's much upside above and beyond that. If you want that upside, you have to go to equities, and that's what keeps us overweight equities, neutral on credit, and then neutral on duration as well.
I want to just sum up with something that we've been talking about throughout the morning, this idea of how we had the financialization of the markets when you first graduated and you came in post-financial crisis or during the financial crisis. And now we're moving to another phase where this is the real world really reasserting itself in a new way. The CapEx is taking an increasing proportion of growth and, frankly, budget of balance sheets. How different is this investment landscape from when you graduated and from the years and years of 0% interest rates that really fueled a lot of financialization?
So it's interesting because I've also worked on our long-term capital market assumptions for the better part of the past decade. And I remember times where we said, the 60-40 portfolio is going to pay you 4% over the next 10 to 15 years. Nobody liked that story. Our number is now closer to 6.5. The reason why is that you have these forces of more active fiscal spending by governments, more economic nationalism. Well, how do you respond to that as a corporation? You invest more money in things that can solve some of the problems that the political sphere is creating. And so I do think we're moving away from this world of financialization. I do think that you're going to see real dollars spent on real things. And I think overall that leaves us in a world where Fixed income gives you income, equities give you growth, and when you put it all together in a portfolio, you can actually generate a rate of return that allows you to achieve your long-term objectives.
When governments start picking national champions, do the rules of capitalism still work?
So I think you need to be cautious, obviously, and there are certainly some warning signs in the current environment. But my job is not to pass judgment on whether that's right or wrong. My job is to figure out what to do about it. And so if you have that type of support coming through, you have to think of it. Yes, there is some risk, but there's also opportunity that's being created. Which, if you let that go by, you're going to look silly.
We've been giving capitalism a beating for a long time now. Coming out of GFC, central bankers kicked it in the gut, and coming out of the pandemic, governments are doing the same thing.
I would agree with that. I think
Let's not pretend any of this is,
I would agree with that. I would just wonder if you are operating by a certain rule, game of rules, do you have to change those rules as an investor and start to shift around your thinking that things won't necessarily make sense in the same kind of way? I'm just wondering how that sort of introduces some new variables.
Totally. Like the government is picking winners and losers.
Correct.
And in the last 10 years, central banks just haven't allowed any losers. To some extent.
It's true. No, this is something that a lot of people complain about. Exactly, the beer goggles.
The dynamism has gone away. It's a complaint,
The small businesses.
Yes.
Where are they?
But I think at the end of the day, stock prices follow earnings. And so if you can follow the earnings, regardless of why those earnings or how those earnings are being generated, right, that should work out if you're a long-term investor.
There we go. Sensible, David. Thank you. We appreciate it. We need some of that. David Levitz of JP Morgan Asset Management. No emails offering tickets, by the way.
Look, they're listening to your first comment, not necessarily the look in your eyes. Please don't just ignore what I'm saying. Yeah, exactly.
Brazil. Something like that. I don't know.
Now you're getting choosy.
No, should I pick a date?
Yeah, exactly.
Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Talks to avert a government shutdown gaining momentum ahead of today's vote in the Senate. Sources telling us here at Bloomberg, the Trump administration is moving closer to Democrats' demands over Homeland Security funding. Meanwhile, U.S. Border Czar Tom Homan holding a press conference in Minneapolis this morning. He arrived 2 days ago and is leading ICE operations in the city. Meanwhile, President Donald Trump taking to Truth Social this morning to continue his criticism of Federal Reserve Chair Jay Powell. The president writing, Jerome Too Late Powell again refused to cut interest rates, even though he has absolutely no reason to keep them so high. President Trump adding, we should be paying the lowest interest rates of any country in the world. And it's the end of an era at Southwest Airlines. The company is ending its decades-old practice of open seating. Assigned seating is being rolled out this week. Southwest says seating changes are meant to keep up with evolving customer expectations, plus boost profits. The Dallas-based carrier is also charging travelers for checked bags now. That's your Bloomberg Brief, John.
Yahara, thank you. The good old days on Ryanair. It was wild.
Okay,
there's no way. Used to line up really early.
Choose your own adventure.
You'd line up so early.
It was crazy.
Like 2 hours before it takes off.
The good old days?
And then the sprint across the runway to get on the plane and block seats for the rest of the family.
Hold on a second. The good old days, would you ever do that again now?
No.
Okay.
Absolutely not.
It is fun at first. It is fun at first to experience it.
Yeah, exactly. Of course.
That's just what it was.
Right, but it's the good old days.
£15 to fly to Italy back in the day.
So I can't tell. Is this romancing it, or is this sort of discussing the things that you leave behind?
Bit of family fun, Bramo. Sort of like fighting everyone off to block the seats.
When Junior is of age, you can take him just to experience that.
Sure, he'll love that.
I'm sure you will. It's like, listen to what Dad has.
June 13th, by the way, MetLife Stadium. Anyway, up next, the Morning Calls Plus. Ed Ludlow joins us as big tech earnings continue. Apple set to report after the closing bell. Live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Over the next 3 to 5 years, when you start thinking about the shift toward an AI world, it is going to be dictated more on the physical AI opportunities. We've kind of seen this accelerated shift away from SaaS to kind of the more chip making related names here.
Big divergence opening up in tech at the moment over the last several weeks, few months for that matter, between hardware and software. That was Angelo Zeno of CFRA. Your equity market doing okay, and I stress just about okay, up by 0.1% on the S&P, unchanged on the Nasdaq 100. That's the price action. The opening bell at 1 hour and 11 minutes away. Here are your morning calls. First up, Morgan Stanley removing Microsoft as a top pick following earnings, noting disappointing growth in its cloud computing platform. Their stock is down almost 7%. The second call from KeyBank raising its price target on Meta to $8.55, believing its fourth quarter results are a blue sky scenario. That stock is flying. It's up 9%. And finally, Mizuho upping its price target on Tesla to $5.40, seeing the company is well positioned as a leader in physical AI. The stock is up by 1.8%. Let's stick with tech. Apple next up to report as megacap earnings are doubling down on AI. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the program, sir. A big divergence in the price action between Meta and Microsoft. You covered the numbers as they dropped. What stood out for you?
It's the same equation, though. The concern with Microsoft from the sell side and the buy side is very simple. Capital expenditures accelerating and growing beyond the pace at which revenues are growing. And actually, Azure, the cloud unit, is the key metric by which we judge Microsoft's AI success, seeing decelerating growth. And, with Meta, even though the capital expenditures forecast for this year up to $135 billion is kind of eye-watering, right? They give Meta the benefit of the doubt because Meta, differently to Microsoft, showed outperformance in revenue growth and was able to evidence through various different data points, actually, that it is directly tied to their existing investments in AI.
They're all taking these big bets. And Ed, I think that's what these companies have in common. Meta, Microsoft, Tesla, they're taking massive bets. And then you've got Apple. Yeah. And Apple is a curious one because they don't fit in to that. It doesn't feel like they're taking major bets right now.
The only sort of analogous thing is probably Tesla to Apple, because as hardware players, they're facing very difficult environments. And we talked about it less on the blog in the context of Tesla, but it's a very difficult environment. Apple's probably going to have its best ever quarter. The data from the prior quarter showed that China was improving. The soft third-party data shows things are quite good. But not to overstate this, John, the situation with memory chip prices is very severe. And so Apple, which we've in years past called the master of bottom line management, is going to have to face very difficult decisions to pass on that cost to the consumer in their handsets or not. It's really tough out there, like well beyond tariffs. We're back to having some supply chain issues. And I was listening to your last guest talk about kind of like throwbacks to the COVID era. A lot of what we see in the commentary of all of these companies is very representative of what we were seeing in 2020, 2021. So that's kind of interesting.
And I have to say, I don't really feel terrible for Apple when you say it's hard out there. And I see the line out the door to spend $2,000 on products.
Quite.
So there is definitely that sense. Although I will say they are the biggest underperformer among the Magnificent Seven cohort since late last year. A real question here about whether there's sort of a bifurcation now from some of the buyers of some of these memory chips and other expensive components and the providers, right? I mean, we see this sort of shaking out in terms of profitability. Is there some kind of divergence that's identifiable, or is it case by case?
Case by case. I mean, I was surprised that Elon Musk gave such specific commentary last night about the memory chip market, and he basically put it pretty simply: what's happening in memory chips is more severe than what is happening in AI chips. The issue as well, it depends on who you are. If you are Apple, and particularly if you're NVIDIA, but we're talking about Apple tonight, right? You have a lot of leverage with your suppliers. And if your suppliers are tight on supply, and supply, obviously, tight supply drives pricing, you have a better ability to negotiate. So, Apple's management of that will be looked at. But you're absolutely right, by the way, big picture, like, Apple does look good right now on the hardware side. Inevitably, people will still say, when is the AI-powered Siri coming, and give us some real evidence that you actually are a player in this AI thing. But beyond that, hardware company, and John's completely right, we're heading in slightly different directions now in the software corner of this market and the hardware corner of this market.
Ed, can we say anything about what kind of spending on CapEx is rewarded in markets and what isn't? I mean, it's sort of the Microsoft Meta breakdown in this question of whether Apple will get rewarded for investing in AI or not to try to keep up with some of its competitors. I mean, what makes certain CapEx good and what makes it bad?
Covering Mag 7 technology earnings is very difficult. Because they don't have like a common metric. BI does a really good job of tracking longer term CapEx projections, but they report this in different ways. So Microsoft's story was that CapEx was higher in the quarter gone, and they give some like incremental commentary of going forward. Meta just comes out the gate and goes up to $135 billion this year. And historically, as you guys know, like Meta gets punished when spending is too high and the loss-making units have a loss that is too wide. But actually, in this context, Meta's $135 billion post, the market was very calm about it. They kind of think, well, that projects quite a lot of confidence. The biggest surprise for me last night is Tesla coming out and saying $20 billion of CapEx, because that's double its historic average, double what the street was expecting. And, you have to take it with a grain of salt, I suppose. But Musk also is talking about Tesla becoming a chip maker. And that's not even factored into their CapEx forecast. But based on the market reaction this morning, investors look at it and go, this is quite useful data, thank you.
Ed, I think Anne-Marie's got a complaint. Just a brief complaint.
Ed, try covering the Trump administration. I have the smallest violin for you out in San Francisco with the mega tech hyperscalers, please.
I get it. Yeah, but look at the bags under these eyes and this shade, and, it's hard. That's all I'm saying.
It's 5:30 in the morning. I got to give Ed credit.
You're going to get offered a skincare regime in a minute. Ed, go. Run. Ed, thank you, sir. Appreciate it.
He needs to wear the patches under the eyes.
What are those things you're wearing?
Yeah, I'm going to send them. I'm going to send some. Don't worry, Ed. They're coming your way.
Okay, all right. Coming up on the program, the latest jobless claims data set to cross. We'll catch up with Nancy Lazar of Piper Sandler with us to break down the data and look back on a news conference with Chairman Powell. Chairman Powell at the end of that news conference feels a little looser. He's ready to go.
He's ready to go.
It's like you ask him a question, no thanks, I want to talk about this instead.
Yeah.
I don't have to entertain this anymore.
And he said that 1 million times. Actually, he said it 7 times. I don't have anything for you on that today. And then he said something like, I'm not going to comment further from that statement, so check it out.
He's got 2 more meetings circled on the calendar.
Not going to work on the Hill.
Then he's got a cruise.
It's not going to work on the Hill.
He's got a cruise.
I got nothing for you, Senator.
It's like $1 million speech, and then on a cruise again.
Yeah, you could have sent him on cruises?
It's not a bad lifestyle, is it?
Well, it depends on what kind of cruise it is.
True. River cruise. Disney cruise, no. River cruise, yes.
I have ideas.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
60 minutes away from the open, about seconds away from the economic data. The scores look like this. Equity futures on the S&P up by 0.2%. The Nasdaq 100 up by almost 0.1%. In the bond market, it has been sleepy, that's for sure, over the past few months. We are near the upper end of the range for the year so far. 425 on 10s this morning, and 2 still anchored around Fed funds at 356.93. With that economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. The numbers are just coming out now, and we don't see much change in the numbers for initial jobless claims. They do rise to 209,000 last week, but that's still a very, very low number. Now, we should point out, you've heard a lot about layoffs the last 48 hours or so, including more today from Dow. Those won't show up as jobless claims until those people's severance runs out. So we wouldn't expect the numbers that we've heard this week to suddenly show up. But all right, here's the interesting thing. Last week's numbers were revised up from 200 to 210. So the rise to 209 is actually a decline to 209. So that's the way these things work. A couple other numbers that are out this morning. We have the non-farm productivity and unit labor costs revisions, and there's no revision. 4.9% for productivity in the third quarter and negative 1.9% for unit labor costs. But here's a number that will matter to the economy, and that is the trade balance for November. Remember, it came in at $29.2 billion, an extraordinarily low number when first reported, it reported for October. The number is, for November, 56.8. One of the reasons that the Atlanta Fed GDP Now number is so strong is because imports collapsed in October after so much stuff was pulled forward, and now it looks like we're getting much more of the kind of trade balance we have been getting in the past. Imports rose 5%, while exports fell 3.6%. So that will add, or well, it will subtract basically from that GDP Now figure, and probably we're going to fall under the 5% anticipated number at this point.
So, Mike, you think, and you're indicating really, and I think this is important, that the trade numbers have kind of been skewing the GDP read that we've been getting. Can you tell us about underlying demand? What's happening just to broader consumption outside of that story?
Well, underlying demand has been relatively strong. It has slowed some, and there's going to be a lot of interest in fourth quarter spending. Retail sales have been okay, and personal spending okay, but we don't have that data for December out yet. So we're waiting on that, and that will tell us much more about how strong the economy is. One thing that's going to be concerning is this collapse in consumer sentiment, because people spend what they earn, and the consumer confidence numbers that came out from the Conference Board this week suggest that people don't think jobs are going to be available, and they don't think their incomes are going to be going up in the months ahead. So in that case, they may be a little more cautious in spending.
Mike McKee, appreciate it. Thank you, sir. Joining us now to continue the conversation, Nancy Lazare, Piper Sandler. Nancy, good morning. Good to see you.
Good morning. Nice to see you.
Mike McKee indicated there the X minus M part of the GDP formula is kind of skewing things at the moment. Would you go with that?
Oh, absolutely. I mean, Atlanta Fed had 5% GDP for the fourth quarter. That's probably now unlikely, but something close to 3 to 4% for the fourth quarter is probably still likely.
Do you have a better sense of exactly what these jobless claims mean at a time when they seem to be flat, despite what we heard from Mike just there? We're hearing these job cuts announcements. There's this churn under the surface, and there's a lot of low sentiment. So how do you gauge these numbers and what they mean?
Well, actually, I'm quite excited the fact that claims haven't increased in the face of these layoff announcements. I think it's in part because small businesses are starting to rehire, and 80% of jobs in this country are created by companies that hire less than 500 employees. And certainly that's not the companies that have announced these layoffs today. So small businesses, medium-sized businesses are highly cyclical, and they're now feeling the lagged effects of the Fed easing cycle. I mean, Fed is probably done cutting rates, but they've already cut rates 175 basis points. And it takes roughly 2 years for that to actually impact the economy. So that's 24, 25. So right now we're in the sweet spot where lower rates are helping to support small businesses. And so the NFIB data is looking encouraging. And so we're ending the bifurcation, I think, in the labor markets, where out of the pandemic, it was the big companies that were hiring. Now maybe they overhired, and now you're starting to see smaller companies hire. And again, they drive the job market.
Forgive my strange faces as I try to contort myself to try to understand what this economy is doing, because I'm really struggling here.
Yeah.
If you could characterize things, is this late cycle, early cycle, mid-cycle, given the fact that the growth figures are kind of skewed with GDP that are being influenced by trade, the jobs numbers are being skewed by some of the different industries? I mean, how would you characterize the cycle?
I'd have to characterize we're mid-cycle. It reminds me of 1995. In that you had a Fed easing cycle in 1995, maybe even 1996. The Fed tightened aggressively in 94. You obviously had it was a tech-led boom in the economy in the early 1990s. Then the Fed realized they were behind the curve, and they raised rates in 94 very aggressively. Sounds familiar, 2001, 2002. And then they cut rates 75 basis points in 95 as the economy slowed. And then the economy took off again in 96, and they stopped cutting rates. So it reminds me mid-cycle of the 1990s.
If they stopped cutting rates, and you're talking about this productivity boom, is the Fed done for this year?
I think they should be done for this year. Productivity gives you stronger potential GDP growth. In the 90s, it only took a 75 basis point cut in Fed funds at a certainly higher level than we are today to reaccelerate growth from 2 to 4%. That is because when you have a stronger productivity, think of a healthy company. You don't need significantly lower rates to get growth to reaccelerate again, and I think that's where we are today.
Well, the president certainly wasn't happy with the decision yesterday. He made that known today in a Truth Social post. How difficult, if you don't see any rate cuts needed for this year, is it going to be for the new chairman?
I think the messages can change, and I think there's a chance as we go through the year, it's like you look over your shoulder and it's like son of a gun, the unemployment rate has stopped going up, maybe it starts to come down, you start to see healthier job growth in 2Q, GDP growth is at least 3, maybe even 4, and the administration could come out and say, I guess we've done our job, the economy is actually now improving. They do change.
Does that help housing?
Pardon me?
Does that help housing? Because that seems to be a sensitive issue.
So I think it does. The last thing we need from housing is another major easing cycle. That obviously created the boom in housing in 2005, 2006. And even in 2009, 10, 11, you had another pickup in house prices, and you ended the decade with another, I would argue, housing bubble in 2017, 18, 19. And we saw that during COVID. Slow, moderate improvement in housing is actually healthier for house prices. You don't get another boom, and you make it longer-term affordable. You are already seeing that down south, where you have put in place a lot of new inventory. You're already seeing that in new house sales. New house sales have picked up because new house prices have come down because they overbuilt. So we are seeing an incremental healing in the housing market. Housing is becoming more affordable. Just don't try to buy something here in the Northeast or the West Coast. You've got to move down south.
This is an interesting point, though, that you're making, that lower rates could be problematic, could have unintended consequences.
I totally believe that. You go back and look at history, be it the late 60s, be it what happened to us in 2005, 6, what happened after the GFC. Totally, I think you can create economic excesses. You get a boom and then you get a bust.
So does that mean that you think that dropping rates lower from here substantially, unless there is a material shift in the economy, could lead to a harmful or some sort of bubble-type behavior in risk assets.
I really do. I mean, nominal GDP in the third quarter, quarter to quarter, was over 8%. In the fourth quarter, probably it will be at least 5-6%. And then you have Fed funds roughly of 3.5%. That's a huge gap. If you think of the economy as a company, again, revenues are growing at a very healthy pace, and if you lower rates too aggressively, you do risk creating another bubble, be it in tech. That's what happened in '98 after Greenspan lowered rates sharply in just a couple of months after the Russia LTCM crisis. That really created that last boom in the tech bubble, and then he had to raise rates, and that created the bust. So yeah, I think a more moderate level of interest rates when we have such healthy growth trajectories, albeit housing's not booming, but that's fine. Yeah, I think it sustains a cycle.
If I were channeling Fed Governor Chris Waller, I would say, okay, this sounds really lovely, but you look at the sentiment surveys, you can see consumer sentiment is really negative right now. You look at some of the job loss announcements, Dow, for example, coming out and saying that they're going to cut 4,500 jobs this morning, saying that they're going to use artificial intelligence to bridge some of those gaps. This is a market that calls for lower rates to try to support the employment level. Why would you push back against that as saying that's not valid?
Okay, so first on consumer confidence, I would argue there are three measures of consumer confidence. You have MISH, Conference Board, and then we have our own measure of consumer confidence. Those other two have been totally wrong when it comes to consumer spending. Consumer spending was 3.5% in the third quarter. It's going to be at least 3% in the fourth quarter, whereas those numbers suggest consumer spending should clearly be deteriorating. It's not. Maybe it's more a political statement than is an economic statement. Our daily consumer confidence survey actually turned up after the government shut down and is consistent with a healthier consumer. So one, you have to look at all the data, which we try to do. And so first on consumer confidence. On AI, technological innovation is what creates new jobs. In the old days, if you go back to the 70s or talk to Greenspan, he used to seasonally adjust data by hand. Economists at some of the big banks in the 70s would plot graphs by hand. Well, those entry-level jobs disappeared in the 1980s, thank God, because that's when I started. And you use computers. So creative destruction is actually what makes the economy, the U.S. economy, exceptional. I still think we are exceptional.
You're very constructive on the economy going forward, but it is an election year. I know everyone's talking about tax refunds, but also this president is willing to run it hot and is going to push Congress maybe to do other fiscal stimulus. What do you think that is going to mean for the inflation picture?
So my colleagues in Washington who are experts on this, and I have not, suggest it's going to be very difficult given the makeup of Congress today to get additional fiscal stimulus. And it's not just the tax refunds. That is kind of like a sugar high for the economy, and that starts next week. We're very, very focused also on other more structural things that they've done through full capex depreciation and also deregulation. So those things we think carry the economy as we go through the back half of the year. A lot of the street thinks this is a sugar high, strong growth in the first half, weak growth in the second half, and we disagree with that. We don't need more fiscal. I'm actually quite impressed with the productivity that's coming out of Washington. My heart does go out for those who have lost jobs in D.C., but at the end of the day, maybe it was a little bloated. And you're improving productivity. Federal outlays have actually stagnated, which I think is good news. And so I think the fear of the deficits is also a little bit overstated.
Punchy segment, thoughtful stuff. This was good. It's good to see you.
Thank you very much.
Thank you. Nancy Lazar there of Piper Sandler, echoing a stronger outlook that I think was presented also by David Lovitz only about 40 minutes ago.
Yeah, pushing back against the consensus, although everyone on the show, the consensus has been that it's been a strong first half and a strong second half, and then ultimately the productivity gains really will be something that is sustainable. I think that the headline is really Ed Yardeni. Productivity is the fairy dust, and that seems to be what a lot of people are banking on.
Right, and he says he's been talking about the roaring 20s now for years, but for Nancy's point at the end there, it's almost like she can go in and run Doge. That effort has sort of fell by the wayside, but a lot of people on Wall Street were excited about it and moving from public sector jobs into the private sector.
I'll just say it's nuts how quickly this decade's going. Because I remember that note that came from Ed Yardeni back in 2020. It was like the roaring 20s, and here we are 6 years into the thing.
Yeah, no, I agree.
Crazy.
I mean, it is crazy. I'm also still thinking about what jobs I can outsource. I'm trying it with ChatGPT to see what I can get rid of. It's tough. It's not good enough yet.
What are you trying to outsource?
Well, it's just questions about please compile all job cuts that have to do with this, not very good. Please compile, research, to try to, make it easier for me so I don't have to do it, but it doesn't work.
If you figure it out, let me know.
Okay, thanks.
All right. Equity futures on the S&P, positive by about 0.25% with an update on stories worldwide with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Recapping that data, we just got initial jobless claims for last week coming in at 209,000, just a tick above estimates, and below the figures for the week prior. It was a holiday-shortened week marked by severe winter storms across much of the country, which of course can impact the data. Meanwhile, continuing claims fell to 1.83 million. Jersey Mike's Subs, a sandwich chain with more than 3,000 locations, is reportedly working with Morgan Stanley, JP Morgan, and Jefferies on a potential IPO. Sources telling us here at Bloomberg the company is seeking a valuation of at least $12 billion, and more banks are expected to be part of the lineup. And talks to avert a government shutdown gaining momentum ahead of today's vote in the Senate. Sources telling us here at Bloomberg the Trump administration is moving closer to Democrats' demands over Homeland Security funding. U.S. Border Czar Tom Homan holding a press conference in Minneapolis saying he aims to cut the number of federal officials in the state. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next, Earl Davis of BMO saying the Fed's easing window is closing fast. Plus, Yahara has your morning movers. Whirlpool shares plunging after its outlook disappoints. That stock is down by about 10%.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
If trend growth is coming down and we are in a pre-financial crisis world, then so too is R-star, or the real equilibrium interest rate. And as that comes down, the Fed can continue to lower interest rates In fact, they would have to continue to lower interest rates just to maintain the current level of accommodation in monetary policy. So there is definitely scope for them to keep cutting rates.
That was Matt Hornback of Morgan Stanley. Equities at the moment positive by about 0.25% in the stock market, pushing just a little bit higher, up by 0.2% on the Nasdaq 100. With some morning movers joining us now for more. Here's Yahira. Hey, Yahira.
Hi, John. We start with the appliance maker Whirlpool. Shares are plunging down 10% in the pre-market, and it all comes back to tariffs. Hear this, what CEO Mark Bitzer said. He said, even though as a company, obviously, we like the concept of tariffs, it did not help us in 2025. That's because Whirlpool says that competitors front-loaded inventory, keeping their prices low. So Whirlpool was not able to capitalize as a domestic manufacturer. So that caused sales to miss in the last quarter, and the outlook not so good either. Meanwhile, shares of U.S. rare earth companies are falling in the pre-market after a Reuters report said the Trump administration is stepping back from plans to guarantee minimum prices for critical minerals projects. That's a reversal from last year when floor prices were promised, according to Reuters. And remember, the U.S. government did take stakes in USA Rare Earth and MP Materials. And we end on the divergence we're seeing in the tech trade, a big story today. We are seeing Meta shares now up nearly 10% in the pre-market as it gets a pass to spend big on AI, up to $135 billion worth, because the payoff is showing up, especially when it comes to ad targeting, which of course is the engine of its business. Microsoft not getting to the same pass. Shares are down 6.5% in the pre-market as investors scrutinize its record capex. John?
Big divergence there. Yahira, thank you. Great work this morning. Brilliant, as always. And it's pretty easy to explain the story. If you're going to spend a lot of money, make sure it shows up in revenue. And that's the story, the divergence between those two names.
Yeah, if you're going to spend money, also prove that you're not doing it to play catch up. Prove that you're doing it to get ahead of something. And that, I think, also is the key. It's also a question of, all right, Meta already went through their efficiencies, et cetera. They're actually showing that they're able to do the advertising. And Microsoft, I don't know, it's still kind of at the wrong end of the trend right now.
Apple up next after the closing bout, the next big tech player to report earnings after the close. Your trading diary is shaping up as follows. We'll hear from the president later. He speaks at 11 a.m. Eastern time. After the closing bout, we'll get those earnings from Apple. Tomorrow, the government funding deadline plus results from Chevron and Exxon, followed by PPI data and the return of Fed speak. Earl Davis of BMO's got a lot to say on the Federal Reserve. This is what he has to say on this committee. The US will be on hold for the foreseeable future. The window for one more ease is closing fast. Earl joins us now for more. Earl, welcome to the show. Is that the window for Chair Powell's Federal Reserve, or just the Federal Reserve for the year ahead?
Being Chair Powell's Federal Reserve and the year ahead, actually. So let me back up. So with your previous guest, the fiscal stimulus in the market, I largely agree with that. It's largely discounted, so move on, carry on. There's no further impacts of that. Further eases, monetary eases, two eases, largely discounted in the market. There's no further impact for that. What's not being discounted in the market, and that gives me extreme concern, is the broadening of the commodity rally. Fed Chair Powell was asked us about gold and silver, and he said we include in our macro, but it doesn't have any impact necessarily on monetary policy. I agree with that. Having said that, when that commodity rally expands into what we're seeing today, copper almost up 10% today, that has significant impact into the AI build-out. There's a significant amount of copper used for the energy in those build-outs. That's a significant increase in prices there. And that's not even to speak out the build-out for energy that's required in North America in general. I'll also add in gas. At $65 now, when you look at oil at $65, has direct implications on gas, which is a consumer tax. So and now you're seeing in wheat and the broadening, and we expect this to continue. And the reason why we expect it to continue is silver and gold are stores of wealth. Wealth is future spending. When you look at wheat price, oil price, copper price from a gold and silver perspective, it looks very cheap. So we could see continued buying there when you look at it on that matters. And that's what's concerning from an inflationary impact that the market is, I would say, complacent about right now. And my team's actually having a meeting in an hour to say we're overweight credit, to say whether we should reduce that overweight or not, and go underweight duration in 30 years for because of the broadening of the commodity rally.
Earl, that's exactly where I wanted to go with this question of what assets get hit hardest
if people are underestimating the commodity-driven inflation that could be in the system.
Yeah, I apologize for the sun changing. I had the perfect. Still buyers of risk, but we're reducing our risk now to buy at better levels, which we think we'll have given how tight valuations are right now.
Is your take on duration a U.S. phenomenon, or is it a global phenomenon that duration around the globe could suffer in the face of some of the commodity boom?
That's a great question, and I would say the further out the curve you go, the more global a phenomenon it means. So 30-year bonds. So when I say we're looking at going underweight duration, it's not 2-year bonds, 5-year bonds, or even 10-year bonds. It's 30 years we're looking at going underweight for two reasons. One is that's the one that has the most influence globally. We're seeing what's going on in Japan. You could get some fiscal expansion, continued fiscal expansion in Europe as well too. So that has impact in regards to if I'm going to invest in 30-year bonds, I can invest somewhere with a higher yield once swap back to U.S. So that's one thing. It's globally. The other thing too is there's just so much price risk when you have a 30-year bond that we feel we're not being rewarded for it now with these levels. 10-year bonds, we feel comfortable going long or buying 10-year bonds as we approach 450 and go higher. The one thing to remember why we feel comfortable buying bonds on backup, if we do for some reason break the high yields of last year, which is our premise, like the yield for 2025, the spread of that yield or the range will be the same range in 2026. And we feel very confident about that and buying at the higher end of the yield because that's when the talk about QE comes back into effect. It'll snap back in bonds, add to the volatility. That's why we love being active managers in this environment. It's perfect.
Earl, I've got a buy recommendation for you, some shades. Earl Davis, thank you. BMO.
Yeah, I know.
Asset Management.
I'll take the sun. It just came out at the wrong time here.
Thank you, buddy. Appreciate it. We'll let you go. Let's get to this move in copper. Moves we have not seen in 17, 18 years for this metal. Copper up by 9 to 10% in today's session. Monster moves.
Yeah, and this is being fueled by China in particular, kind of hoarding it. It just raises this question, how far can some of these moves go, given the fact that we're seeing penny-like stock moves in the likes of copper, in gold, in silver?
Copper, Caterpillar,
exactly.
the Aussie. It's just
the real world.
Amazing. John Stoffers of Oppenheimer joins us tomorrow. Neil Dutter of Renmac, Alex Altman of Barclays, Michelle Weaver of Morgan Stanley. From New York City this morning, good morning. This was Bloomberg Surveillance.
The semi-finals are set at the Australian Open. Jessica Pegula reached the Final Four for the first time in Melbourne after she took out fellow American Amanda Anisimova. The New Yorker will face Alina Rybakina for a spot in the final. On the men's side, Jannik Sinner dispatched Ben Shelton to reach the Final Four for the 9th time at the Slams. Novak Djokovic awaits in the semis.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
AI, some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the trend, the technology trend and the investment is real.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving someday.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Today's the day. Again, looking for 7,000, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
We have a continued spending spree for big tech. Meta, Microsoft, and Tesla ramp up investment in AI. Now attention turns to Apple after the close.
Blackstone delivers a surprise jump in profits. President John Gray says deal-making has reached escape velocity.
And packaging giant International Paper plans to break up and spin off its European operations.
A lot of stories to cover today, a lot of corporate news, and we're excited to bring you some exclusive conversations on that front. But Matt, I'm kicking things off with a look at Microsoft. You mentioned the huge amount of AI spending that we're getting. At least when it comes to Microsoft, investors are worried. Down 6.8 in the pre-market. Cloud sales growth slowed last quarter, and its outlook was seen as weaker after spending a record $37 billion in the past 3 months. It's a market that's upset about this now. You can't just spend and expect gains.
Well, CapEx is up 66% in the quarter, and revenue from the cloud, at least, only 38%. So there's a bit of a mismatch there. Meta's ad business showed improvements and will help the company spend up to $135 billion in CapEx to fuel Mark Zuckerberg's ambitions of AI super intelligence. You can see the market likes this, up 10%. But of course, they're making the run rate for their ad business is like $220 billion a year. So they can afford it.
Exactly. It's the divide. Can you afford to keep spending or can you not? And let's discuss just that in the rest of the Mag 7 earnings we've been getting and will get with Bloomberg Tech co-host Ed Ludlow. Ed, how did you distinguish between how the market treated Microsoft earnings versus Meta earnings?
Yeah, like Matt has the right formula. Expenses growth for Microsoft is outpacing growth in the key unit that we track, which is Microsoft Azure, which at 38%, like 38% growth is nothing to sniff at, but on a currency fluctuations adjusted basis was completely in line with consensus. And even like I think on your program, right, people have been coming on to Bloomberg Television and saying they want to see Azure at 39, 40% growth. But the reality is that it's now decelerating a little bit, going in the wrong direction. Compare and contrast, like Meta projected great confidence saying that capital expenditures at the top end will be $135 billion this year. That's a ginormous figure, but in the current period, at least, in the forward-looking commentary that they gave, ad sales growth is very strong. Meta, a little bit differently, gave other data points that also showed that internally, all this AI prior investment is paying off for them too. They're just better at doing certain core functions.
You know, I talked to a trader this morning, Joel Kalina from Wedbush, who said he's a little worried about companies close to OpenAI because their cash burn is so high. Right. But I noticed OpenAI contributed $1.02 to Microsoft's bottom line, and that's more than 25% of their total earnings.
right? So they contributed $1.02. How much of that $1.02 did Microsoft give OpenAI in the first place?
Good point. The circular economy.
Right, and you know, this is like a well-discussed thing. There are two parts to it. That circular financing element is very true. OpenAI is also almost a burden to Microsoft. Microsoft is capacity constrained. It has to deal with the infrastructure of OpenAI's activity. But also, like, Microsoft, you know, I grew up with Microsoft as a kid, right? In those days, you would pay for your Office 365 subscription, software that you could get elsewhere for free otherwise. In present day, it's not just OpenAI, but Anthropic as well, offering tools that basically make enterprises look at their software expenses and say, is this something that I actually need right now? You know, there's choice in the market.
Hey, Ed, quickly before we let you go, we're also going to get Apple earnings on deck. I got to wonder, with the nerves around spending, does Apple become the winner that they're adding Gemini to their iPhone? Users will get AI exposure and AI assistance without the hundreds of billions of dollars committed to AI-related CapEx.
Yes, and also Apple just doesn't rise and fall on a capital expenditures figure, right, like the hyperscalers do. The data out of China in particular looked good in the prior quarter. The soft data points us that this will be a record quarter for Apple, right? In the background, memory pricing is severe. And so Apple's management of that supply chain, the bottleneck of memory, but also what to do with passing on pricing, that might show up. And so that management, you know, Apple's the king of managing the bottom line. But that is something to pay close attention to for sure.
All right, we will be paying close attention throughout the day and tune into your show as well. Bloomberg Tech's Ed Ludlow, he kicks off his program at 11 a.m. Right now, let's get into Tesla because those earnings topped estimates for the fourth quarter, and the electric car maker said it will invest $20 billion to ramp up production of not just cars, but batteries and robots across half a dozen plants. Here's Elon Musk.
I think in order to remove the constraint, the probable constraint in 3 or 4 years, we're going to have to build a Tesla Terafab, a very big fab that includes logic, memory, and packaging domestically.
Joining us now is William Blair, head of energy and power technologies. Jed Dorsheimer, he has a market perform rating on Tesla. Jed, what did you think of the earnings? What do you think of the CapEx plans?
Well, I think, thanks for having me. I think there's a little bit of both. You know, the bulls are going to point to autonomy and humanoid robots. You know, the end of life for the S and X for the humanoids is going to be a signal of this is the future. And they're not wrong. I mean, that's where most of the value from a stock perspective is in these future opportunities here. The bears are going to say, wait a minute here. You've got, you know, auto that's doing worse. You're now end of lifing, you know, part of that. Where's the cash flow going to come from to pay the $20 billion of CapEx that they just announced and $2 billion that they're investing in XAI? And then quietly in the middle is kind of the area that we focused on is the energy business continues to march along is kind of the silent success here, which we're going to need more and more of. So I think, you know, you're kind of in this, in what I would call a tweener category where it's like, hey, you know, those who have made up their mind or on the bull side are going to point to that. I don't think this quarter is going to really change anyone's minds here. And you're going to need to, you know, we're going to need to see if Elon can hit timelines, which historically he's not been good at, but, you know, as we can see those data points around automation and autonomy and robots, that could drive further upside.
Jed, can I get your thoughts on that, what you bring from what the bears would be worried about, your direct response to those who say, as you put it, they now have a cash flow problem if they're putting their EVs aside and investing into AI and their humanoid robots? How do they solve the cash flow issue?
Well, Tesla's, I don't think so I would come back and so part of the bear story is that we're in a cyclical versus secular trend here in terms of AI. We see AI as existential. We see the move to, you know, the need for more power as we reshore and kind of increase the energy density per dollar of GDP. And so, I see that is something that we have to move towards, and AI becomes your disinflationary hedge against that. So I think at a fundamental level, the bears have it wrong, because it's like we're applying, this is 2000 all over again, and I don't think that's the case. As for Tesla in terms of cash flow, as the energy business continues to march along, and recognize that the 3 and Y make up most of the auto sales, you're not really giving up that much with the S and X. And if you can hit the numbers on the robots, and you bring down pricing on that demand, you could actually have more cash flow that comes into the business from that trade. So that's how I would address that, the bear side of that story.
You do give up what I think is the most elegant, most successful, most enduring design in Tesla history. I mean, the Model S, Franz von Holzhausen turned out in that an all-time classic. Does it matter if Tesla comes out with any good cars anymore? Because everything else is pretty boring.
It's not an auto story anymore. I mean, it's sad, like you'll lose sexy, right? That was, if you look at how the S, the E was for the 3 and the X and the Y, but it's not a car story. And I don't think it ever was. I think that was the petri dish to kind of prove out the hypothesis here. And it's really been, in our opinion, an energy story, and that might be transitioned to more of an information and automation story. So those who look at it like as a car company and say, hey, I want to comp it to a General Motors or Ford, have always gotten this wrong, and they've been crushed on that trade. And I think they will continue to be crushed.
So, Jed, then take us to this future when it's no longer, I guess you're saying it's no longer a car company now, but with the EVs it still have left, what does Tesla look like, let's say, in 5 years' time? Is it just not even producing vehicles anymore?
Well, we've argued strongly that the return on invested capital for the energy business is far greater than that of the auto business. And we're now seeing that in terms of what's needed. If we look at every gigawatt of compute that's going into a data center, you need 2 gigawatt hours of batteries. And so your return there is tremendous. We're short 90 gigawatts of power by 2030 in terms of data center demand. So it's an enormous amount of energy that can be supplied, and I think this is a really elegant and critical solution for that. In addition, once you get to autonomy, their cost structure of their tech stack is far lower than that of Waymo. So if they can, as long as they don't have a major incident and they are able to continue to scale robo-taxis, then they can use pricing as a weapon to come in well below what you'll be able to do in terms of Waymo with Uber. And so that presents an opportunity to take that market share. And, the average utilization of a vehicle is only 5%. So as you go to a robo-taxi, your utilization goes up to, 80, 90%. And so you'll need less overall vehicles, but the usage model changed dramatically. And so that also gives them a huge advantage there. So, those are sort of the winner-take-all opportunities that they're going after. Now, in fairness, we do not have Optimus in our model, and most other analysts don't. So that's an upside opportunity is that flows in.
All right.
That's a little picture of the future.
I'm looking forward. I mean, that's the part I can't wait for as Optimus. Jed, thanks so much for joining us. Always a pleasure having you on. William Blair's Jed Dorsheimer there. We'll discuss big tech's spending spree in the next hour as well with Sadek Waba, an investor in infrastructure. I'd say one of the most famous infrastructure investors there is. He started that business at Morgan Stanley. Now he's at I Squared Capital. Quick check on futures right now. We're looking at S&P futures up just 0.1%, but 7,017 the level there. If you take out the premium for futures, we're looking at about a 7,000 even cash open. NASDAQ really not moving at all, 26,164 on the NASDAQ. No, we're going to have Adina Friedman on.
Correct.
Which
NASDAQ,
I'm very much looking forward to.
On NASDAQ earnings.
I was looking at the NASDAQ composite from the high in March of 2000. It took 15 years to get back to that high of 5,000 roughly in 2015. But now we're at 5 times that amount.
Yeah, and by the way, NASDAQ shares themselves are at a record high too. I think around $100. So a nice round number for them too.
All right, coming up, another stock on the move, International Paper. Those shares climbing after announcing plans to split the company into two. We're going to speak with the CEO next, Andy Silvernail. This is Bloomberg Open Interest.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Let's get to high interest now. Look at what's making headlines around the world. Brent crude hit $70 a barrel for the first time since September after President Trump warned Iran to strike a nuclear deal or face possible military action. The threat added a fresh geopolitical risk premium to oil, with analysts estimating prices are $3 to $4 higher on Iran concerns alone. Meanwhile, fears of supply disruptions in the Middle East are outweighing expectations of global oversupply. And Dow says it will cut about 4,500 jobs worldwide as it shifts more operations towards AI and automation. The chemicals giant expects up to $800 million in severance costs as it streamlines and simplifies its business. The move follows earlier layoffs and plant closures and comes amid a broader wave of job cuts across major U.S. companies as hiring slows and worker anxiety mounts. The Fed didn't seem to see it that way yesterday. But International Paper says it will split into two publicly traded companies, spinning off its European packaging business. The move follows last year's acquisition of DS Smith and comes as the company looks to simplify operations and improve performance after a tough year thanks to trade uncertainty and weak consumer sentiment.
Well, Matt, I am pleased to say that joining us now is the man himself, the International Paper chairman and CEO, Andy Silvernail. Andy, thanks so much for joining us. Exciting news, not just on the earnings front, but on this deal to split into two. As Matt mentioned, this comes about a year after your acquisition of DS Smith. What was the calculus of, rather than work on continue to integrate that versus splitting apart into two companies?
Yeah, well, thanks for having me here this morning, Danny and Matt. And really the impetus here and the exciting part of this is what we realized is what we have are two regional powerhouses in sustainable packaging. And as we dug deeper into the businesses, it just became more obvious every day that all of the value was in those regional integrations. And that's really what drove this decision making. It's an exciting day here for International Paper and the opportunity to leverage those two powerhouses by focusing on capital allocation that's really unique to their missions, to be able to drive the focus. As you know, 80/20 is really how we work in this company. And that really says, hey, let's simplify the businesses, let's segment them, let's focus resources on what drives the most value and allow those businesses to thrive and become best in class in their markets.
To what extent did tariffs, Andy, or trade uncertainty, the changing geopolitical landscape have to do with this decision? Because at first glance, to the layman, it looks like that could be the motivator.
Yeah, very, very little actually. At any point in time, you got to think about the geopolitical implications and all the forces that are shaping the world. But it's a moment in time, and when we're making decisions here at International Paper, we've got to think for the long term. We have to think for generations. And so while that's a factor that you have to consider, it's really around the fact that all of the value is regional. And that's the really important message here, is the value is regional. And so let's focus on the customers, their distinct missions, distinct needs. Let's focus on the assets that need to be applied there. And critically, the capital allocation and the resource allocation to allow them to pursue those unique missions.
Andy, another thing that's been weighing on CEOs' minds who have to deal with an international company, a global company, is weakness in the dollar and how that's impacting various FX effects of earnings and revenue splitting your business into these local divisions.
Yeah, Danny, when it comes down to it, that's really not a decision point in a moment in time. The strength really interesting about this business, and I love about this business, is we have to think long term. The capital investments that we're making, how market structures evolve over time, those are really long-term plays, and we got to be thinking about maximizing long-term value creation, not short-term gyrations in markets.
You do have, this is a 4-year low, so it's not that short-term for the dollar, and we're looking at forecasts for it to continue to sink. Nonetheless, it puts you in a relatively good position, right? Because you have something like 65 packaging plants around the U.S. You produce, I think, like 70% of your paper here in America. So as the dollar declines, aren't you able to sell more of it to people overseas?
Well, what's fascinating here, Danny, is because of our name, International Paper, people kind of think of us as a global commodity paper company. And the reality is we are a packaging company, and that packaging business and sustainable packaging is actually very local. So while we manufacture paper in region, in each region, very little of it crosses borders. And so really our paper manufacturing is done in the region. It's then shipped to around regional population densities, or MSAs, and then is converted into sustainable packaging. And so in terms of how the dollar affects us, it's really just a translational impact today. And of course, it has implications of how the global economy forms and reacts. But in terms of actually how the markets form and the implications for us as we go forward and as we split into two separate public companies, it's really just going to be the impact that it has on the overall economy, not so much how it impacts International Paper.
Well, Andy, thank you for joining us on the day of this deal announcement. Congratulations on it. Enjoy the rest of your, I'm sure, a busy day on this earnings day. International Paper CEO Andy Silvernail. By the way, if you want more deal news, here's something you do not want to miss. The debut of Bloomberg Deals next week, which Matt Miller is probably tired of me talking about.
Not at all.
My new show that tracks the key players, major moves, and capital flows behind global deal making. It's Wednesday, February 4th at 12 p.m. New York time. Clear out your calendars.
No, I'm
Appointment
excited.
viewing.
I'm really excited about this because, of course, we're going to continue to focus very much on M&A and IPOs.
Totally.
And public and private capital and how they interact with deals on this program. But that'll be a great way for people who are specifically focused on that industry to get everything they need downloaded in an hour.
Let's cut this up and use it as a commercial. Thank you, Matt. Thank you for the buzz marking. Coming up, more deals. We're going to listen to my exclusive, or not my exclusive interviews, but one of the many interviews of John Gray this morning post-earnings. That's coming up next.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get a look at some of the movers on our radar this morning. Single stock stories start with Caterpillar earnings, topping estimates as energy needs for AI drive demand for its equipment, but tariffs cost the company $1.7 billion in 25.
IBM topped analyst estimates. It is on strong growth, on course for strong growth for its software unit, though shares up 7.6% in the pre-market.
And Royal Caribbean earnings were better than feared, as it says about 2/3 of its 2026 trips have been booked up. I hear John Farrow actually is looking to book a trip, so maybe they get one more passenger from surveillance.
I cannot imagine that. I truly cannot. Coming up, more earnings as we go to the opening bell.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talaki kon ahmalep ahmata suara pangop ahmalep manchang lenya ay kun mamanya.
Una batalla a muerte.
Money can do a lot of good,
It can really transform people's lives, but it can also hurt them.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Looking at futures that are a little bit higher, so 7,015 on S&P futures. NASDAQ futures down a little bit now after a slew of tech earnings yesterday, including Microsoft, which disappointed with its cloud growth. The small caps gaining about 0.25%. Down the New York Stock Exchange, super pumped. York Space Systems is ringing the opening bell. Dirk Wallinger right there, the founder and CEO. No tie, front and center. That's how you know he's the founder and CEO, because he doesn't have to wear a tie. PicPay is ringing the opening bell down at the NASDAQ market site. And this gentleman's going to join us right here on Bloomberg Open Interest. CEO comes on to talk about this Brazilian bank. Now, Danny, in terms of the stocks to watch, it does look like Microsoft is weighing down the gains that we should be seeing from Facebook and Tesla.
Yeah, right around new highs for this index. Microsoft is impinging things at this moment. Look at this chunky decline, down 9%. The issue is that its cloud growth slowed last quarter. At the same time, it's upping its CapEx, spending a record amount on AI capabilities. You compare that with Meta, up 10%. It's because their ad business grew, and that's allowing them to spend money, at least $115 billion on their AI efforts. Tesla, as we were just talking in the last hour with William Blair, they are putting aside $20 billion to build out factories for its robo-taxis and robotics plans. It's axing some of its older EV models, because apparently this is not an autos company anymore, Matt.
Yeah, no, it isn't. It's more, obviously, with a $1.5 trillion market cap, that's more than all of the other automakers in the world put together, including like Pagani and Koenigsegg, if they had a market cap. I think the most interesting thing about Tesla, a viewer just sent me a tweet, and I've got to verify this with Modal on the Bloomberg terminal, but looks like free cash flow in the fourth quarter, $1.420 billion, which is the exact same number for free cash flow in Q4 2022. So Elon Musk loves his 420 references, as do I. Apple reports after the bell, with Wall Street expecting record holiday sales last quarter. Analysts will be closely watching how memory chip costs are impacting the business. Obviously, they've gone up, and they're an important part of your iPhone. So it'll be interesting to see how that hits the bottom line when we see Apple report earnings today after the bell. Don't miss that on the close with Romaine Bostick and Katie Greifeld. Joining us now to talk about S&P 7000 is Citi Wealth Chief Investment Officer Kate Moore. And Kate, I know it doesn't matter for any other reason than the fact that it's a big round number, but I guess a lot of people put in stop orders or sell orders at that level. So when we bounce up against it, there's a little bit of resistance. What do you think about stocks right now?
You know, we're still really constructive on stocks, Matt, and I have to say it does get a little uncomfortable when you've had a couple of these years of very strong performance, not just in the U.S., but of course some of the broadening out that happened in 2025, and people want to kind of doubt the sustainability of the run. You know, you've seen this on a couple stocks you were just mentioning a moment ago after their earnings report, that if it doesn't hit the highest bogey or the highest whisper number, people get a little bit itchy. That said, the fundamentals look really, really strong, Matt. And we are very anchored in the fundamentals in terms of our equity allocation. And as such, we are still continuing to have a significant positive view for equity returns over the course of the year.
How then do you kind of say, all right, Microsoft gets slammed because it's spending a lot, but Meta does okay, and it's spending a lot? Sure, the revenues coming in are different, but Kate, how do you distinguish which kind of spending from hyperscalers is okay and which is not okay?
I mean, Danny, that's a great question, because this kind of knee-jerk reaction, like some spending works and some spending may actually be negative for margins in the near term. It feels like investors' time horizons keep shifting based on a specific company. And look, here's what I will say. We want investments to happen at this point, not just in the AI cycle, but of the economic cycle. We think we're in a year of overall spending outside of technology, including in industrials and parts of other resources. And people are going to have to get comfortable. There was a knee-jerk reaction for a very long time that if a company was spending, if their CapEx was strong, you faded that because you were worried about the delivery on the bottom line. But I think we need to have faith that companies do an outstanding job today managing to their margins and managing to their earnings. And even if we have one quarter that looks a little softer, a little disappointing, it's not a reason for us to step back from our positive equity risk.
Do you worry about the concentration risk, especially around one private company? I see people throwing 10, maybe 30, maybe $100 billion at OpenAI. And I'm not asking you to specifically comment on that company, but just the concentration risk. So many companies are so deeply invested in Sam Altman.
Yeah, well, I would say I can't comment specifically on that, Matt, but I do think the concentration risk in a lot of investor portfolios made them uncomfortable over the course of 2025. And some of the rotation that we saw at the end, kind of the last 2 months of the year, was really about this, that not just the U.S., but certain U.S. companies had become outsized in investor portfolios. And people started to ask themselves, like, does this make sense? Or in the case of some funds, have they bumped up against the position limits they could hold in individual names? So I think we're going to continue to struggle with this when you have these companies that are growing in a phenomenally fast pace, who are like eating everyone else. And as a result, their market cap is reflected in, the outsized positions in an individual portfolio or an ETF or an index. I think that's going to lead people to ask, what else should I be doing to balance that risk? And how can I hedge my exposure to some very concentrated ideas?
Kate, for some people, I guess a lot of people actually, the hedge has become gold. I mean, the price of gold has been remarkable. It's now above $5,500. But Kate, can it act as a hedge when itself is looking like a momentum play? Shouldn't that be a concern? Can it really be a hedge with these types of skyrocketing price moves?
Look, when I added gold to the portfolio last year, and we added, over the course of 2025, it was really kind of the drivers around, the fiscal story and fiscal sustainability. It was a story around, how do we, diversify away from U.S. dollar holdings. It was the central banks continuing to add to gold reserves. And, these kinds of real fundamental drivers. Right now, we are seeing an incredible amount of interest from a wide range of investors in adding gold. And I'd be lying if I said that the price performance this year doesn't make me a little bit uncomfortable. This type of move, this fast, always gives a little bit of pause. That said, I do think that gold should be an important part of portfolios. We have used it both as a hedge against some of our equity exposure, as a substitution for duration, as what we think can be an uncorrelated source of return. So there's a lot of drivers for that for us in our portfolio construction. But yeah, we're watching for maybe a pause, a bit of breathing room, actually, after this phenomenal run.
All right, Kate, thank you so much for joining us this morning. We always love having you on. Appreciate your time. Citi Wealth Chief Investment Officer, Kate Moore. About 8 minutes into your trading day, let's get a check on this equity market that is fighting the push and the pull between Meta and Microsoft. Microsoft winning out that battle. We're looking at actually that's not the S&P. Let's just hold on one sec. We're going to get that up. It still is a push and pull because Microsoft plunging 11% at the open. Let's see where it is now. It's at 10% now. So let's start with the decliners here. Down 10%. NVIDIA, it's only down 0.4%, but because it's so big, we've sorted this based on how much it's weighing down the equity market by market cap. Just on that note, I mean, this is such a good function to have move. 42 points. That's how much Microsoft is responsible for dragging down this index that has been trying to hit 7,000. We are under that this morning because of the weight. Just some things, the upside Meta, we've been talking about this morning. Their spending's okay because the advertising business is healthy. We're going to talk about that after the next break. IBM, they had earnings that they're solid. Caterpillar also had earnings that are solid, as did Royal Caribbean, and some of the other tech names like Alphabet doing well too. Let's look at what the sectors are doing. Tech's going to be an interesting one because of this push and this pull. 2%. Ouch. Again, because Microsoft's down 10%. Meta can't lift that up. A tough day for tech. At the top of the pile, we showed you what some of those energy names like Exxon were doing, so that means that it's moving. The reason Meta's not helping, just thinking out loud here, is because it's listed in this index, communication services, and that's why that's up 2.25%, and tech is down. Industrials, financials, materials, leading out the rest of the pack in this morning's session, Matt.
I want to also add, I can confirm Tesla's free cash flow number was the same as the data point sent in by a viewer. Thank you, Tommy, pointing out that free cash flow came in for Tesla at $1,420 million.
Thank you for bringing us that, Matt. And a very important figure.
I just want it, like the function, MODL on the Bloomberg, right, for any equity. It's such an incredibly good and efficient function that
do you think Tesla was like, shoot, we're at 419, everybody ramp up the sales, we got to get to 420?
I definitely do. Somehow they massage it in the right way, all the right ways. Coming up, Meta's AI spending is double what analysts expected, but shares are climbing. They like to see that kind of spending. We'll discuss this with Madison and Wall's Brian Weiser next. This is Bloomberg Open Interest.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Let's get you some top calls. A look at what the sell side is saying this morning. First up, Barclays, they upgrade Zillow, saying housing markets can remain nearly stable for the company to execute well. The firm sees solid mid-teens revenue growth, faster profitability gains, and improved execution. Shares are just slightly dropping, though, this morning. BMO Capital Markets, they are downgrading First Solar, saying Tesla's plans to build large-scale vertically integrated solar manufacturing could be a meaningful competitive threat. Shares clobbered, down almost 11%. And to the upside, Meta's strong revenue outlook is easing Wall Street concerns around rising AI costs. JP Morgan said Meta is earning the right to spend as revenue and engagement pick up. Morgan Stanley pointed to the fastest growth in over 4 years, driven by monetization. Shares up more than 7.5%, Matt.
All right, let's focus in on that because joining us for more on Meta is Madison & Wall principal Brian Weiser. And, you know, it's fascinating that the market likes it when they say we're going to spend 85% more than the record spend last year, up to $135 billion. I think, by the way, that's a corporate record for CapEx.
Must be.
I was looking at, like, Saudi Aramco, their biggest number was $50 billion. And yet, I understand it because they made, what, $60 billion in ad revenue in 1 quarter?
This is a $200 billion revenue company, and at the current rate of their expectations, they'll be 250 maybe by the end of next year, which is a stunning number. Still not as big as Google, by the way, but still a really stunning number. The point is, though, that they will claim that the AI investments are allowing them to be better at driving perceived performance. Perceived is a key word. They're better at segmenting marketers differently, better at segmenting users, better at finding ways to add to the ad load without maybe people noticing. So there's all sorts of advantages that they get from it, and that's really driving it.
Well, forgive my ignorance. What is perceived performance?
Well, they can attribute a sale based on the idea that you were exposed to an ad. Whether or not you were actually incremental, maybe they were really good at targeting the person who was already going to buy a product.
Yes.
And they get credit for the sale. That would be the perceived performance. They're really good at that. They might drive real performance too.
No, it makes a lot of sense. Like, I am a big fan of flannel shirts, right? And I love this little brand, Outer Known, and I buy stuff there. Yep. So as a result, Outer Known ads pop up in my Instagram feed all the time. But I bought the shirt first before the ad popped up, not the other way around.
So Meta knows a lot about you because they're really intelligent in terms of their systems, and they know that you're already buying it offline, let's say. Whether or not you were exposed to the ad may or may not have a factor in driving that. It may have been coincidental, but the attribution tools that they produce, which are really good, might just say that they cause the attribution.
We are getting a lot of, finally, interest. I mean, this is, people have been trying to make wearables for so long, and it feels like it's finally gotten to a point where people are into it. There's been rave reviews of the Ray-Ban Meta ones. The information reporting that Apple is starting to develop like an AI pin. How much does that change the advertising game when they all of a sudden have access to data? That's like literally what you do every day.
It probably doesn't change it much in the near term. It's a little fantastical to think about, certainly marketers thinking about allocating advertising budgets in that manner. That doesn't mean there's not a real consumer product. And, you know, unfortunately, thinking about the events of this past week, when you think about how, like, consumers maybe might think, I think I need to have wearable glasses rather than holding onto a phone. Think about that as a consequence. That could be a catalyst, unfortunately. But I think that the idea of wearables, I think, do have legs in the long term. I know I'm waiting to get some.
Yeah.
But I don't know that it'll drive the advertising business at all.
But does it shift? I mean, if I could wear Meta Ray-Bans, instead of carrying my phone, I would probably use fewer Apple products, right? Does that massive business shift to Facebook?
There's always that risk, and that's also why you could argue OpenAI wants to invest in hardware too, right? They want to have devices. We're not sure in what direction it will actually take, but absolutely. Now, there's a form factor.
That's exciting, by the way, the new device, whatever it is, and we still don't know, right? That's coming out with the help of Johnny Ive.
Exactly. Yeah. The form factor is something that the world hasn't gotten over yet. Snap's been at this for a decade, right? Spectacles was kind of what the company really wanted to do when they went public in the first place a decade ago. We're not there yet. How long ago was it that IBM had a commercial showing these wearable glasses, right? I still remember them going, oh my God, I want that.
Or the original Google Glass. Everyone was like, you are an absolute nerd and dweeb if you wear these things. I did buy one of the original Snap glasses, though. I remember like queuing up in line on a Snap pop up Madison Avenue. I wore them once in San Francisco, and a random tech bro complimented on me, and I threw them in the trash.
I want the LinkedIn glasses, though. I want to go to an event and say, hello, Danny, how was your recent job appointment? I want to be able to look at
spooky. That's spooky, dude.
But I want that.
I know, but what is the line here? Because it does feel like we're getting into very like Big Brother, terrifying kind of future.
We're there.
I mean,
We've blown past that point.
I mean, have we? Are we just deciding that personal, I don't know, like any sort of privacy is just over for us?
I think consumers generally protest, and they don't like it when they're presented with the alternative of not having this, but then they're given convenience and ease. And this is the same with advertisers, too. They can complain about transparency and all sorts of other problems, but they're given perceived performance, perceived ease, and they take it. This is why you have to look at the European Union, where the basic premise is privacy is like your organs. You're not allowed to sell your organs, and you're not allowed to sell away your privacy in Europe. At least that's the spirit.
Let me ask about the contribution of AI, and not just to Meta, but all the companies that you cover at Madison and Wall. I mean, last year there weren't too many mentions of AI actually contributing to the bottom line if you went across S&P 500 earnings calls. And that seems to be picking up in this quarter.
Well, definitely for these companies and any of the digital advertising companies, it's driving so much of the growth. We estimate that about a quarter of Meta's ad revenue is coming from a product called Advantage Plus. Advantage Plus is like this kind of set it and forget it, make the creative on the fly, figure out where the ads go on the fly, everything's on the fly. For Google, that equivalent PMax, Performance Max, is a bit smaller, but this is where a lot of the growth is coming from. It drives performance the way that marketers want to see it. Again, whether or not it's really incremental is beside the point. But AI-based products are really critical for every digital platform, and increasingly for the non-digital ones too, like the traditional linear guys, the television networks like Comcast. They're not talking up the AI products. I didn't hear it on the call today, but their Universal Ads product would theoretically have an AI component for making creative for a small advertiser. So it is growing in importance for the whole industry.
I mean, just what we got from Meta last night just really amp up the bar for Google next week for Alphabet's earnings?
Expectations might be amped up. I mean, on the other hand, you look at Microsoft's numbers, which were a more reasonable, call it, whatever, 10% constant currency growth for the search and ads business, plus for LinkedIn. That's probably closer to where the ad market is. With that said, Google is so big, they're so much bigger than Meta, that they grow at the industry's level. And so if the industry grew 10, it shouldn't be surprised to see them grow 10. For Meta to grow 20 when they're half the size of Google, well, I mean, it's a lot easier to grow faster from a smaller base.
Hey, Brian, this has been such an interesting conversation. Please come back again soon.
Anytime.
That is Madison and Wall Principal Brian Weiser. Now, elsewhere in earnings this morning, Blackstone posting a surprise profit jump, deal making heating back up. Fourth quarter distributable earnings rose to $2.24 billion, helped by a surge in deals. I spoke with President and COO John Gray earlier to talk about what's fueling the rebound.
It feels to us like that 2013-14 period where after the hibernation following the GFC, we began to take a number of companies public, notably Hilton Hotels. And it looks like it should continue. As long as markets stay where they are, I think we will see a lot of activity. That's obviously good for us and our investors. I'd also point out for us that the decision we made to lean into AI infrastructure, becoming the biggest investor in data centers, becoming the biggest provider of private capital to utilities, the lead investor today in electrical equipment and related services, that's really delivered great results, and there's a lot of momentum there as well. And then I'd just say finally that we continue to see this secular shift towards alternatives. Insurance companies, individual investors, institutions. We had $71 billion of inflows in the quarter, $239 billion in the year. So a lot of good things are happening, but certainly the deal backdrop is quite favorable.
Whenever things are so good, people love to pick for holes in it and reasons they might not be good. John, there was a Bloomberg survey of private capital investors basically saying what could blow things off course. For them, it was macroeconomic or rate instability. For you, what is your concern that could blow things off course, and what is set up to be a strong year?
Well, you always can have things geopolitically. That's a risk that always exists. Certainly long rates, if you saw that back up, that could slow down the deal environment. But I'd say overall, the picture looks pretty good. We've got an economy with a fair amount of strength. Our private equity companies in the quarter had 9% revenue growth. That's obviously positive. We continue to see cost of capital coming down. Spreads are at very low levels. That's helpful for the deal environment as well. And then this AI world, this huge investment that's happening that we're helping to facilitate, and then the huge productivity boom that's going to come, I believe, after that is another positive. So there are always risks out there. You've got to be thoughtful in how you deploy capital. But the overall environment to us feels pretty good. I think this should be a strong year.
How do you navigate that AI spend specifically? Obviously, a huge boon to Blackstone. But on the other side, you have, for example, in public markets, Microsoft has earnings yesterday, and everybody freaks out that they're overextending themselves on CapEx. How do you find that balance of investing and capturing this new economy versus the fear of overextending yourself and bubble fears that emerge?
Well, I'd say how you invest really matters. So a lot of what we've done here is, as I said, this infrastructure, and it's based on long-term contracts with credit-worthy counterparties, and that makes a huge difference. So if you're building a multi-billion-dollar data center in the US or around the world, and you have a 15-plus-year contract with a company with a $3 trillion market cap, that feels pretty good. Similar dynamic if you're doing something around energy, be it an LNG or a new power plant, you have a long-term contract. So I think there are ways to do this that are more downside protected. At the same time, we're trying to capture the upside selectively, you know, around some of the big LLMs, around some of the application software, but we're mindful of how much investing we're doing. We're also mindful of the risk, but there's also a fair amount of upside. I do think what's interesting is everyone's focused on these bubble risks. I think the biggest risk is actually the disruption risk. What happens when industries change overnight, like what we saw to the Yellow Pages back in the 90s when the internet came along, or what happened to Uber when Uber and Lyft came to the taxi business 10 years ago.
That was my interview with Blackstone President and COO John Gray. We'll have more of that conversation in the next hour. Matt, and I went on to ask him, okay, you're worried about the disruption of AI, and that's the biggest threat. What are you rethinking? And he said something we've had guests on the show talk about. Some of these IT companies, some of these software companies that are really set for disruption. There's a lot of private capital firms out there that have put so much money behind these companies, and ones that are specifically built just around them. What happens when that changes and AI eats their lunch?
Yeah, no, it's one of the biggest questions that I have, you know, when we look at, some of them are huge companies, right? Yeah. And previously, the reason they're so big is because they had such huge margins. But those margins are going to get shrunk when people start using AI. Like Joe Weisenthal of the Odd Lots podcast is coding his own programs.
Yeah, he loves Claude, and a really interesting episode on that. By the way, we were showing a little teaser of it coming
Good point.
Next week on Wednesday. Follow the Money with Bloomberg Deals, my new show that dives deep into coverage of the biggest mergers, power players, private capital, and capital flows shaping global markets. Again, it starts next Wednesday, appointment viewing. But coming up in the next hour, we're going to talk even more deals, AI infrastructure with I2 co-founder Sadiq Waba.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US, or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
CBS News on the Hour, your home for original reporting.
I'm Christopher Cruz. President Trump's border czar Tom Homan told reporters he's been ordered to make changes in ICE operations in Minneapolis.
President Trump wants this fixed, and I'm going to fix it.
Homan says his meetings with Minnesota leaders this week have been constructive.
We've come a long way.
He says he's working to make the immigration crackdown safer. Agents will conduct more targeted enforcement operations. Homan urged everyone to tone down the rhetoric.
I said in March, if the rhetoric didn't stop, there's going to be bloodshed. And there has been. I wish I wasn't right.
Michael Wallace, CBS News.
Homan says ICE and CBP are working on plans to draw down the number of federal agents deployed to Minneapolis. Republicans are taking seriously Democratic threats to hold up approval of funding bills for a number of large federal agencies unless ICE makes changes in the way its agents operate. CBS's Caitlin Huey-Burns has that.
Essentially, what Democrats want to do, and the White House apparently seems open to this, is separate out that DHS funding bill from the rest of the package. So pass the rest of the package, things like funding the Pentagon, transportation, education, and other agencies.
In Mississippi, thousands of homes and businesses haven't had power since the ice storm came through over the weekend. CBS's Tom Hansen reports.
Robin Tannehill, the mayor of Oxford, the small city home to Ole Miss, had to implement an emergency plan for its limited water supply to prioritize shortages at its hospital.
So it's going to be a long road to recovery. You know, it's hard to even get our minds that far ahead right now when we still have people without power and without water. We're still really in emergency mode.
Former Sangamon County, Illinois Deputy Sheriff Sean Grayson will be sentenced today. He was found guilty of second-degree murder in the death of Sonia Massey. She'd called police to report a possible prowler. Grayson shot her when she refused to put down a pot of boiling water. CBS News asked Sonia's cousin, Sante Massey, what kind of sentence the family hopes Grayson gets.
We know that it's not up to us. We are a praying family, and we know it's ultimately God's decision.
Grayson could get up to 20 years. More than 250 years ago, Benjamin Franklin said early to bed, early to rise makes one healthy, wealthy, and wise. CBS's Michael George says old Ben just might have been onto something.
A study in the UK found that middle-aged and older adults who are more active in the evenings tended to have worse cardiovascular health than people who are more active in the daytime. Night owls' unhealthy behaviors like poor diet, insufficient sleep, and smoking may be the reason for the disparity.
This is CBS News. Season 4, Part 1 of the steamy streaming series Bridgerton is being released on Netflix today.
Dearest gentle reader.
Season 4 of Bridgerton is a Cinderella story.
We must find the owner of this glove.
This time it's number 2 brother Benedict who finds his match at a masquerade ball.
Mr. Bridgerton.
Do we know one another?
Luke Thompson's Benedict falls for a household maid.
Falling in love and all of that is like one of the most universal things to talk about.
Yurin Ha plays Sophie Beck.
I would love for the audiences to take away that love has no bounds. It doesn't matter about your class or your race.
You sound as if you have been made a new man.
Deborah Rodriguez, CBS News.
Season 4, Part 2 drops February 26th. The Kennedy Center in Washington will host a screening tonight for the documentary Melania, the day before its release in theaters worldwide. The film follows the First Lady in the 20 days before Donald Trump's second inauguration. Christopher Cruz, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube as well, so check us out there. Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence program for the next 2 hours. Boy, commodities on the move in a big way here. I'm looking at gold moving higher, crude higher, copper up more than 10%. That means we need to check in with Mike McGlone. He's a senior commodity strategist for Bloomberg Intelligence. We'll get the latest on what's going on out there. Steve Mann, Bloomberg Intelligence Global Autos Analyst, will talk to us about Tesla planning a $20 billion splurge to support Musk's AI future. So back in the news again, Elon Musk and Tesla. Christina Hooper, she's going to be in our studio. She's a chief market strategist at the Mann Group here. Another big mover today from the earnings front is Microsoft. Down 10% in early trading here. They put up some numbers last night I thought were pretty good, but the street said no. So we'll check in with Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. So a lot going on out there in the marketplace with earnings, with economic discussion as well. We'll get to all of it over the next 2 hours. Right now, let's set the scene here with Lisa Mateo and a Bloomberg Business Flash. Lisa.
You got it. And this Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest costs and global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. You can learn more at ibkr.com/RIA. We've got stocks slipping. This, as Paul was saying, investors kind of sizing up those AI winners, losers. That's after that big surge in big tech spending. Looks like on the losing side, yes, Microsoft shares taking a hit. They're down 11%. The biggest decliner in the Mag 7. It's higher spending. Well, it conflicted with that slower cloud sales growth. Tesla shares, they're down about 1% right now. They're going to spend $20 billion this year on AI, self-driving vehicles. Also put another $2 billion into Elon Musk's XAI startup. The company's also going to discontinue its 2 oldest vehicles. That's the Model S sedan and also the Model X SUV. On the upside, Meta, they're saying they're going to double capital spending to which Musk says $135 billion this year. It also delivered stronger than expected sales outlook. That's thanks to its advertising business. Meta shares, they're up about 8%. Also in tech, IBM shares, they're up about 6%. Strong growth for its software unit. After the close, all eyes turning to Apple. That iPhone maker set for its biggest sales quarter ever. Its shares right now, they are down about 0.3%. So let's get to NASDAQ. Right now, down 1.5%. We have the S&P 500 down 0.7%. The Dow off about 0.1%. In the yield space, the 2-year 3.55%. That's down 1 basis point. The yield on the 10-year 4.25%, and that is up about 1 basis point. Gold surged to a fresh record. Let's take a look at COMEX Gold, up more than 2%, $5,460 an ounce. Also surging, copper up 8%, silver up about 0.5%. Brent crude hit $70 a barrel for the first time since September. Let's get to that eco data. More evidence of stabilization in the labor market. Initial claims, well, they edged down by just 1,000 to 209,000 last week. U.S. trade deficit, that widened in November from the lowest level since 2009. Imports rebounded. Exports fell. Right now, we have factory orders for November. That's coming in. The expectation was for 1.6%. Came in higher at 2.7%. That is your Bloomberg Business Flash. Scarlett and Paul will send it over to you.
Lisa Mateo, thank you.
you so much. We appreciate that. It's Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Bailey Lipschultz. Bailey, what are you looking at?
Yeah, I want to start with one of the best performers in the S&P 500. That is Southwest Air, ticker LUV, right now up, rounding up, call it 13%. Best day since April. Trading at the highest level since 2022. Why the big move? They beat expectations on the fourth quarter. They talked up demand for 2026, expecting earnings of at least $4 a share, well above what Wall Street was looking for. That'd be up over 300% compared to 2025. And it does stand out compared to the others that we've seen in the airline space. Delta, more mixed. American Air, more mixed in terms of print. So Southwest, yes, they were battered a bit by Elliott with their activist stake. No longer are they doing the free boarding. You actually pick your seat like other airlines. But so far playing out pretty well for the airline.
Just another airline now. It's lost some of that distinction.
My parents were like core Southwest users. They loved the credit card. You got promoted to A1 through 10. It was awesome. You got to select the exit row. They're out.
No more. All right. What's next?
Las Vegas Sands, ticker LVS, one of the worst performers in the S&P 500, down 12%. Yeah, as you mentioned, Paul, Macau, underwhelming. People not flying or visiting the kind of region to gamble. It does seem like when you look at growth, 23% win growth in 4Q, outpacing some of the market, but also the big debate has been VIP. How are they catering to their high rollers? Now they're competing with other casino operators on the island that are pitching to the average Joe. Have you gone?
Yeah, I've been there once. It is awesome. Man, did they do a good job. I mean, they created this gambling mecca out of nothing.
Is it better than Vegas, though? I've heard it's like kind of a knockoff Vegas.
No, it's very similar to Vegas. I mean,
Well, it has the colonial roots, though. So there's like fantastic Portuguese architecture there. There's great food. It has really come a long way over the last 20, 30 years.
So you're bullish Macau, even though the stock is down almost 13%.
I'm bullish Macau's an experience. I don't go there to gamble, so I can't speak to that.
I went there expressly to gamble. So, all right, what else you got for us?
Yeah, Microsoft, ticker MSFT, down 11%.
Yeah, it's amazing.
Just to put that into context, Meta right now is up about 8%. When you look at the point differential, Meta on the S&P 500 leading to a 14-point boost. Microsoft is a 46-point drag. So essentially 3 times the move when you look at the S&P 500, even though their performance is pretty similar. RBC calling it out, solid report, not enough to clear elevated expectations. AI, demand AI spending. When you pair that with cloud growth slowing, you're kind of dealing with an issue opposite of Meta, which we saw beating expectations and talking up how that AI investment is going to benefit. Big move for Microsoft. Just want to call out that that is the worst move since March 2020, which we all remember. Pandemic.
Right. Well, Azure only met expectations. It didn't really trounce them. All right, Bailey, thank you so much. Bailey Lipschultz with our Stock Movers. And for more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. You know what's been trading like stocks? Commodities.
Crazy,
right? I mean, every day we come in and there are these big percentage changes in gold, in copper, in silver. Chinese speculative buying, a big driver, of course, certainly during Asian hours. And today it's copper's turn. Let's bring in Mike McClone. He's our senior commodity strategist here at Bloomberg Intelligence. And Mike, what do we know about this Chinese speculative buying? And what do we still need to understand about this source of demand for metals?
Well, Scarlett, you started exactly where you should. The foundation for the rally for most metals and most commodities starts with the stock market. You're seeing that roll over a little bit today. We're also seeing that pressure maybe kick in a little bit. But you're pointing out right, there's something significant going on in China. There's significant buyers of all the metals. They really started with gold last year. Gold got expensive, so they trickled over to everything. The bottom line, though, with copper is it's not a speculative metal. It's industrial. And China's #1 source of demand. It's going up more because of issuances with the tariffs from the U.S., and supply constraints. And I'm very concerned. The copper's, I'm very concerned. As long as the stock market gets going up, it's fine, but I'm afraid it's going to tilt back lower. But here's a key thing that's oftentimes directional for copper. Iron ore hasn't been doing well. Chinese bond yields haven't been going up. They've been going down. So I think by this time at the end of the year, we're going to look at the metals like we are cryptos now.
All right, Scarlett, we all know that Mike McClone is based down in Miami. Get this, Saturday in Miami, low temp, 37 degrees. People will be freaking out down there.
That's brutal for Miami.
Brutal.
I mean, fortunately, Mike McGlone knows how to deal with this because he comes from here.
He's a grizzled guy from the Midwest. Mike, when I look at copper, I don't think speculation. When I maybe look at some other precious metals, you can tell me some people are speculating here. So is copper, when you see a move like today, is it really based on some fundamentals, or is it too also subject to some speculation?
It's short moves like this, almost always speculation. Some of that short covering, I myself thought it was a worthy short around 6. It still might be, but it's still a bull market. So we're covering those people out. They're taking them out on stretchers. The bottom line, though, is number one thing to remember about all these metals, when they go up, that's their own enemy, and then they end up going back down. That's number one. The thing I'm really worried about this year, silver leading everything. When silver leads rally, you back off, and that's just an indication, because silver is usually the one that causes the most pain, and we're overdue for those days where it's up and down, and maybe both, 10% in one day. It's way overdue for that.
Yeah, silver doesn't have the volume or the liquidity that a gold does, or even a copper does. Mike, we see these commodities getting a huge lift as the U.S. dollar sinks, the Bloomberg Dollar Index hovering near this 4-year low. What is leading what? Is it the dollar or commodities?
Well, there you go, Scarlett. The dollar is weaker. I think that's leading, and it's kind of not said, but we all know if you want to fix a trade balance, you need a weaker dollar, so that's what's happening. The bottom line, though, to me is, remember, it's January. This is the time of year where you put on new positions, and oftentimes it's the wrong thing to do. Crude oil peaked around January last year. Corn peaked around the same time last year. And it's just, is this going to be enduring? So to me, the number one thing to look forward to is, can we keep this up? And that's why when you start out with the stock market, has to stay up for most of the industrial commodities to go higher. Most all of them are. And the only ones the least industrial is gold. So here's one thing I'll end with. As of this morning, the ounces of gold it takes to buy one S&P 500 is 1.26. That's the lowest since 2013. So the stock market is actually collapsing versus that ancient store of value.
Ah, interesting. Okay. Before we let go here, on oil front there, Mike, I guess when the U.S. sends in a carrier group near the Iranian waters, that gets people's attention. Is that kind of what we're seeing here?
To use President Trump's word, the word armada in that area is always going to boost crude oil. But the number one thing crude oil traders like is when it spikes for potential supply disruptions out of the Middle East. They just love that as a chance to sell. So crude oil around $65 a barrel at WTI is right around last year's mean median mode. It's the first place to test a short to see if it proves you're wrong. And I think potentially by the end of the year, we'll be lower than that. But remember, the bottom line is, for the midterms, we need lower energy, lower interest rates, and lower yields if Mr. Trump is going to have a chance, and he has an ability to potentially make that happen.
All right, Mike, good stuff. Stay warm down there. I mean, boy, you're going to break down below 40 maybe over this weekend. Brr, for the people down in Miami.
By the way, we managed to escape, we think, the worst of the winter storm that's now
coming
brewing.
This weekend. Yep. Right, all right. Mike McGlone, he does it all for us, senior commodity strategist for Bloomberg Intelligence, doing some great work down there on the commodities. And again, as you mentioned, Scarlett, these commodities are just ripping all over the place, looking at the metals. And again, copper today is probably this story. That's up about 9% today, just trading. So it's just been a real move in the commodity.
There's a lot of talk that there's traders who are on these crypto native exchanges and platforms. They're moving away from Bitcoin and trading these metals, like gold, like silver, and probably these days like copper.
All right, very good. All right, a programming note, folks. California Governor Gavin Newsom joins Bloomberg Business Week editor Brad Stone for a fireside chat in the latest edition of Bloomberg Newsmakers. Tune in at 2:15 p.m. Wall Street time on Bloomberg Radio, Bloomberg Television, and the Bloomberg Podcast channel on YouTube. Governor Gavin Newsom, California, 2:15 p.m. Wall Street time with Brad Stone. S&P down 59 points. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers Studio, I'm Lisa Mateo. Some cautious trading on Wall Street. This is over concerns on whether that surge in AI spend will translate into earnings. Let's start with the NASDAQ. It's down more than 1.5%. We go to the S&P 500. It's falling by 0.7%. And the Dow, that's off about 0.1%. Over to the yield space, we have the 2-year 3.55%. That's down 1 basis point. The yield on the 10-year 4.24%. And that is little change. Gold extending its rally. Let's look at COMEX Gold, up 0.7%. $5,379 an ounce. Copper surged by the most in 16 years. It's now up more than 5%. Silver extended its year-to-date advance. Right now, silver, though, it is falling about 2.5%. Brent crude at $70 a barrel. This is at President Trump. He renewed threats against Iran, and that's why that is up at that price. Bloomberg Dollar Spot Index, it's strengthening by about 0.1%. Over to Bitcoin right now. I want to point out because it's down more than 4% at just above 85,000. Let's move on to Caterpillar. It got an earnings boost from selling power generation equipment to AI data centers in its fourth quarter. Now, the company's power and energy segment, it's now its biggest and fastest growing segment, posting a 25% profit jump compared to that year earlier period. Its shares are up more than 2%. Comcast reported revenue profit in the fourth quarter met or surpassed expectations. Shares are up more than 4%, and that's even as it continued to lose cable and TV internet customers. And finally, Lockheed Martin shares are on pace to close at a record for the first time since October 2024. After it forecast 2026 earnings that was above expectations, its shares are up nearly 7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate it. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Tesla reported numbers last night. One of the things that jumped out at folks is Tesla said it will spend over $20 billion on a dramatic reshuffling of factory lines to ramp up production of cars, batteries, and robots across a half a dozen plants. So a lot going on at Tesla as usual. Let's get the latest analysis there from Steve Mann. Covers all the autos companies globally for Bloomberg Intelligence. He's down there in Princeton, home of the best Bloomberg lunch. I'll tell you that right now. Steve, talk to us about Tesla. What's going on there with Elon? How's he kind of shuffling up this company?
Yeah, Paul, I think the most, what stood out for me was really that the AI investments that they have made in the past few years, it's actually being converted into returns. And that visibility of that return is much better after the call. You know, they actually codified and put in black and white in their presentation the rollout plan for the robotaxi. And, you know, they're looking to roll out into 9 different cities, mostly in the South, in the first half of this year.
Okay, so some visibility is always great when it comes to Tesla because so much of the story driving Tesla is Elon Musk's storytelling skills and capabilities here. Tell us a little bit more about what Elon Musk said when it comes to Tesla needing to build its own semiconductor factory. I mean, we're just getting our head around the cars and the you know, the self-driving vehicles, the AI, robotics, and now we're talking about chip making.
Yeah, that's the Tesla business model. They are vertically integrating. They're looking at the whole supply chain, whole value chain, to see where they can cut costs. But the other thing that you know, Elon Musk mentioned is geopolitics. That plays a role in why they want to build their own chips. But the other thing is there is a huge demand for chips across the board, AI chips, memory chips. We've already are seeing some shortages on memory chips in the automotive supply chain. So it's not a surprise that they're going vertical. They want to ensure there's a source, and they want to make sure that the technology stays in-house and they have control of that technology.
Optimus humanoids. What is that? And is that something that's going to be material for this company?
Yeah, according to what the company's saying, they are making progress. They're going to launch the next version of the humanoid robot. They're actually stopping the Model S and X production and sales. It's pretty low anyway, and converting that factory to humanoid robots. But we still think it's years away. I think for it to be commercially viable, and interest from the marketplace, it's probably won't be until the end of the decade. But they will use some of that robot within their own factories.
Steve, what about Tesla sinking another $2 billion into Elon Musk's own startup, the XAI? Do people have a way of seeing whether that has a return on that investment? I mean, is it just money that goes in that one direction?
Yeah, there seems to be a lot of confusion in the market, but to me, it's actually a right thing to do. Because first of all, Grok, which is part of XAI, it's already in their vehicles, operating in their vehicles as a navigational assistant. And then as robotaxi rolls out, I think they want to personalize those robotaxis. And Grok, through XAI, is the perfect tool to do that. System to do that. So, if Tesla's going to use the services from XAI, I think they need to pay for it. So $2 billion investment into XAI makes sense.
I see.
All right, very good. We got the Tesla stock down 2% today, down 6% year to date, and up about 8% over the trailing 12 months. So a lot going on, a lot of cross currents there. The Tesla story, for a lot of folks, it just comes down as a bet on Elon Musk. Steve Mann, thanks so much for joining us. Appreciate it. Steve Mann, Global Autos Analyst at Bloomberg Intelligence. The Fed yesterday, that seems like a year ago now.
I know.
It's just because there's so much news overnight, so much earnings. It's just,
and they didn't do anything.
And they didn't do anything. But, we'll have to see how that plays out. So there's some people that paid attention to it yesterday. I wasn't one of them. Christina Hooper, Chief Global Market Strategist at the Man Group, joins us here live in our Bloomberg Interactive Brokers studio. Thank you for braving the cold to come into our studio. Christina, what did you take away from Fed Chairman Jay Powell yesterday? As Scarlett mentioned, it was kind of as expected, but was there anything that jumped out at you?
Well, one thing was that I thought he was way too optimistic when it comes to the labor market.
Okay.
Obviously, the language changed there, and he was looking for a rationale for putting rates on hold and entering a pause phase. My concern is that I don't see signs that this labor market is improving. Yes, we got solid numbers today, but what we've seen is a hiring rate that's gone down significantly. We're at 3.2%. The average over the longer term has been 3.7%. And I would anticipate that we are going to see an increase in layoffs this year, so that what he had called a balance in a lot of different press conferences will now be a mismatch, where we'll have lower hiring, higher layoffs. That is one of my big concerns for the economy in 2026.
And the earnings reports that we've gotten so far, or the company remarks, kind of back that up, right? Amazon being the latest example of 14,000 jobs being cut there. So you were already heading into this FOMC pretty bearish. You had talked a little bit about the possibility of a recession. Do you still think that's a possibility?
Oh, absolutely. I think this is an environment in which we could very well see a modest recession. Yes, productivity gains have been very significant, but we have to keep in mind that the U.S. economy is one that is driven by consumers. And if you have consumers that are already under significant pressure, lower income consumers, middle income consumers, you're relying on higher income consumers, and they may not be able to deliver, especially if you were to see, for example, some kind of a stock market sell-off, as the wealth effect has a big impact on consumer spending for high income consumers.
The consumer confidence number, Paul, earlier this week, showing it's at the lowest since 2014.
Absolutely. How about the potential benefits from the One Big Beautiful Bill in terms of maybe tax relief for some consumers? How does that factor in?
So I know some are hanging their hat on that, but if we were to look at actually where the tax cuts are going, it's to upper middle and higher income households for the most part. That tends to have a lower multiplier effect because among those households, they tend to not spend all of it, save some of it, as opposed to tax cuts or any kind of benefit payments to lower income households where every dollar, or almost every dollar, is actually spent. So the multiplier effect is much higher.
I know that you've been more favorable on overseas markets than the U.S. as a result of all the outlook you have for the U.S. economy overall. However, you look at what's happening overseas, Chinese speculative buying driving up metals prices. There's a lot of speculative excess out there in the markets. Where do you go for some confidence that you are getting in at a good valuation as opposed to chasing these highs?
So I think it's two things. First of all, we want to look at the valuations of individual markets. And so if we look at Europe, for example, valuations are relatively low. Asia EM, with the exception of a few markets like India, valuations are relatively low. But for me, it's valuations plus a catalyst. The catalyst in Europe, of course, is defense and defense-related spending. And in Asia, it's drivers like AI CapEx spending. And it's not just coming from the U.S. Much of it is being driven by Chinese CapEx spending around AI, which is a very different beast, and I would argue has longer legs. But there are also other drivers, electric vehicles, semiconductors that are driving Asia EM. So at the end of the day, it's also about diversification because there's a lot of uncertainty. And so ensuring exposure to a broad range of equity markets, a broad range of asset classes within fixed income, and of course, having adequate exposure to alternatives. Those asset classes or sub-asset classes that have historically had low correlations to traditional equities and fixed income. That's how we have to proceed in this kind of environment of very elevated uncertainty.
How does fixed income fit into your outlook here these days?
Well, so I would argue that we need to be cautious and be well aware that central banks are moving in different directions in different parts of the world. There is nothing very coordinated as we see fragmentation on the global stage. So it's about looking at, for example, where the opportunities are in investment grade, and I see that in Europe, as well as a bit in the way of opportunities in high yield, which I see in Europe as well. But again, I think at the end of the day, it's about being well diversified and having that exposure to precious metals as well.
Yeah, you're right.
Really? At these levels?
Absolutely. Absolutely.
How? How do you express that?
So one could have exposure to mining stocks. One could have exposure to the physical gold, the physical silver through ETFs. There are a variety of ways to do it, but I think it's important because historically that has had has had low correlations. Hasn't had such low correlations recently, but I would argue that's because of the kind of unusual market environment we're in, where two emotions are driving it: fear of missing out and fear.
Yeah.
and things aren't going well if gold prices are going up so much. I think about an old Jerry Seinfeld joke. If you're 35 and you're moving home with your parents, that's a sign that things aren't going well.
Right.
When gold prices are going up as rapidly as they are right now, that's a sign that things aren't going well, and there are certainly real risks in this environment.
Christina Cooper, thank you so much for joining us. Really appreciate it. Christina is a Chief Global Market Strategist for Man Group, joining us live here in our Bloomberg Interactive Brokers studio. A programming note, folks, we will hear from New York City Mayor Zohran Mamdani when he joins Bloomberg Balance of Power today. That'll be at 5 p.m. Wall Street time. You can listen live here on Bloomberg Radio or watch it on Bloomberg Television and the Bloomberg Podcast channel on YouTube. So we'll have that for you as well. S&P down 75 points. The Dow off 250. NASDAQ off 470. That's about 2% here. Microsoft selling off about 12% today, bringing down NASDAQ. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks slipping with the NASDAQ leading the losses. It's down more than 2%. The S&P 500 down more than 1%. The Dow right now off 0.5%. The two-year yield, 3.54%. That's down 2 basis points. The yield on the 10-year, 4.23%. That's up 9 basis points. Over to commodities, have to point out COMEX gold is down nearly 2%, but at $5,237 an ounce. We have copper up nearly 3%. We have silver down about 6%. Over to Brent crude, it's at $70 a barrel. The currency is the Bloomberg Dollar Spot Index. That's strengthening by about 0.1%. And Bitcoin right now, it's down 5% at just above 84,000. Over to company news. NVIDIA CEO Jensen Huang, well, he is setting the record straight. He's saying that the company has yet to receive. The company says users, well, they're just wearing the new leggings incorrectly. They say if you sized up and wore seamless skin-toned underwear, it would solve the problem. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, Lisa Mateo, with our Bloomberg Business Flash. All right. Tech stocks are really in focus. The NASDAQ Composite Index, Paul, is down 2.25%. The Mag 7 names began reporting yesterday, and it's really a split view here when it comes to those big tech names. And another one is on the docket tonight. You've got Apple reporting this evening at 4:30 p.m. Wall Street time. And of course, we know that the latest Apple iPhone came out, so this is a huge quarter for the company. Anurag Rana is our technology analyst, and he covers all things big tech. Anurag, Apple, there's a lot of good talk, a lot of good feedback on the latest Apple iPhone. I think it's the 17. Are we talking about the 17? Yeah, I think it's the 17. I've lost track of the numbers here. But that is, once again, the driver for Apple, even as a lot of the questions remain on its AI strategy.
Yeah, I think, tonight we already have a glimpse that these guys are going to do okay in terms of total revenue growth for the first time for the iPhone. I think it's going to be in double digits. And there is a bit of strength, as you said, on the iPhone 17 family of products. But there's also a trickle-down impact from what they could not fulfill in the prior quarter, and that's going to bleed in. So that's going to be all good. I think, the big question right now is whether the rising memory prices are going to have the impact on their margins, and when does that show up in their numbers, and whether they're going to offset that with any price increases. So that's, I think, probably the most important thing as we look at Apple today.
Explain to us just again where we are right now from an Apple perspective as it relates to AI. What is their strategy? How are they executing on it?
In our view, I think this is probably the best strategy. Let the world go out and fight who has the best model. Then they're going to go out and rent that model. Because imagine this. At this point, Microsoft, and then we have talked about this, I think, for about 6 months now, is going to spend somewhere north of 40% of their sales into CapEx. For Apple, that number is 3%. So they don't have to go out and spend hundreds of billions of dollars to figure out way to get the next model. Whoever is the one, they're going to go out and use it and put it in their operating system and make it smarter. And the question is, well, why can't you do it in-house? And our answer is, why do they have to do it in-house? They didn't do that for search. Whoever has the best search product, they just use it, and they will pay the money, or somebody will pay them to do it. So from our side, we like it financially. I think it is the right thing to do. And we'll, I think this year, that would be one of the bigger differentiators for Apple compared to all the rest of the large tech companies.
Do we know how much Apple is paying to be able to embed Gemini into its software?
Yeah, I think Mark Gurman mentioned about $1 billion a year, something like that. Now, again, they have not disclosed that number, but that's not just the only thing. That's just probably the licensing fee. Then they're going to probably use Google's data centers to host those, transactions or those queries at that point. So it will have an impact on their operating expenses. But frankly speaking, for a company that generates, let's say, $400 billion in revenue, that's nothing. I mean, compared to if you have to go out and spend $100 billion and you don't even know whether that model model will be good enough. Now, they allocated all the GPUs to Azure, they would have grown north of 40%. What's happening right now within Microsoft is the cloud capacity that they have built, and they've done a very good job about it in the last 12 months. They're allocating it differently, whether it's their GitHub Copilot, which is the coding agent, or the M365 Copilot, their Azure business, and also internally for their R&D. And that, if you can only have this much capacity, you will realize the revenue only on the Azure side. And I think that's where the mismatch is. The biggest question people are asking is, well, the CapEx is growing in the 60s, but their cloud revenue is growing on the 30th. I think it's a bit silly, to be very honest with you. They know what they're doing in terms of R&D for future growth. But frankly, from our side, 38% growth is not a bad number.
No, it's hard to hold your nose at that. But is this a company that gets worried about this kind of market reaction, or like you said, they're confident in their strategy overall? They're going to move forward with this regardless of whatever message investors might be trying to send.
No, I don't think they will change their strategy. I mean, they are doing whatever is right for the Microsoft product of families. And because you think about it this way, in 7 years, by 2032, they will lose the IP that they get from OpenAI. They need their own models by then. They have to have it. So if they're going to put some R&D dollars to take care of that, so be it. I mean, I don't think that's a problem. They are actually, even now, one of the bigger beneficiaries of all the Gen AI spending that's out there. It will all come back to the cloud. Whether it takes a year, 2 years, I don't think that's a problem from a long-term point of view.
How about CapEx? We saw Meta put a huge CapEx number up there, way above where the street was forecasting. Here from Microsoft, their CapEx up dramatically as well, up 66% from the year earlier. How do you think about CapEx, or how's the market thinking about CapEx?
So it depends on who's spending the CapEx. So when we think about it, the three most important companies in our view is Amazon, Google, and Microsoft, because they have really strong cloud business that can monetize it. How Meta monetizes it, I don't know. And frankly, the reason for that is because they're saying they're going to drive more engagement internally with their products, but they don't have a cloud business that can monetize it. Their model is not being, bought by Apple to put it in the operating system. So I have no idea what the future for that CapEx is, but I feel very comfortable with the CapEx that's driven by the three large hyperscale cloud providers, because we know the business that they're in and where the monetization is going to happen.
Okay, before we let you go, just a quick recap of what happened with IBM. Good enough for an almost 5% gain. What were investors responding to?
Yeah, I think it's, again, a game of low expectations. That's where the revenue growth rate was better. They came at, the total revenue growth was 9%, but the software division was around 11%. So I think that's really the benefit. But think about it, ServiceNow down so big, their growth rate was in the 20s. Microsoft, same thing. So it's all a matter of relative expectations, today.
All right, very good. Anurag Rana, a lot going on out there in the world of tech, including Apple after the close today. Some big numbers being bandied about for CapEx. Anurag Rana, technology analyst for Bloomberg Intelligence, joining us from Chicago. Folks, a programming note, California Governor Gavin Newsom joins Bloomberg Business Week editor Brad Stone for a fireside chat in the latest edition of Bloomberg Newsmakers. Tune in at 2:15 p.m. Wall Street time on Bloomberg Radio, Bloomberg Television, and the Bloomberg Podcast channel on YouTube.
He's going to be fiery, Gavin Newsom.
Yeah, I think so. Absolutely. I mean, he's been pretty aggressive in pushing his agenda forward, and as it relates to President Trump and what the Trump
raising his national
doing.
Profile and kind of becoming the torchbearer for the Democrats.
I think so. That might be how he's setting it up. So that'll be a fascinating discussion today. Again, 2:15 p.m. Wall Street time on Bloomberg. This is Bloomberg. Good morning.
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. All right, you're looking for an AI stock? How about this one? Bet you didn't think about this one. Caterpillar got an earnings boost from selling power generation equipment to AI data centers in its fourth quarter. Stock's trading up today. It's hitting a 52-week high. How about that? Chris Giolino, he covers Caterpillar and all of those other construction companies, manufacturing companies, senior U.S. machinery analyst for Bloomberg Intelligence. So, Chris, I bet you didn't think early in your career that Caterpillar would be a tech play. Talk to us about their quarter.
Yeah, no, certainly not. And, you know, it was one of the, I think, the top performers last year in the market, and certainly off to a good start this year. Quarter was solid, you know, beats both on the top and bottom line, really driven by higher than expected volume in their power and energy business, as you alluded to. But I think the real standout and the takeaway this quarter was really the unprecedented order and backlog growth that we saw. Now, we came into the quarter with backlog already sitting at a record level, but we saw orders increase more than 70%, which drove nearly a 30% increase sequentially in the backlog. And what's encouraging, it seems that it's pretty broad-based. It's not just the data centers and AI. It's construction starting to contribute, mining starting to contribute. So you're really starting to see a lot of momentum starting to build moving into 26 as we get these, not only the cyclical recovery start to materialize, but also the secular tailwinds kind of converging here.
So it sounds like a number of different drivers, and do they all move to their own timeline in terms of that cycle? You know, they're all kind of hitting their stride at the same time?
Yeah, I think as we go into 26, you are starting to see those cycles converge. The more cyclical mining and construction businesses have kind of been bouncing along trough for a couple of years now. We're finally starting to see some stronger order activity and momentum building on the non-res and even on the residential side in North America. Mining, you're starting to hear of some more projects on copper and gold. And then obviously they can't add capacity fast enough when it comes to power generation. They're going to be more than doubling their large engine capacity through the end of the decade. So that's more of a supply constraint as we look here, at least in the near term.
Chris, so when you talk to institutional investors about your group, do people just buy the group, i.e. machinery, construction, and when the cycles are coming together and then sell them when they're not? Is that, or do I have to be real bottoms up on individual companies?
You know, it varies, and I think it is becoming a little bit more bottom up. You know, historically, for example, trucks, right? You'd always buy when truck orders were at their worst and bottoming. That's a short cycle business. You'd kind of pile into those names at that point in time. Ag is a little bit idiosyncratic in terms of how those cycles work and a little bit detached from your traditional economic cycles in that it's more driven by crop prices and farmer incomes. And then construction equipment, certainly a more cyclical GDP type play. But what you're seeing now is you're starting to see some divergence between, you know, those names that have the data center AI exposure, like the Caterpillars and the Cummins of the world. And those have really outperformed over the last 12 months because of their exposure, where a lot of the other machinery names just aren't as levered to the data center play.
How exposed is Caterpillar to tariffs? I mean, there are some tariffs in place, and there's, on a daily basis, threats of new tariffs being put in place.
Yeah, if you want to pick apart one negative in the quarter, it was the tariffs. They did come in a little bit higher than we expected, and it continues to weigh on margins, particularly in the construction and mining businesses. Tariffs in aggregate were roughly a $1.7 billion headwind in 2025. That's going to step up in 2026 to about $2.6 billion. We've really seen Caterpillar kind of hesitant to push price to start to offset these. And I think that's really been a concerted effort to try to gain market share, particularly as we are at a softer part in the cycle. I think pricing is going to become much more of a contributor as we look into 26. Right now, they're guiding to about a 2% contribution on the pricing side, but I won't be surprised to see that go a little bit higher, particularly as some of their end markets start to recover.
Those front loaders, dump trucks, all that kind of stuff. Where do they actually manufacture this stuff?
all over the world, right? They are the largest equipment producer globally. Wow. They have a pretty extensive manufacturing footprint here in North America, but it is a very global business, and they certainly have a market leadership position in most of the products that they sell.
I know we like to look at Caterpillar as kind of this barometer for global GDP because it's so exposed to all over the world. Did the company say anything in regards to what it is anticipating for growth for this year, like hotspots and maybe slower parts of the world?
Yeah, so they put out back in November at their Analyst Day a 5 to 7% revenue CAGR target through the end of the decade. They're kind of guiding us to 26 being kind of towards the top end of that range. So think, 7% plus type growth. We actually think that might end up being a little conservative, just given the strength that we're seeing in the order book, just given that the backlog continues to sit at a record level. So we have really extended production visibility here for 2026. So I actually think that outlook could be a little bit conservative, particularly as we continue to see a lot of their end markets come off the trough.
And tell them to do a 10-for-1 stock split. Stock's $650 a share. It always gets me. Got to be tough for some investors to buy it. Chris Giolino, he's a senior U.S. machinery analyst for Bloomberg Intelligence, covering Caterpillar, putting up some good numbers today. Again, stock hitting a 52-week high today. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence begins in just moments with a broad sell-off in the marketplace here. The S&P off 1.3%, the NASDAQ off 2.4%. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI?
When it comes to China?
Bloomberg. Scarlett Fu and Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning. The Bloomberg Intelligence team, Paul Sweeney and Lisa Mateo in the Bloomberg Interactive Broker Studio and streaming live on YouTube. Coming up in this second hour of Bloomberg Intelligence, AI spending worries a big theme this earnings season for a handful of big others. So we'll all the earnings that have come out. Paul, our senior equity analyst, the top shareholder. Mandeep Singh, he is our global tech research head, will talk to us about Meta. AI spending, not so much a concern for Meta, given how its share price is rallying today. We'll talk to us about Meta. AI spending, not so much a concern for Meta, given how its share price is rallying today. Winnie Caesar is the global head of strategy at Credit Insights to give us her outlook on the markets. A lot of tech companies following a lot of big banks in selling debt right now. And Jody Laurie, she is our credit analyst, will talk to us about Royal Caribbean jumping on accelerating demand, and that is spurring some fleet growth. Geeta Ranganathan will give us the latest on what's going on in big media as well. But first, let's go to Lisa Mateo for our Bloomberg Business Flash.
You got it. We've got stocks really slipping. Investors sizing up those AI winners and losers. You talked about it. It's that surge in big tech spending. Looks like on the losing side, we do have Microsoft. Their shares down nearly 12%, dropping the most since 2020. It's higher spending. Well, that conflicted with a slowing cloud sales growth. Tesla, they'll spend $20 billion this year on AI and self-driving vehicles. They'll also put another $2 billion into Elon Musk's XAI startup. The company discontinuing its two oldest vehicles. You have the Model S sedan and the Model X SUV. Its shares, they're falling nearly 3%. On the upside, Meta, they're saying they're going to double capital spending as much as $135 billion this year. It also delivered stronger than expected sales outlook thanks to its advertising business. Its shares are up 7%. Also in tech, IBM shares, they're up about 6%. Strong growth for its software unit. After the close, all eyes turning to Apple, the iPhone maker set for its biggest sales quarter ever. Let's get right to it. So we have the NASDAQ falling 2.5%, the S&P 500 down nearly 1.5%, and the Dow right now off about 0.7%. In the yield space, the 2-year 3.55%, that's down 2 basis points. The yield on the 10-year 4.24%, and that is little changed. Commodities, have to point out COMEX gold is right now down nearly 2% at, though, $5,248 an ounce. We have silver dropping about 4%, copper up about 3%. Brent crude, $70 a barrel. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate it. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Nora Melinda. Nora, what are you looking at?
Well, of course, we've got big tech earnings, so that's really been in focus today. I've got my eyes on Microsoft. We're seeing this stock down as much as 12%, really plunging today. Of course, we know this is after reported slowing cloud sales growth. This, of course, is really underscoring a lot of investor concerns about the return on spending. Of course, we've been talking so much about the AI spending ballooning, and that's what people are really looking at here as it relates to Microsoft. So you are seeing those double-digit losses here, but we did see that Azure, the cloud computing unit, did post a 38% revenue gain during the quarter. That just met analyst expectations. So you are really seeing the stock being punished, down for its worst day since March 2020, that pandemic.
All right, a fellow Mag 7 name moving in a different direction, Nora.
Absolutely. We're looking at shares of Meta Platforms. That's ticker META. We're seeing shares up as much as 11%. That's the best day since July. This is after the company topped projections for holiday quarter revenue and also gave a strong forecast for the current quarter when we look at that earnings report. So we did see that the company projected record spending for 2026. The CEO, of course, Mark Zuckerberg, saying it's aggressive campaign to amass AI infrastructure, computing power, and talent. That's really what a lot of Wall Street is hinging on, those words, really. So we're seeing, of course, Wall Street really celebrating the print that we got out of Meta Platforms, definitely diverging from what we saw from Microsoft.
All right, how about the defense contractor Lockheed Martin?
Yeah, Lockheed Martin. It's actually hitting its highest level ever. Shares are up as much as 8.1% on the day. This is after it reached a deal with the Pentagon to increase its THAAD missile production, planning a multi-billion-dollar investment over 3 years to expand production. So the company also did report a 9.1% increase in sales to $20.32 billion in the fourth quarter. So you're certainly seeing Wall Street rallying behind this name. We're seeing shares up about 4.9% right now as we speak. That's ticker LMT.
Good stuff. Thank you so much, Nora Melinda, our Bloomberg Television markets correspondent. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, big day in earnings, big week in earnings, really. Blackstone is the alternative assets giant that has just reported results. And right now, the stock is down almost 4%. Paul Goldberg is our senior equity analyst who covers Blackstone. And Paul, a surprise jump in distributable earnings. Deal making definitely saw revival in the quarter. And John Gray, the president of Blackstone, called escape velocity. That's how he characterized the deal making that we're seeing take place. So all of that is good news for Blackstone, yet the stock is lower. So explain what's happening.
Good morning, Scarlett. There are a few things, and I would add to your list of positive things also $71 billion of inflows in the fourth quarter and $240 for the year. So this is a record. The inflows are extremely strong. So that builds up a lot of capital for momentum in 2026. I think what's happening, there's some concern on the real estate side. The real estate business has not been recovering as quickly as some people anticipated, and probably Blackstone anticipated themselves. So that's sort of a drag among one of the four businesses that they have. Also, a lot of people are asking questions about the digital infrastructure. This is one of the key investment themes that Blackstone is invested in. And there is obviously some concern about the AI spending and a lot of those other things that I think is adding to some of the concern.
Well, in a related story, Jersey Mike's just filed to go public a year after going private with Blackstone. So that'll be I would think, a nice IRR.
That's what they want to see happen.
Exactly. So, Paul, I mean, that Jersey Mike deal, we all love the Jersey Mike subs, but does that kind of confirm what Mr. Gray was saying about, hey, we're in a better position now from a market's perspective to monetize our deals, which has been a problem for the industry?
It has been recovering in the second half of 2025. So we've seen quite a bit of pickup in realizations in general for the managers, and the rest that will report over the next 2 weeks. We should see an improved results as well. If you think of the environment, the M&A has picked up, and there's an expectation of more escape velocity kind of going into 2026. And the expectations for the IPOs, the market where they can exit, are also improving. So NASDAQ also reported this morning that Gina Friedman was on the tape and talking about improving IPO pipelines.
All right, so that's definitely something that investors want to be hearing more of.
You remember, Scarlett, we had the big take story yesterday from Janet Lauren about how universities,
the
Yale model universities are liquidating some of their private equity investments, their alternative investments. Paul, has any of the big alternative investment managers you cover, have they mentioned that fundraising may be a little difficult here because maybe universities aren't as aggressive as maybe they were in the past in terms of investing?
Not necessarily, Paul. I mean, there are some players that obviously decided to pull back a little bit given the growth in the sector. But overall, if you think of the diversification of different strategies, money coming from insurance, from the wealth sectors, they're really diversified now. They're not tied to those kind of legacy institutions, endowments, and so on that they used to raise money, most of it. And a lot of that is perpetual capital. If you look at Blackstone, $1.5 trillion of assets, almost half of it is perpetual capital.
What's perpetual capital?
This is the capital that they don't have to give back, that sits in those funds like hedge funds, perpetual unless clients decide to pull it.
Unlike universities, which are saying, wait, I need some of that money now to pay my endowment taxes or to, fund the new gymnasium or the new dorm, what have you. So yeah, that is something. And also, of course, private equity funds are now looking at retail investors and perhaps, putting them into retirement accounts. That democratizing access to private assets is a whole big thing. I want to also get your take, Paul, on Blackstone in talks to become the single biggest shareholder of New World Development. This is a Hong Kong development company. It's run along with many other property development companies in Hong Kong by a very wealthy family. What can you tell us about this, and why would this be a good addition to the Blackstone portfolio?
So in terms of the real estate, they've been very explicit that they do see the opportunities and they want to be opportunistic in terms of investing money in real estate, even though it's been kind of dragging its feet coming back. Hong Kong property market, if I recall correctly, that's been on the upswing. So they probably see a meaningful growth opportunity that they can do, and particularly in Asia. And Hong Kong hasn't necessarily been one of the Asia hubs for Blackstone. It's India and Japan, for example. But they are seeing an expansion in Asia in generally because in terms of privates, Asia is an underinvested market in terms of the private investments.
Yeah, we should mention, by the way, that the family of the Hong Kong tycoon that runs New World, Henry Chang, their firm has been approached by several potential investors and possible investments, but no agreement has been reached, according to New World.
Paul, what's Blackstone saying about their real estate business these days? I mean, they're such a leader in institutional real estate ownership. What's their strategy going forward?
Well, Paul, when you